Morning, everyone. Please settle down. We'll be starting in about 5 minutes. The governor has also arrived, so I request everyone to just come into the room now. Good morning, ladies and gentlemen. I hope everyone settled down. I'd like to welcome you to the fourth edition of the Financial Express Modern BFSI Summit 2025. My name is Roshan Puvaya. I'm the editor for Financial Express Digital, and I'll be your host for the better half of the day. Just to give you some perspective and to set the tone, India today stands at the cusp of a historic economic transformation as we are on a course to becoming a $5 trillion economy. The role of the BFSI sector is very vital and it is essential for this transformation. India's banking landscape is stabilizing. Bank credit has rebounded to 9.5% year-on-year growth in June, up from a 3-year low in May. Deposit growth remains strong at 10.4%. Meanwhile, the mutual fund industry is seeing strong growth. Assets under management are 74.4 lakh crore in June, and SIP inflows hit a record 27,269 crores and 8.64 crore contributing accounts. The Modern BFSI Summit spotlights this transformation, and of course, to get to that $5 trillion economy number, we need capital, and that's what we're going to be discussing today. The ways and means and how we're going to get there to the $5 trillion economy. Before we proceed, I'd like to thank our sponsors for today's summit, associate partners Adani Connex and BIMTech, supporting partners Zeta, Balance Hero India, PL Capital, Cyril Amarchand Mangaldas, and Motilal Oswal Asset Management as our investment partner. I'd like you all to also share insights from today on social media using the hashtag FE Modern BFSI. And I'd also like to welcome the senior delegates in the room, the Honorable RBI Governor is over here. And to welcome him, I would like to call upon Anand Goenka, Executive Director of the Indian Express Group, to give a welcome note.
Thank you so much, Roshan. Ladies and gentlemen, very warm welcome. I've had the pleasure and privilege of introducing 4 RBI governors in a forum like this to an audience like this one at Express events in the past. And every time I do it, it remains equally fun and grows increasingly funny. Now, why is it fun? It's fun because the office that Mr. Malhotra occupies, that of the governor of the RBI, it has a habit of attracting some of the world's finest minds. And it's a lot of fun to read up about their journeys. Mr. Rajan, Mr. Patel, Mr. Das, and now, of course, Mr. Malhotra is no exception. His educational background is formidable. IIT Kanpur, Princeton, and then IAS, a topper in IAS. He was involved in 2 major reforms that helped the Indian economy. The first in the power sector in 2020, and then as Revenue Secretary, he worked to formulate the new income tax regime. So this is why it's fun, because you get a refresher course in modern history, just learning through the journey to impactful journeys like his. So it's a great refresher course. Now, why do I say it becomes increasingly funny? Because I remember every intro I have done has always started with, "He joins at a difficult time." This statement is truer every time I say it. 2 wars that never seem to stop, an American president who, good or bad for global economy, I'm not sure, but he's definitely good for my news industry because of his unpredictability. There's buzz of de-dollarization, crypto growing like a religion, aiming at disintermediating governments from citizens' wealth, and now backed by the family of the US president. Domestically, we were seeing near war with Pakistan. We see an edge of our seat suspense thriller in our FTA with America. And in all of this global uncertainty, the RBI, the Finance Ministry, and the Indian economy has been an island of economic stability and faith. Bank NPAs are down, digitization is up, retail participation, investment in equity keeps rising. In spite of the governor cutting interest rates by 100 basis points in 6 months, inflation is only at 2.1%. GDP growth at 6.5%. Of course, there are challenges. Home loans are down, car sales, FMCG sales are flat, consumption is still muted, bank credit growth is down, and we're being economically threatened for buying what Lindsey Graham calls blood money, calls blood oil. So there's a lot of work to be done and a lot to talk about. So it's a pleasure to have Mr. Malhotra with us because he doesn't speak very often, and when he does, it's with clarity, candor, and wit. So thank you so much, Mr. Malhotra, for making time and for being with us. I won't stand between you all much more. If I can ask Mr. Malhotra, please join us on stage. And he will be in conversation with Financial Express editor Shamal Mazumdar. Looking forward to that conversation.
Governor, thank you. Thank you for agreeing to do this fireside chat with us. My first question to you would be that, in your lecture at your alma mater, IIT Kanpur, you recently said that you gave a very nostalgic and heartfelt speech. And you said that if you have to be trusted, a leader must have the courage to take difficult decisions. So my query to you would be, what was your most difficult decision so far as RBI governor?
So, good morning, everyone, and thank you very much for this opportunity, and thank you very much for a very kind introduction. It's indeed a pleasure for me to be over here interacting with you. I think this is a good format, it shows the fireside because it gives you the opportunity to ask the questions rather than, me doing the talking. So, we chose this format because we do make our statements every 2 months and then, we speak what we want to speak. So this is a good format, gives you the opportunity, as I mentioned, to ask questions. Yes, I did mention, and I'm very happy to note that you went to my speech. It was the convocation ceremony of IIT Kanpur, which is also my alma mater. So I did mention about trust. Trust is very important. Any relationship is the bedrock, of any relationship, whether it is in business, workplace, in a marriage, at home. And so this is something, which drives organizations, the team, to follow the leader. It's very important that he inspires trust in himself. It's been 7 months now, more than 7 months, and it will be difficult for me to put my fingers, on what has been the most difficult decision. And we have taken quite a few decisions, whether it is relating to monetary policy. We reduced the repo rate by 100 basis points, the CRR cut, liquidity, and similarly on regulation, banking regulation, we have taken a number of decisions relating to a vast variety of subjects, starting with the liquidity coverage ratio, priority sector lending, gold loans, project finance, and innumerable others. I believe that we have now put in place a system of consultation in our decision-making process. We have in fact formalized it. It was always there, but we have now a regulation-making framework where consultation becomes very important. So we consult not only for our monetary policy decisions, and I can see some people over here, who come regularly for our pre-MPC consultation meetings. We take their inputs. And similarly for regulation making, we take inputs from all our stakeholders. So I believe in decision making, consultation is very, very important. The other thing that we do is that we have a collaborative effort within the RBI for decision making. And what it means is that we try to have a mindset of inquiry. We try to have a system where we encourage constructive criticism. We test assumptions. We look at various options. We look at the pros and cons of various options. We reach out to experts. We reach out and look at international experience. And we try to be as data-driven and as evidence-based in our decision-making and policy-making. And so the endeavor really is to have better decision-making. If you illuminate the path, the walk becomes easier, the journey becomes easier. Similarly, in our decision-making, we try to have as much knowledge as possible to make difficult decisions easier. And we believe in decision-making. The other thing I would say is that we in RBI, we believe in decision-making because it is the decision-making that brings us on the path of progress.
Federal Reserve Chairman Bernanke once said that the job of the central banker is to worry. Our very own Bimal Jalan once famously said that when I woke up, I start wondering what to worry about today. Now, as the RBI governor, what is your main worry? Whether you have any worry at all, because recently only you said that RBI seems to have won the war against inflation. Now, not many of your predecessors can say that. So
that's a nice one. I mean, it's always a challenge, and Mr. Anand Goenka also mentioned this, that, whenever a new RBI governor steps in, it's with new challenges. So every day, we wake up to new challenges, whether it is a bank in distress or whether it is the fluctuations, the abnormal fluctuations once in a while that you see in the foreign exchange markets, or a cyber crime or a fraud or something. So there is a challenge, every day that we face. I would only say, you mentioned about the war against inflation. So let me clarify. You see, at the point that the MPC met in June, we had come down from a high CPI headline inflation of 7.8% or so in April 2022, down to 3.1%, which even Anand mentioned that inflation is very, very low. Even at that time, it was 3.1%, which is below our target, much below our target. And the outlook was also very, very benign. 3.7% is what we had projected. So given this fact that the inflation had come down, it was below target, I did mention that the word I used actually is jung. It was in Hindi, which we have translated to war. I do not know, whether it means war. I would rather like to say, that it's a battle. We won a battle because the war actually against inflation is a continuing one. We never let our eyes off inflation. That's our primary objective, to maintain price stability. And we have mentioned that it is not inconsistent with the other objective that we have of growth, because that is prerequisite. History tells us various economies, wherever there has been very high volatility, wherever there has been high inflation, growth has suffered. So this continues to be our number one challenge. It's not a permanent victory. It is a victory. It's a battle won, but the war against inflation continues. Insofar as you mentioned, about our other challenges, so let me say, we in the RBI would not like so much to worry rather than to prepare the economy, to prepare for the future. And the opposite of worry actually is faith. So if you do your karma, if you prepare yourself, you prepare the economy, you prepare the system, do your karma and then have faith, I think, in our system, in our economy, in our processes, and do your best. There are a number of challenges. Price stability continues to be challenge number one. And I would say banking regulation, because that's our other, ours is a full service central bank, as they say. So apart from monetary policy, we do, so many other things, including banking regulation. How do we conduct banking regulation and provide the appropriate regulations and strike the balance between growth, between efficiency, and financial stability for the banks? That's, again, a challenge that we continuously are looking at and trying to improve. And the third priority for us will be, and continues to be, is consumer satisfaction. How do we improve consumer satisfaction? There are a number of grievances. How do we enhance financial inclusion? Of course, Jan Dhan, with more than 50 crore accounts, has done a wonderful job, but we still need to further deepen it. We need to further widen it. There are still a number of grievances. We need to reduce them. I may mention that we are having, as of now, a panchayat level camps, and there are about 2.7 lakh panchayats all across the country. So all banks are going to each panchayat, spending a day over there, trying to do two things. One, widen and deepen financial inclusion, the various schemes that we have. Re-KYC is an issue, so they are trying to address re-KYC, because a lot of these Jan Dhan accounts which were actually opened in the year 2015 now are due for re-KYC, having completed 10 years, and more will come for re-KYC next year, so they are focusing on that. And the other thing that they are focusing on is consumer grievances. Related to this, I will say, is when we talk about consumers, it's not only consumers of the regulated entities, it's also the consumers of RBI, who are our regulated entities, how we can improve services for them. And I made a mention of this even earlier. We have now come out with a revised Citizens Charter for RBI, not for the regulated entities. There is already a Citizens Charter for the regulated entities. There was a Citizens Charter even for RBI. We have now revised it. There are 204 services in it. Timelines have been given for all the services. And it will be our endeavor to provide services to our regulated entities, to our customers, that is RBI customers, in the timelines that we have provided.
Right, you talked about regulation. Now, RBI is set to usher in a sweeping regulatory framework for all the regulated entities, some sort of a umbrella network for regulation. What's your view on this, and what is the status of that?
I think what you are mentioning about is perhaps a statement that I gave on consolidation of various regulations, and we have about 8,000 of them. 5,000 of those regulations, a huge number. 5,000 of them are obsolete or redundant, but there are still about 3,000 regulations that we have. So there is no new framework that we are coming out with. It's a consolidation. Let me clarify. It's a consolidation of all the regulations, all the circulars, master directions, And our attempt will be to have one master direction, one circular for all the banks. In the first phase, we are trying to convert them into 33. We have identified 33 subjects, but the endeavor is to put all these regulations, one for banks, another for NBFCs and so on and so forth. There are a number of board policies which have to be approved by the board, about 100 of them. A large number, it puts a lot of pressure on the board members. How can we rationalize them so that we can free up their space, their time, in order to concentrate on strategic decisions, on policy making, etc. The RBI has already rationalized the number of returns which a regulated entity is required to submit to the RBI. So this is one set that we are trying to do, which is a consolidation. We believe that it will provide simplicity and clarity for the regulated entities to understand, and it will improve compliance. The second thing that we are trying to now do and put in place is that we are coming up with a regulatory review cell with the mandate to review all our regulations periodically every 5 to 7 years. The purpose over there will be to, number one, see if there are any obsolete, redundant, they have lost their utility, but still they are going on. So review them as per the need, as per the new requirements, because it's a changing requirement, it's dynamic and evolving. And the second is, again, to see as to whether there is the right balance, the right trade-off on cost and benefits, consumer centricity. Look at, again, consumer centricity, which I mentioned is a priority for us. And look at if there are any regulatory gaps, anything needs to be done, for financial stability. So we will put this cell in place and review all these regulations to be able to provide the right balance between efficiency and financial stability. So these are two things, that we have already put in place, as I mentioned even earlier, a regulation making framework where two things are important, which we have highlighted, emphasized on two things. One, consultation, which I mentioned, and the other is an impact analysis. What is the impact of the regulation from a cost perspective, from a benefit perspective on all the stakeholders? So this was being done, and now we have formalized it.
Right.
So this will be the focus, of, I think, the regulation making exercise that you were talking about.
Governor, in general terms, what will RBI or the MPC's rate philosophy be now that it is more or less certain that inflation will be well below the RBI's projection of 3.7%? When people are talking about less than 3% now.
Well, this is the MPC meeting is due in another 10 days or so. So obviously, you will know what the MPC decides. It will not be appropriate on my part actually to comment on what the MPC will do, but let me elaborate on the decision, which can perhaps throw some light on what the MPC might do in the next meeting. And as you are aware that the MPC, after having reduced repo rate by about 100 basis points, exactly 100 basis points, has changed stance to neutral. So I may mention over here that the stance of neutral allows them, gives them the flexibility to move in either direction or even to have a pause. And the MPC will be looking at the data that comes in. We are looking, you mentioned about the inflation having come down to about 2.1%. I may mention over here that monetary policy, as you are aware, and your learned audience is also well aware, is forward-looking. And so more than, the current data, it will be the data relating to the outlook, 6 to 9 months, 12 months, Those are difficult decisions, as you are aware. I also mentioned that the earlier projection that we have given for Q4, even though 3.7% is the average for this year, but Q4, and it may be, revised downwards given the fact that the numbers that are coming in are lower than what we had projected even for Q1. But Q4 still is 4.4%, and we'll see how it gets revised. But at the time of the meeting, it was 4.4%. Even next year is more than 4%. So monetary policy being data-driven, more on the outlook, will be guided by the revised numbers, if any, and take a call.
A related question is, you've already cut repo rate, you've already cut the CRR rate. So, but credit uptake and private investments both remain very sluggish. Now, with amid these global uncertainties and with limited policy space now available, the question that many are asking is how low can interest rates really go without affecting financial stability in terms of asset bubbles, etc.
See, the first thing is credit growth. You mentioned about credit growth. So credit growth last year we had about 12%, 12.1%. Now, of course, it is 9.5%. You compare it with 16%. It seems very low, but we need to be looking at a longer horizon. The average credit growth in the last 10 years is about 10%, 10.3%. Compared to that, we had 12.3% last year, so it is quite healthy. Having said that, how low you are saying that the inflation, the policy rate can go actually will, depend on how the MPC looks at the numbers. I'm happy to note that monetary policy transmission is actually happening. This will also help in supporting growth as we speak. You mentioned earlier that there has been a monetary policy transmission on the credit side of about 28 basis points on new loans till May, which means that whatever rate cut was done in February, that has already translated into and has been already fully transmitted. We now have preliminary figures for June credit rates, and over there we find that for new loans, the rates are lower by at least 50 basis points. It actually depends on how you calculate it, so they are just trying to work that out. But that's 50 basis points. So which means that within 2 months of our 50 basis point, 25 plus 25, 50 basis points cut, we are in June and the whole of the monetary policy transmission has happened. So all these things will actually help further in improving credit, in improving growth. I really don't think, and we don't have any signs of that this will actually result in any asset bubbles. It will actually, as I'm mentioning, it will help in credit offtake. And for credit offtake, it's important to also keep in mind that it's, especially for large industries, because it is in large industries that we find that there is a relatively lower growth rate, but they have other sources. They have other sources of finance, and that has actually increased. So overall flow of funds to the industries is actually, to the economy is actually increasing, not decreasing, and that should all help in giving the support to our economic growth.
How do you respond to this, commentary that perhaps RBI, the MPC has shown all its cards too soon, because Trump tariff drama is going on and it adds a completely new and unpredictable dimension to the growth inflation dynamics. So many people say that RBI perhaps saw something that they didn't see, meaning a slowdown is in the horizon. What is your view?
No, I clarified this. See, actually, whatever decisions we have taken, they are basis the macroeconomic conditions and the outlook. Inflation was very benign, and growth below our aspirations, though still robust at 6.5%, below our aspirations, and so we felt, that the MPC felt that it provided them the space to cut rates. And so we have taken a very, very calibrated, I would say, decision with regard to monetary policy, which is decisive and which is forward-looking. Two things I will mention. See, monetary policy, as I mentioned earlier, acts with a lag. So you have to be forward-looking. And the other thing is, everyone is mentioning about uncertainty. Mr. Goenka also mentioned about this huge uncertainty. So what is it that we could do about lowering this uncertainty? We try to do and bring in, some certainty in our policy making. And so we believe that, if we are forward-looking, we are decisive, that actually helps in monetary policy transmission. Some of the figures that I gave you, the February rate cut already passed in May, 25 basis points, 28 basis points has been transmitted, and 50 basis points of cut by April, by June, within 2 months, it has been passed. So whatever we did, actually, today stands validated in terms of a much faster monetary policy transmission that we did. Coming to the fact that, whether we don't have anything left now, having done all this, well, it will depend on what the requirement really is. But we believe that we have enough ammunition in our armory, so to say. We have enough tools in the monetary policy toolkit. I think the reference really perhaps is to the reduction of CRR by 3%, from 4% to 3%, which is kind of seen as an abnormal measure because it has been sparingly used. This tool has been sparingly used. And so as I mentioned and clarified in some of the interviews even earlier, and let me do this again, it is not only for purposes of liquidity management, it's also for purposes of reducing costs of intermediation so that the benefits thereof are passed on both to the savers and to the borrowers, because this is actually a cost. Because we have never used it to the extent of 4%. We have used it to the extent of only 1%.
Yeah.
That too, during times of COVID. So 3% gives me sufficient cushion, sufficient ammunition, sufficient liquidity to provide it in times of need of crisis, because it is again, it's a sparingly used tool. And so we have enough resources, enough tools to be able to chart out the right monetary policy and manage the trade-off between growth and inflation.
So do we interpret it as saying that a rate cut is not ruled out in the near future?
See, we'll come back to that question again, in some form or the other. This is actually, for the Monetary Policy Committee to decide. Having said that, yes, we are in a neutral phase. The stance is neutral. And the fact that there was some commentary that we reduced it, we changed the stance too quickly. I would only say that let's not look at only the time. Let's look at the quantum of the rate cut. The rate was cut by 100 basis points. That is more material. Number two, it does not mean, as you are also pointing out, it does not mean a reversal of the easing policy. There still can be a cut. We have the flexibility to move up, down, or pause. Yes, it does mean that the bar for further easing is higher than it would have been if it was accommodative. That was a clear signal for further easing. And more importantly, I think rate cuts will depend on the outlook for both growth and inflation rather than the current numbers, something which I mentioned even earlier.
Governor, just one question on this US Genius Act, which has now become a reality. And anti-CBDC posture of the US government is also publicly known. Now, government and the RBI has taken an opposite view, contradictory view, saying that you're not comfortable with crypto. But now that US has already done it, what would be your view now? I mean, I know our committee is looking into this, etc. But do you think that there is a need now to take this into account because this act was just passed last week?
See, it will not be appropriate, as I mentioned even earlier, because there is already a committee at the level of the government, and RBI is represented in the committee. Let's wait for the discussion paper. They will go into all the issues, including the fact that now the Genius Act has been passed. We have earlier expressed our concerns, both from conduct of monetary policy, from capital flows point of view. I'm sure all those views will be taken into consideration before a final view is taken by the committee.
Right. Coming to a different subject, what would RBI's view be? I know there's been a lot of toing and froing on this issue. What is RBI's view on making it UPI remunerative for banks?
Okay, UPI. Right. So UPI, see, payment systems are very important. I think that's the lifeline. Payments, money is a lifeline for any economy. So we need to have a efficient system and universally accessible system. It's a public infrastructure which needs to be provided. As of now, there are no charges, and the government is actually subsidizing the various players, banks, and stakeholders in this whole UPI payment system. Obviously, some costs have to be paid. They will have to be defrayed. Right now, it's the government which is defraying those costs. Going forward, how those costs will be met will certainly, I'm sure, the government will be looking at it. We stay committed for providing, a means of payment, as I mentioned, which is efficient, which is secure, because digital payments, again, security is very important, and which is accessible. And whatever needs to be done for that, we will ensure that we have a good, robust, secure, accessible payment system working in our country.
But so far, RBI has proposed and the government has disposed, because last time when RBI came out with a paper, immediately the next day the government clarified there is no plan to charge anything. So do you think RBI will make a renewed push now?
See, as I mentioned, what is important is that the system should be sustainable. Costs will have to be paid. Someone will have to bear the cost. This is an important infrastructure. The government has taken a view that it should be available free, and the government is subsidizing it. And I would say that it has borne good fruits. About 2 years ago, the number of transactions per day of UPI were about 300 million, 31 crore per day. In 2 years, it has doubled, more than 60 crore a day. So, important thing is that the UPI or any other payment system for that matter, as I mentioned earlier, is accessible, it's cheap, it's secure, and it's sustainable, meaning that costs are, it will be sustainable only, if someone bears the costs. So as long as it is government or someone else, that's not so important. The important thing is that costs of any service should be paid, whether collectively or by the user.
Governor, India has, they say, has a large number of banks, but not enough large banks. Do you think that this PSB mergers, public sector bank mergers, need to be fast-tracked? Will it solve the problem, or do you have anything else in mind?
No, we need to do multiple things. Whether the banks, the public sector banks should be merged or not, that is for the government to decide. If they ask us our views, we will certainly, share our views with them. Not appropriate for me to comment on in a forum like this. Government has earlier merged, you are aware, banks with good results. A lot of public sector banks were merged. Regional rural banks have recently been merged. Now we'll be having only one state, one regional rural bank. There were 43 earlier. There used to be about 200, almost 200 regional rural banks. So there has been a process of consolidation. Similarly, State Bank of India had a number of subsidiaries. They were amalgamated with SBI. So the government will, I'm sure, take a call as to whether there is, whether it makes economic sense to merge more banks.
We know that RBI is not very comfortable about allowing conglomerates into banking. You have made your position very clear on that. But are you at least amenable to the idea of large NBFCs entering the banking space?
Large NBFCs?
Yeah. Some of them operate like banks only now.
Yeah. So, see, NBFCs can obviously, they can become small finance banks, they can become universal banks, but the conditions or the eligibility criteria for a company or for an NBFC is not very different. It is the same. So, as mentioned earlier, we have our concerns, on, while of course they have deep pockets, some of these NBFCs will have deep pockets. But if a same group, a large industrial house or a corporate group is doing financial activities and real economy activities within the same group, there is an inherent conflict of interest with the group actually dealing with the money of the depositors. And so those concerns valid and they continue to remain. And so there is no proposal as of now to allow corporates, whether through NBFCs or as a individual company, to get a banking license. Of course, they can have equity ownership up to 10% without control.
But is there a case for reviewing this promoter shareholding cap in private banks from the current 26%?
See, that is a Banking Regulation Act limitation of 26% on voting rights. So similarly, we have allowed promoters initially to go up to even 100% shareholding to be brought down within a period of 15 years to 26%. Again, this requirement is coming in because we would like no individual person to exercise undue control over, to have, undue control over the management of a bank which is dealing with depositors' money. So it's this diversification of ownership so that there are checks and balances within the owners, which we feel is necessary, and so there is no proposal to review this 26% shareholding. I may mention banks, foreign banks can take even up to 100%. You are aware that they can take up to 100%, even more than 50%. They can take going up to 100%.
No, in this context, I'm reminded of a comment by a very senior banker that RBI sometimes, the thing is, if there is accident, doesn't mean that you will stop all the cars on the roads. It's RBI sometimes, it leads to over-regulation as well. I mean, how do you maintain a balance between innovation and regulation?
No, that's a very lovely, I like that question, first of all. And so I would like to assure you that we would certainly not like to prohibit or retard any economic activity. It is important for every economic actor, including banks, to be doing various activities depending on their risk appetite. Yes, as you are saying, people can, in the process, they can fall. They should not fall too often, but they should learn from failures. Our attempt going forward will be that we allow them activities to be done within the banking sector wherever there are, if there are any such restrictions, with proper guardrails. The appropriate balance will certainly have to be kept in mind, and it will be our endeavor to do that.
I know I'm running out of time. Just two more questions. Sure. What's your view, or the RBI's view rather, on the inflation targeting framework? This has been in place since 2016. Now, are you in favor of retaining the CPI as the target, or you think food part should be excluded because RBI hardly has any control on the supply side? So in some, do you think there is a case for reviewing the inflation targeting framework?
I recall I did mention, I did try to reflect on this FIT, the flexible inflation targeting, in my first monetary policy statement, when I observed that, generally speaking, the FIT has been a success. It has lowered inflation, and it may be, I think some of the credit should perhaps, go to FIT, apart from, the other measures that the government has taken, the supply side improvements that have happened. But some of the credit should go to FIT. The inflation generally has been lower, about 4.9% after FIT was introduced. Before that, it was much higher. The inflation has generally, apart from a few exceptions, when it breached the upper limit, it's been within the band. So it has served the purpose well. It's now due for a review. As you are aware, every 5 years we do the review. We'll be coming out with a discussion paper. We'll invite suggestions from all the stakeholders, and we will give our comments to the government. Since it's round the corner, it's up for a review. We have invited, we will be inviting comments. I don't want to, preempt and take a view or a posture. As I mentioned, we will be consultative. I mentioned earlier that we will be consultative. It will not be appropriate if I give my view right away without having done the proper consultation. And after that, certainly, we will advise the government. The final call, I may mention, has to be taken by the government as to what the particular target or the benchmark should be for the flexible inflation targeting that we have. On your food thing, see, there is already, it's not a point band, it's not a point target. Keeping in view, I think, this reason that there is high volatility in food prices, and we tried to dig out some old numbers, and we found that over the last, I think, 5 or 6 years, the standard deviation, while food inflation and core inflation, both of them are averaging about 5%. Both of them is not very, very different. But the volatility in food inflation, the standard deviation over there is almost 3. So on 5, a standard deviation of 3 percentage points is quite high. And so that's why, whereas for core it's about 1%, about 1.1%. And so the flexibility, therefore, allows us to do this inflation targeting. It gives us some flexibility because of volatility in food prices.
Right. Finally, Governor, I don't want you to ask you a bank-specific question. I'm just generally saying, given the recent episode in two banks, IndusInd and what would RBI general advisory be to boards of all regulated entities? Because ultimately it's a collective decision. I mean, the CEO resigning or the CEO resigning is just tackling the problem partially. What is your, the regulator's perspective on how the regulated entity board should function?
Naturally, the boards, the ultimate, the responsibility lies with the board, but we have to at the same time acknowledge the extent, the nature, the gravity of the issues, and basis that, take decisions. The board cannot be, if the pointer is towards that, the board cannot be, held responsible for each and every misdemeanor or episode. But they need to be vigilant, and they need to ensure that the money that the depositors, many of them small, have entrusted with them is kept safe.
Right. Thank you, Governor.
Mr.
Thank
Malhotra,
you for being...
I'm so sorry to interrupt. Can I, if with your permission, a short rapid fire, short questions and short answers, and just
Only a couple of them, not more than that.
so a couple of them, and you please say pass if you feel that your advice to the Fed Chair Powell, how to deal with the president, with the U.S. president, because you've been both in government and and as a governor of RBI. So, what would your advice to how should he deal with somebody like Trump?
I don't think he needs advice. I think he's doing a very good job. So,
okay, fantastic.
Maintaining the independence of the central bank is very important. I think he has done a commendable job. I may mention that we were there in the IFMC about a couple of months ago in Washington, where the finance ministers and the central bankers of the top 30-40 countries were present. And every governor and the finance minister gets a chance, to speak on the economy and what's required to be done. And there was, some 40, 50 speakers. And Jay Powell was also there. And he spoke about, what he was doing, about central bank independence. And out of everyone, he was the only one who got a roaring applause. No one else. So I think, he's doing a good job.
Wonderful.
On that, and I don't need to give him any advice.
Super. First reaction to the UK FTA that got in the papers today morning.
Hopefully, it should help us. I think that is the way, going forward now, because unfortunately, multilateralism seems to have taken a back seat. So I think in that sense, it's good that we already have one FTA in place. It should help various sectors of in our manufacturing as well as on the services side. And perhaps, we need to do more of them. US is in advanced stages, and there are others.
Okay. The one real fear and one imagined fear of cryptocurrency.
I think I mentioned that. There is a group which is looking after this in the government.
Okay.
And so let's wait.
BRICS currency, can that ever become a reality?
Again, these are issues, related to the government. So let's hold on, that's related to your crypto. And as of now, there is not much work. There's not much work happening on a BRICS currency. But a dollar is here, as you are all aware. It's going to be here, for some time, for a longish time. It's because you need some universal cross-border currency. It's there. It's serving the purpose. We, on our part, are trying to popularize, like other countries, we are trying to popularize our own currency, which is the Indian rupee. We have agreements with many countries. With UAE, it is successful. It is operational. We are in talks with Maldives. We have an MOU with them. And similarly, quite a few other countries. And our effort will be to popularize our own currency I may mention that it will happen, but it will happen slowly. It takes years, it takes decades for local currencies to gain, to become popular.
So de-dollarization, is it a red signal, orange signal, or green signal? How would you position the trend of de-dollarization, the buzz of de-dollarization? How do you state where it is right now?
See, dollar has actually reduced. You can see, over the last few months, all countries have been trying to diversify. But as I mentioned, it will be there. It will be there for some time. It will be there for the longest time.
Last question. Any response to America's constant threats on us buying oil from Russia? We keep hearing this. Lindsey Graham, somebody else is always speaking. So any comment on that?
I think the government is doing a good job. My batchmate is there as Petroleum Secretary. He's doing a wonderful job over there. I think he will manage the situation. I have faith. I said, let's not worry. Let's have faith in our abilities, in our systems, and I'm sure, we'll be able to find a way forward.
Super. I think one question
Thank you.
from
Sir, you have mentioned a couple of times 6.5% is good, but our aspiration is high, and that's like music to everybody's ears coming from RBI governor. You have done a lot, much more than expectations to support that aspiration. But the two other important stakeholders, government and businesses, what would your advice be so that they can leverage fully on everything that you are doing on rates, liquidity, prudential norms, a strong communication, everything?
My advice is only, that we will continue to provide the right macroeconomic conditions for growth. We'll continue to provide them the certainty, whether it is liquidity, whether it is on our policies, whether it is related to monetary policy or banking regulation. And they should go out, with the confidence that the RBI is there to support them in their genuine endeavors. And of course, RBI will step in, wherever they find that some actor is not acting as per the rules of the game. Thank you.
Thank you, Governor. Thank you for your patience. And
Thank you. I'd request the governor to just stay back on stage for a second. Anant was grilling him with the rapid fire, so I would just request Anant also to come on stage and give him a token of appreciation as well. Thank you so much. Thank you, Governor. Thank you for being such a sport and answering all the questions that we posed to you. We're going to break for 5 minutes till the room settles down. You can just probably have a cup of tea. And then we will go ahead with the other sessions. And this is on the topic of bridging the talent gap, innovating education for a tech-driven future. In this, we will have Dr. Prabina Rajib, Director of BIMTech, which is the Birla Institute of Management Technology. Dr. Rajib's academic journey began with a PhD in finance from IIT Kharagpur. In addition to her teaching responsibilities, she has showcased exemplary leadership in various administrative capacities, such as being the chairperson placement and the dean of VG Swayam, IIT Kharagpur, and the chairperson for the POSH. Dr. Rajib's international teaching spans AIT Bangkok, Purdue University, and Curtin Business School. She has authored 4 books and numerous high-ranking research papers, alongside newspaper contributions. She is the recipient of the Fulbright Fellowship and the Best Case Study Award 2022. She is also the sole management school professor from IIT Kharagpur, selected for the higher academic grade professor recognition. With that, I'd like to welcome Dr. Rajib up on stage. And moderating the discussion, we have BFSI B2B editor Sandeep Soni joining her on stage. Sandeep, over to you.
Thanks, Roshan, for the introduction. I guess we are still settling down after that power-packed address. But nonetheless, we'll set the context for this current session. Very clearly, the Honorable Governor's address has given us a clear perspective on, the forces that are redefining the financial system in today's world. Whether it's around your regulatory tightening, digital acceleration, risk volatility, and the growing need of focusing on customer-centric innovation. So as we talk about, the transformation and evolution of the industry, it also brings us to one important question, which is around, talent development, leadership. Is the leadership that's coming out, is it ready to lead in the current environment? The talent that's coming out, is it as good as in understanding compliance as in understanding digital disruption? So I think that's also one of the areas where educational institutions are looking at to produce leaders, produce talent that can, manage risk, understand, AI-powered credit models, manage ESG-linked risk, drive, address the volatility in the system, and also, build trust in the, customer-centric innovation. And so our discussion with Dr. Rajiv will focus on this intersection point, where we have industry evolution and also, leadership development. Leaders that can, manage risk, drive change, lead with agility in an ecosystem, which is, evolving with a playbook of its own, in real time. So, Dr. Rajiv, I'll begin with a question around what are the financial education programs that, BIMTech offers to help bridge the the talent gap, and also how you're looking at, producing talent or leaders that can, manage compliance and also lead innovation in the industry.
So, thank you, Sandeep. I'd like to give a brief background what BIMTech is all about to the august audience. BIMTech is an organization, academic organization, which offers postgraduate program in management. Every year we take about 500 students, and we offer 4 programs: PGDM in insurance business management, PGDM in international business management, PGDM, and PGDM in retail business management. Also, we house Atal Incubation Center, and through that initiative, we have incubated about 300 new startups under the aegis of AIC BIMTech. And very rightly, in the previous session, it was discussed that India is going to be $5 trillion economy very soon, $1 trillion economy very soon. We are low in capital formation. India has, in GDP to capital formation is about 30-35% compared to 45-50% in Western advanced countries. India lacks capital, that is known. But what India is privileged is that young population. We have, India is a young country. Our median age is about 29 years. So we have a lot of potential in terms of grooming this younger generation who are going to take the leadership position in driving the India's fortune, driving the India's growth to become a developed nation very soon. So this is where academic institution like us comes into. And specifically the academic institutions which are into higher education, that we come into picture. So digital disruption is everywhere. In fact, our life is on the mobile. Now that I'm here without the mobile is probably a very rare occasion when you will be sitting in a chair or table without the mobile next to you. So life, everything revolves around mobile, everything is digital, everything is, I don't know when I held a currency note. Probably, I don't know, maybe last 1 month or 1.5 months, I have not held a currency note in my hand. So what we are saying that digital disruption has started, it is going to increase, and academic institutions like us, we are grooming the next generation youngsters by providing an opportunity where they are, they learn through by doing. In the sense, we have revised our curriculum, we are bringing in a lot of analytics related courses. In fact, sir, you will be very happy to know that at BIMTech, we have started our own digital currency. We have named it as BIMcoin. It's not a cryptocurrency, it's a digital currency. It's a student-led development, student-led digital currency developed in-house, and all shops, all cafeteria, students are not going to be using their UPI. They will be using UPI, but buying and selling through the BIMcoin. And the maximum amount to increase the usage of the BIMcoin, the student or student group which are using the maximum BIMcoin, buying and selling through BIMcoin, we are going to be suitably acknowledging them. And also, we are trying to create a platform. Suppose while graduating, you have certain BIMcoin left. So you can trade that BIMcoin with a junior and encash it. So that is also an initiative what we have started. We have gone for Bloomberg lab, about 13 terminal Bloomberg lab, and we are in the process of giving some, till now they were doing some mock trading and all. We are in the process of allocating some amount of budgetary provision so that student-led fund, so that the students are going to be learning by doing. So not only academic institutions like BIMTech, lot of other institutions are also putting in similar kind of initiative. Though I am representing BIMTech, but I am also very mindful that this is not only these are not the initiatives BIMTech is doing. Similarly, many of the higher education institutions are undertaking extremely innovative steps so that the career, whatever the industry requirements can be bridged. And you also asked me this question related to digital disruption and the regulatory part of it. See, one thing we are very mindful is that, I'll give an example here on this context. Last year, some of our students went for a project summer internship project in some fintech companies. And when they came back, when they were giving presentation on the work they have done, we could clearly see that some of the projects borderlines mis-selling of the financial products. Okay? That was a kind of an eye-opener for us, that our students did not know that these are mis-selling. They were going ahead and selling products, by some of the companies, and students did not have the knowledge or information that this is a milk selling happening. So what we have done now in our curriculum, in every finance subject, we are talking about regulation, we are talking about mis-selling, what constitutes mis-selling. Okay, so that is something, another initiative which we have done.
So we talked about, revising the curriculum. Can you give some anecdotes, some references, some examples?
See, curriculum revision is like we continuously revise our curriculum. B schools have to continuously upgrade their curriculum. But what we did last year is a major, massive curriculum revamp. In fact, we had for each of these 4 programs, we have an industry advisory body representing from various industries. So we made those industry advisory body. We also onboarded academicians, senior professors from other institutions, and we did a complete rehauling of the curriculum. But to cut the discussion short, we have brought in a lot of analytics related subjects into the curriculum, lot of fintech, insurtech, machine learning, Python, Visual Basic, lot of new age, and cybersecurity, by the way. Cybersecurity also has become earlier it was an elective subject, cybersecurity has become now a compulsory subject for all of our students. So keeping our curriculum ready to meet the industry need is something which we are extremely mindful. And also another thing which, to the August audience I would like to share here is that mandatorily every subject has to have a 30% of the teaching to be done by industry person. So 70% will be in-house faculty and 30% mandatorily has to come from a person who is in the relevant industry. So through that, we are hoping that we will be able to bring in certain content which is otherwise could have been left by the faculty members.
Yeah, that's interesting. But I think you also have certain collaborations, with, like you said, Bloomberg.
Yeah.
How does it help, in kind of, industry readiness and global outlook of, students?
See, Bloomberg is, because it's a massively expensive investment for us as an academic institution. So what we have done that every subject, finance subject, will have a certain project component coming from the Bloomberg. So every student has to be mandatorily be expert in all parameters, all aspects of Bloomberg through the subjects. That is one part. And Bloomberg also provides 3 certifications. That is your Bloomberg Market Concept, ESG certification, and Introduction to Financial Market kind of a. So all students have to be mandatorily completing this certification. Certification is important, but what we are focusing on is that a lot of industry-ready projects, B-school competition, participation, etc., should be done through the Bloomberg data so that we are effectively utilizing this resource.
Effective utilization of resources, I mean, that's also an interesting point. But given, the rapid growth projections and the market dynamics, how the industry is evolving, any real-time understanding, where, students can understand what's going on in the market through some activities, through some programs?
See, we offer 4 different programs. So insurance program, we have an insurance program where you have catastrophic bond modeling is done by an organization called Accidents. They come here, spend about 20-25 days, and to provide a full reinsurance and catastrophic bond modeling aspect to all our students. Similarly, all our retail management students go and spend exclusively in retail stores for, we call it on-the-job training. And similarly, in the finance domain, students are doing a lot of projects, participating in different competitions, and writing research papers. So learning by doing has been a very, very integral part of our curriculum, and we are continuing to focus on that.
But any real-world industry projects?
See, all 500 students go to summer internship for 500 companies. Okay. Out of that, out of 500 students, about 150 to 160 students are focused on finance, banking and finance and insurance. So all these students are doing summer internship. I do not have exact list of the companies at this point in time, but each of these students are doing a project, real life project with the companies to solve a real life problem.
Also, how do you ensure, that students can, tackle contemporary challenges in the business, in the industry, when they grow out and they graduate? Any particular focus around that?
Sir, could you please repeat?
Any particular program, that you offer to students to, to tackle, let's say, the contemporary challenges that's happening in the industry? Any real-time challenges that they can address through programs like yours?
See, a lot of professors, all of us, we get a lot of consultancy work from companies. Okay?
Correct. Yes.
And professors get consultancy work from companies, and for every consultancy work, we have mandatorily 3 to 4 students will be associated with the professors so that they contribute to the consultancy work. And all those big major competitions which are organized by different organizations like Reliance, you have TVS Mahindra, you have L'Oreal, all those big industry competitions, we encourage our students to participate, and I'm very happy to say that a lot of our students won very good prizes in these national level competitions. So encouraging them to participate in competition and hand-holding them so that they do well in the competition is also very institutionalized at BIMTech.
I think we are running out of time, but parting thoughts to the audience?
What I would like to say here is that, already Honorable Governor Mr. Sanjay Malhotra has already told, which I really, really liked. What he mentioned is that illuminate the path and journey will become easier. So that is one of the sentence. So at academic institution like BIMTech, we are striving towards illuminating the path of the students, and we are very hopeful that our students are going to be industry ready to solve the challenge of whatever the industry is facing and contribute meaningfully towards India becoming a superpower.
And we hope the path illuminated for students as well. Thanks for joining us. Thanks for talking to FE. Thank you.
Thank you, Dr. Praveena Rajiv. Thank you, Sandeep. And in the interest of time, I'm going to keep my next introduction really short because I don't think the person speaking after this really needs an introduction. He's been the chairman of HDFC for many, many years, I think more than 40 years. So we have Mr. Deepak Parekh coming on stage for a special address.
Good morning, good afternoon, ladies and gentlemen, and thank you for inviting me to the Financial Express Modern BFSI Summit. It has been an interesting morning listening to Governor Malhotra and Dr. Rajiv of BIMTech. I'm confident that throughout the summit today, the common underlying theme is the stability of Indian macros, which are favorable to support long-term growth. More often than not, it is the media and press that helps deconstruct complex financial issues, holds institutions accountable, and plays a critical role in shaping public opinion. Personally, my day hardly feels right if it doesn't start with a cup of tea and a bunch of newspapers. Might I add that way back in 1993, it was a chance glimpse of a small advertisement in one of the newspapers that caught my eye. This was issued by the Reserve Bank of India, inviting new applications for new private sector banks. This is the origin of HDFC Bank, and the rest, as they say, is history. I also believe that financial professionals and the media have a symbiotic relationship. Good relations with the media is always an asset, but it works only if it is a two-way street. The media will help to carry the right message about your business, but it's equally important to reciprocate and freely discuss what is actually happening on the ground, changing sectoral trends and issues beyond the realm of your own company. It is important in a financial ecosystem to have leaders with strong voices, those who unhesitatingly articulate the good, the bad, and the ugly, and are willing to be systemic solution providers as well. We need this because it is the BFSI sector that has the real pulse of the economy and plays an integral part in shaping next generation reforms. They say that the future has a way of arriving unannounced, faster than one expects, and in ways one doesn't quite predict. If our future seems somewhat uneasy, it is true that a lot of present is also increasingly feeling unfamiliar as well. We are living in a more confused world of paradoxes. How does one deal with the on-again, off-again tariff saga? Is prolonged uncertainty worse than dealing with the impact of an unfavorable policy? What is the real cost of global wars? Be it military, be it geopolitical, be it trade, cyber, bio-warfare, amongst others. What is the future of jobs in India? People telling machines what to do, or machines telling people what to do? Pun unintended, will the Genius Act be stable or unstable for global central banks? The truth is that we do not have any answers of so many of these questions, and all these issues will impact the global financial sector. But let me take a more nuanced view of the present. We have crossed the halfway mark of calendar year 2025, and no catastrophic doomsday scenario has played out. Yes, there is a secular slowdown for both advanced and emerging economies, but there has been no recession. There is some trade truce with countries, negotiating trade deals amongst each other, while recognizing that these deals take time to fructify. In fact, the US Treasury Secretary has confirmed that there will be no rush for the sake of doing deals. India too is rightly holding its ground to ensure trade agreements are fair, equitable, and mutually beneficial. Despite heightened geopolitical tensions, year to date, global oil prices has been softer, with major producers increasing their output. In equal measure, renewables have continued to gain traction. China has eased up on exporting rare earth elements and magnets now. For all the recent noise on interest rates in the US, better sense seems to have prevailed on the importance of preserving the Federal Reserve's independence. And we heard the governor talk about the same thing about the independence of the central bank. Global inflation is trending down. Again, the governor mentioned that. Post the shock liberalization day announcement in April, global stock markets too have recovered, with the MSCI Global All Country World Index rising over 10% year to date. So certain data points may diverge or disappoint. One hopes that the second half of the year will be less eventful and more productive. My experience of over 50 years has taught me that financial markets are quick to react, but equally quick to stabilize and equally quick to correct. Secondly, market memory is short. The pain points of yesterday are easily forgotten. And thirdly, financial markets always need something to be excited about, and in equal measure, financial markets always have something to worry about. Let me turn specifically to India now. The macros are stable, undoubtedly, but the very recent data on some high-frequency indicators have tempered downwards, as GST collections, bank credit, urban FMCG sales, passenger vehicles, diesel and electricity consumption suggesting mixed narrative playing out. Anand Goenka in his introduction mentioned the same points. So while there has been a tempering of urban consumption, rural consumption has held up much better so far. My reading is that in the second half of the calendar year, we should see improved urban demand, though rural consumption in the second half will continue to grow at a slower pace. Lower interest rates, the upcoming festival season, and the income tax relief of 12 lakhs per annum should be favorable for the consumption growth engine. This June quarter earnings too reveal a nuanced picture of resilience as well as divergence. Corporate results of 280 companies reveal that profitability has been strong with a growth of 18% for the quarter ended June 25. But revenue growth remains tepid at 5%. What has transpired is that for many, profitability has been driven by cost optimization and extraordinary income. Cost optimization may plateau at some time. So focus has to be on revenue growth going forward. Here lies the challenge of boosting private capex. Again, we heard in the earlier session, because capacity utilization has not moved up from the 75% levels for a while now. Yet this recent CMIE data shows that in the quarter ended June 25, manufacturing sector accounted for 54% of the new project announcements, amounting to 2.3 trillion rupees, and was mainly in sectors like metals, chemicals, machinery. This may mark a turning point, especially with the government's concerted effort in positioning India as a global manufacturing hub and integrating into the global supply chains. No doubt state governments too need to do some heavy lifting if we want to shift the needle for manufacturing from 15% of GDP to the desired level of 25% of the GDP. So let me articulate my views what is happening with bank credit. For the longest period of time, we have always said that India's debt markets are too shallow. India Inc. too was too dependent on the banking sector, and that came with its own sets of risks. We are now at a stage where we are seeing a fair share of disintermediation of banks. The better rated companies, the AAA, AA rated companies are increasingly tapping into the capital markets for resources. Further, many corporates have significantly deleveraged themselves, with capacity addition still tepid. Corporates that are considered riskier and where banks may be reluctant to lend are using the alternate investment route or tapping the international markets where there's a huge demand for higher yields. Even junk bonds internationally are saleable by Indian riskier companies. But this is not all a sordid saga for banks. In fact, while bank credit growth decelerated in 2025, the doors opened up for the MSME sectors, where bank credit grew by 14% and accounted for nearly 18% of outstanding non-food bank outstanding loans. Much of this is due to the relentless efforts of the government to encourage the growth of the MSME. With asset quality improvements and access to significantly better data on MSMEs, one hopes to see further lending in this segment. Other segments, including retail credit, should see a pickup going forward. NBFCs have actually gained market share recently and continue to play a critical role as their target segment is generally different from the customer segment that the banks focus on. Unsecured lending overhang has been reined in with timely interventions by the regulator. Banking support to NBFCs, in my view, will pick up from here on with regulatory concerns not being alleviated. As I have said many times before, I continue to remain extremely optimistic about the growth opportunities in India, and the financial system remains the backbone of our economy. Despite the secular slowdown globally, India still remains the fastest growing economy, and yet it is important sometimes to put scale in the context. India is currently $4 trillion economy, with ambitions to get to 5 trillion in a short span of time. Yet a single company in the United States, NVIDIA, the market capitalization is 4 trillion. Because AI chips are powering the fourth industrial revolution. What was surprising to me is that cryptos, too, are estimated to have a market value of $4 trillion, the same as the size of the Indian economy. I suspect there will be a lot of debate on stable coins following the US's pivot. How does one weigh its benefits of innovation and lower transaction costs versus the challenge to financial sovereignty? What happens to central banks' digital currencies? How does monetary policy get protected? Will the rest of the world accept stable coins pegged to the dollar? How this eventually pans out, again, is a $4 trillion question, but this is a development that needs to be watched carefully. Even as the contours of finance future remains uncertain, in India we know what we aspire for, that of Viksit Bharat by 2047. We now have a blueprint of what it will take to get to a $30 trillion economy. So from the BFSI point of view, what is it going to take to build future-ready institutions? Here I would go back to the time-tested value-based playbook. Many of the goalposts will change as new financial systems evolve. Yet some fundamentals remain unchanged, and these are the fundamentals. Always remember, in the BFSI sector, you are the custodian of someone else's wealth. Financial systems works only on trust. A trust deficit or a reputational loss is normally irreversible. In almost all cases, greed has been the prime reason why financial institutions collapse. I have always maintained that culture and quality of customer service are the only differentiators of product patents for lending institutions like banks. There is no substitute for prudence, and there is zero tolerance for impropriety, and always build for the long run. This, to my mind, is the core of building a future-ready institution. The rest is about understanding customer needs, first-mover advantage, and building resilience and scale. One often hears a new age company saying they are building a tech-first or a digital-first business. To me, the customer-first approach should never be displaced. In our zest to keep up with the emerging tech and competition, we often forget how important it is for tech to be empathetic. Tech is imperative for the BFSI segment, but so is judgment, so is gut feel, and so is intuition. Tech empathy is about understanding what a customer needs, understanding a customer's ability to adapt to tech, and most importantly, prioritizing customer safety. The irony is that the more we embrace tech, the higher are the risk for cyber attacks. Estimates are that India could lose 20,000 crores in a year through cyber attacks and financial fraud. So future proofing will entail increased investment costs. I never tire of saying that India has a long runway of growth and still remains a largely unpenetrated financial market. So before I conclude, I think there are two critical socio-economic sectors issues that I want to highlight. The first is jobs, and we heard the BIMTech person talk about jobs and training young people. As they say, employment is just not an economic metric, it is a social stabilizer. The young workforce has to be gainfully employed with future-ready skills. It is estimated just 4% of workforce receives vocational training. We have to increase this vocational training. Unemployed rate is high. We have graduates who are not job ready. But On the other spectrum, we have among the world's best talent, with global companies chasing Indian talent overseas all the time. How do we bridge this divide? And it is important to note that unemployment in youth is not just India-specific problem, but one that is prevalent even in developed economies. The second issue is housing. Governments have pulled their load on improving urban infrastructure, but the housing markets are now getting skewed towards premium and high-end luxury sectors. It is often reported there is no demand for middle income and affordable housing. This is absolutely incorrect. It is the supply that has dried up for these income segments. What we don't want are speculators in the housing markets. I truly believe we are at the right inflection point to pivot and focus on middle-class housing. There's massive demand for middle-class housing, but there is limited supply. For developers, this segment entails lower margins. Therefore, they're not interested. But well-executed projects, they don't have an issue of unsold inventories. Loosely defined, India's middle income entails households that are earning 5 lakhs to 30 lakhs annually. And in number terms, this cohort represents 715 million people by 2030. We all understand the backward and forward linkages to housing, to other ancillary industries. And the real estate sector is the second largest employment generator as well. So I hope we focus on where the demand is most, because there is nothing more beneficial for a country than building a property-owning democracy. So to conclude, I remain optimistic about the future of India, our country, and I think some of our best days are yet ahead of us. Thank you.
Thank you so much, Mr. Parekh, for those words and showing us where India is right now. And of course, whether it's tech first or digital first, we always have to remain customer first. I think those are very wise words. In the interest of time, I'm going to give a very short introduction to the next session, which is on unlocking growth, innovations, and capital for the $5 trillion economy that India is targeting. This is, again, a fireside chat, and we will have industry veteran Mr. Gopal Srinivasan, who is the Chairman and Managing Director, TVS Capital Funds, and also Mr. Navneet Munot, MD and CEO of HDFC Asset Management Company, joining Kumar Sharma, Deputy Editor of Financial Express Digital, on stage. Mr. Srinivasan, Mr. Munot, if you could please come on stage. Thank you.
With the panelists here, I think there'll be more fire and less chat. And I'm hoping. You're searching for papers, Mr. Gopal, you'll be making me nervous. I was wondering.
Preparing for exam at 2 o'clock. Papers all over the place. I want to prove to the world I'm a qualified AIF manager and passing the exam. I happen to be part of the group that decided there should be an exam, so it's even more important.
My goodness. Okay. Very briefly, I know you have a hard stop at 12:30. I'm just trying to keep that in mind. Very briefly, while we have to the incredible speakers here, actually a round of applause. We have a public markets person and a private markets expert. I mean, both, we couldn't have a hope for anything better than this. Very briefly, why $5 trillion when actually we should be talking of Viksit Bharat? Essentially $10 trillion. We should be talking about that. But when we spoke to people, they said, at least for the moment, tell us. नहीं तो मीडिया में बोलते कि आप कुछ बोलते नहीं, सब फ्यूचर का बोल रहे, कुछ नहीं कर रहे, some such thing, give us some goal or some such thing. Very briefly, the reason for this is essentially there is no two ways on the capital requirement. Basic math will tell actually that if we have to get to $5 trillion economy and grow at about 8% thereafter, we will need something like $440 billion of that kind of a growth with 8%. And if our input capital output ratio is around 5%, around 5, that means we need to invest 5 times that, which is about $2 trillion, which is huge. I mean, we at best we can get about 31% savings as percentage of GDP. A lot has to come from the institutions other than this. While the country is blessed to have institutions and instruments and a huge diversity and variety of that, the uptake still seems to be a challenge. So one opening thoughts from both of you in terms of how you look at the challenge from a capital, deepening the capital pool, so to say. Mr. Gopal.
I think thank you again for having me, and I think it's just been fantastic to listen to two amazing speakers, the RBI governor and of course Mr. Parekh, who is an inspiration to all of us and has touched all our lives. And I think both the editor and Anant asked some really good questions to make this truly, I think, a learning session for me. And I love to tweet my sessions, so I tweeted both the sessions.
And we will also have Mr. Nagaraju after this, who will again bring in newer
Absolutely, absolutely. I just think, the private capital person and the public market person sitting next to each other is a sign of Viksit Bharat. In Viksit Bharat, public and private are going to merge. You're going to find that there is a zone, not everywhere, but there is going to be overlapping. If there was a Venn diagram, these two circles have an intersecting area. And that intersecting area is only going to increase. When basically Vanguard says they're going to offer ETFs based on private capital last week, at the same time when Blackstone says they're going to offer products that go into pensions, right? I think it's going to be, so I would just want to make a sign of Viksit Bharat is that as the capital pools of 5 trillion now? What's the market cap of India?
5, yeah, close to 5.
More than NVIDIA. Okay. So basically, and the private capital pools, which, whatever number you want to put it, it's maybe 8, 10 trillion, maybe 15 trillion, somewhere in that range, because some of it is not clearly accounted in the FDI system. I think for Indian private capital to grow, particularly in venture capital and private equity, I'm not talking about infrastructure and real estate, it's a totally different business. Demand is not an issue. The government is doing everything to increase demand. The Honorable Finance Minister's recent speech, which all of us has resonated with us so well, that 50% of total bank AUM should at least be the NBFC's target, and that co-lending should be accelerated, and that banks should look differently at lending to NBFCs, is one of those most powerful statements of demand, because this is 34% of all private investing in India, or 35% roughly, is financial services. Another 10, 15 is tech, so about 50%. Where is the NBFC capital going to come from, other than from AIFs initially and then public markets eventually? I'm the beginning, he is the end. So the end always matters more.
Unless he also has ambitions of AIFs.
So I think the key point from what I see in India is not about the availability of capital. Yes, private equity alone needs about, from today it's roughly, call it 2.5 trillion rupees a year. We estimate that we need about 10 trillion rupees a year on a steady state basis. The total AUM of private capital as a percentage of GDP is about 40% or 30% of what it is in the US. I'm talking only about private venture capital, private equity, not including any other areas. So clearly there is a lot of demand. I'm just trying to make the demand side case first. On the supply side case, if you just look at it, I know I'm hesitant to make the statement in front of people like Mr. Nagaraju, who are absolutely have everything at their fingertips, because I'm still a few steps removed. The current account deficit is not doing too badly. Last year, if you see total IT services, GCC exports, and inward remittances, I think touched close to $500 billion. And it's growing at about 10 to 20%, somewhere in that range. So with that situation kept in mind, rupee capital is actually freely available for growth in this sector. Our problem is channelizing the rupee capital in, I'm talking about private equity alone, so I'm not touching his 65 trillion or whatever that number is. Basically, the channelizing that is our biggest challenge. Right? Insurance companies have learned to do it very well. Our recent fundraise is about 4,500 crores. Out of that, nearly 1/3 has come from insurance, primarily, which is could never imagine this 10, 15 years ago. But we have no access to the two important segments in private capital. And that's where I think, people like Ms. Nagaraju who are in saddle have to apply their mind and give us, help us to find answers together collaboratively. One, pensions. Today, India is the most severely under-pensioned country in the world. It's a very well-known fact.
Despite, I think, 12.5% of population being over 60.
32 trillion, 33 trillion rupees, somewhere there is a total pension pool. And some of it is in private, PF. Some of it is not in pool. Some of it is just in the balance sheet of the government of India, like the OPS or now the new pension scheme and so forth. It's like that pool has to grow for Indians to be secure, first of all. That day I had lunch with an Australian representative of the Indo-US from the Australian Prime Minister's office, the Indo-US, some group they had. He talked about 300 trillion rupees. He said, I'll speak in your language. Our pension pool is closer to 300 trillion rupees. Right? And I understand, they've been at it for a long time. It's a mineral-rich country. So pensions, I think, coming to private capital is a big, big opportunity. Even at 5-10%, remember the US is closer to 20% of pension money going to private capital. How do you do this safely? How do you do this in the most sensible manner? Because pension is the most precious capital of this country. I think that's something that people like Mr. Raman, the new PFRDA chair, and the government ministries of pensions in Delhi have to sit and address. How can we do it in a manner that is safe? Is it through fund of funds? Is it because the fund of fund model of SIDBI has been superbly successful? So do we emulate those kind of models? And the second thing I think is people like him. Retail money in India, we can skip the American model like we have skipped everywhere else with UPI and Aadhaar and mobile, internet and so forth. We can do one more big skip, and that is to take retail money into private capital. Which means how do you create a retail fund of fund where the minimum ticket is 1 lakh, and basically that fund of funds, like HDFC has a good fund of funds, but it's not a retail fund of funds. It is still regulated by the minimum 1 crore, etc. And in that retail fund of funds, how do geniuses like Mr. Munot, and I really think one of the smartest investors in the market, in my opinion, take basically and say, look, I'll put X percentage in liquid markets, in ETFs, in other public markets. I'll put Y in drawdowns of private pools. And then when the need comes, I will have some kind of fungibility between the two pools. So we can create 1 lakh crore, 2 lakh crore funds, which are also investing into private capital and also keeping a liquid public pool, which is typically happening now in America. So these two things, I think, will unlock any amount of capital we need. That going from 2-3 trillion to 5-10 trillion a year is rupees in private capital will be done. So I just think money is in India. I'm not even talking about monetizing gold, which is impossible, right? But I'm just saying without that itself, there's tons of money between pension growth and the general growth, secular growth of insurance money. Today we're getting checks from insurance companies to the tune of 200 crores into one individual fund. Because I cannot imagine that before. Even 200 lakhs I could not imagine. So this is my sort of 2 cents worth. Huge demand, tremendous success India has shown in regulatory collaboration with the sector, brilliant collaboration India has demonstrated. And this can be done by touching pensions and by letting retail money to flow into both private and public at the same time, rather than wait for the American model to go step by step.
And increase perhaps also some argue that perhaps there should be also some focus on the net FDI. Net FDI, because we have to see FDI from both sides.
FDI in our sector should become an accelerator and not the primary dependency.
Because that's where portfolio money would be one.
No, but I think FDI will come based, that's a pure merit, that's basically pure merit-based money, nothing we can really do. But it should be an accelerator. In the venture capital private industry, when I started, it was 99.99% FDI. Today we are now down to about 80%, maybe 75% FDI, because numbers are difficult to get. And I think next year it will come to 70% FDI in 2-3 years' time. At some point in time, like Korea and China, will be 60-70% domestic money within the next 10 years. And FDI will accelerate the domestic money, which is how it should be. It should not be domestic money is a kind of filler for FDI.
Navneet, your thoughts, especially on the one which Mr. Gopal has mentioned about the private.
When are you launching it?
In few days' time, we'll be celebrating the Independence Day. India got the political independence on 15th August 1947. In many ways, we got economic independence in 1991, where entrepreneurial energy got unleashed. I think 2014 was a historic time, apart from many other structural reforms that we have taken in last 10 years. One of the most prominent one, I would say, is the Jan Dhan Yojana, where we we integrated 1 billion people into the mainstream financial system. And I think from the early 20s, what we have seen is what our industry, Nilesh Bhai is here, some of the other people, and with the help of people like you, what we have done is that taking the Jan Dhan to the next logical step, which is a Jan Nivesh. Of course, this is not like a Jan Dhan Yojana, but what we are trying to do is to transform the nation from a nation of savers to a nation of investors. A nation of savers transforming into a nation of investors, which is very critical. The sheer size of savings pool that we have got in the country, if we channelize that into the productive uses, if we do this capital formation, then growth can have a virtuous cycle for next several years. My grandfather lived in a country where India got wheat in PL 480 on a humanitarian ground from United States.
And the two bad
My
wheat.
father lived in a country where foreign grant was very critical for our survival. I lived in a country where every entrepreneur had to rely on foreign capital, public market, private market. He talked about venture capital. 98% money in this country came from the foreign investors. My chairman talked about the birth of HDFC Bank, but you go back and check, the original investors were all foreign investors. There were hardly any domestic institutional money available. But my son is living in a country where a Korean automaker is importing capital from this country. I take deep pride in being part of that industry which has made that possible, but we have a long way to go. Now think about it. Since 2021, mutual funds have invested $150 billion in equity market, $150 billion. Insurance would have done another 40 billion or so. Close to $200 billion have come from domestic institutions, and in this period, foreign investors have hardly invested in last 4 years. He talked about the FDI, but there is a positive aspect of that. There is a positive aspect of that FDI being like at a net level being close to zero, which means that large number of these companies which are funded by global venture capital and global private equity are seeing exit in the public market, thanks to the retail resilience, thanks to the retail flows that the industry is getting. Now, this exit will give a lot of confidence to structural long-term investors in the world. I was on a US roadshow for a couple of days, and I was telling my colleagues that this country has $50 trillion of institutional money to invest. If we can just get 1% of that, that's $500 billion. I think we are underestimating what the potential of this country is. I think it's up to us, between all the stakeholders, whether it's the government, policymakers, people like us in the financial sector, the businesses, and society at large. If together we work, we just need to enhance the absorption capacity of the global money that can hit us. On the other side, what we are trying to do is that as a growth, 20, 30, $40 trillion next 20, 25 years, what our industry is trying to do is channelize the household savings into the productive investment. So you do the capital formation, create growth, create jobs, make it virtual. And on the other side, what you do is that, as like Prime Minister says, that we have to ensure that our growth model is more sustainable, more inclusive, and more equitable. What we are trying to do through the SIP is that make growth more inclusive, make growth more equitable, and trying to ensure that whatever this country is going to deliver, both in terms of economic growth and the growth of the corporate sector, be it in the private market or in the public market, we deliver to every household. This hasn't happened in many countries. India will be one of the test case for next 20, 30 years, at least for the global south, if not more, that how we ensure that through a capital market mechanism, we made the growth a lot more inclusive. This will be really a very, very interesting case study for rest of the century, for the rest of the world.
You agree with that, Mr. Gopal? I'm sure you will.
Who can disagree with Navneet?
Yeah.
He has seen everything from both SBI to now. And I think what he says is so correct, basically, that fundamentally we have to increase our absorption capacity.
And how do we do that?
And I just want to talk about the biggest missing thing in India, right? See, in India, India's Got Talent is not a TV show. It's a reality show. That's our basic advantage. Even though, of course, it's a bit depressing that 66% of JEE 100 ranks went abroad last year and 33% of JEE 1000 ranks went abroad last year. We still have a lot of talent from where it came. I think people are talking about infrastructure. People are talking about industry. Mr. Parekh gave this beautiful CMI number of 54%, 2.3 trillion rupees. The thing that is missing in my mind, India has so many problems to solve, right? So there's no one thing that is missing. I just want to pick one of those things, and where the government has actually started doing something stupendous, if you ask me, right? And it's an initiative of private sector and government doing it together. It wasn't just a one-way initiative, and that is innovation. We have very limited technological innovation in this country. We have incredible process innovation in this country. Everything is so live. We have incredible regulatory innovation. Our regulators have done a fantastic job. UPI in many ways is more a regulatory innovation than a technological innovation, right? But where we are missing is true technological innovation. Take PhDs, 1/6 of China. Take patent filing, it's again 1/6, 1/7 of China, another such story. You take R&D from private sector, 36%. In China, it's about 75% from private sector. And on and on and on. We can reel out a bunch of numbers. But what is the point? Innovation needs true risk capital, which I don't think Mr. Munoz is going to give, and neither is TVS Capital. We are all very measured in our risk, because India is very punishing when there is poor returns on risk. You get hammered in India. People only talk about the one company that failed in your portfolio. They will never talk about the 11 companies that made 30%. This is the nature, and maybe it's correct also. Maybe that's our psyche. The R&D innovation announcement this time by the government of saying they will give 1 lakh crore across 5 years, 50 years interest-free. And if that is given at 20,000 crores a year, and let us assume that some smart team of people in DST and others are managing it. I know private sector is going to be very closely involved. Out of the 20,000 crores, you put 2,000 crores in government bonds. In 50 years, that will give you 2,000 crores. So 18,000 crores of risk capital, which you can take crazy risk. And we need to take crazy risk. Whether it's in biotech, semiconductors, defense.
Talking of deep tech and all that, then
I don't know what is deep tech, right? Because for me, all tech is deep because I'm a shallow guy, right? But all I'm trying to say is, frontier technology, if you read the US government's 3-pillar note on AI strategy, which I presume all of us have at least had ChatGPT summarize for us, which is what I did, I think what you really see is you need to take crazy risks. You need to say 95% failure is absolutely fine. I have a great process of screening, and I will give grants from the TR, what they call translation research 1 to 8 stage. I will have a fund of funds. The fund of funds will give through debt mechanism, a grant mechanism that is convertible to equity if the company is successful, an equity mechanism. Already SIDBI's fund of funds with 1-for-1 matching has been a runaway success. They create 100 fund managers in the country. SIDBI has created. So that, I think, is what I'm thrilled about. This coming to life will allow in 3 to 5 years' time, that's what it takes, Indians to take crazy risk. And when Indians take crazy risk, the 2-3% will be crazily successful, will create capital absorption that you cannot imagine. I spent 5 days in the US, Monday to Friday, only meeting VC funds and startups in San Francisco and Seattle. Every AI, I visited Google, I visited Meta, I visited NVIDIA, I visited whoever. Look at the capital absorption.
And what did they say about India versus China? Did they say anything that why we still want to go to China?
I don't think they have any perspective on anything other than how they're going to multiply their capital. Let's be very candid about this subject. Nobody is interested in India versus China. They want to say, boss, हम पैसा कैसा बनाएंगे, हमारा कंपनी का वैल्यूएशन कैसा बढ़ेगा. अब पुराना ज़माने में यूनिकॉर्न के बारे में बात करते थे, अब तो चीटा का ज़माना आ गया. We are doubling our revenue every 2 months. We are doubling our valuation every 6 months. So this is the conversation in America, right? So that's what it should be. That's their business. But I think the key story to me is crazy innovation. And with this RDI fund, I think India is preparing itself for something that we could never imagine, and that is taking crazy risk. So I'm super optimistic about many things in India. In fact, but I'm most optimistic about this, and this in 5 to 10 years is going to create, for to doyen sitting here next to me in front of me. Incredible capital absorption, because you'll find tech companies which we never saw worth 3 lakh crore, 4 lakh crore, 5 lakh crore. And they will be only funded with Indian capital, because the grant came from India, the seed capital came from India, this pre-Series A, Series B, Series D, up to IPO. So that's what I'm super thrilled about.
So I think on the first
he talked about like the tax ecosystem in US. In US, they say that if you put enough capital and enough engineering prowess, any problem can be solved. I mean, you can create a colony in Mars or whatever, everything. In India, I think we need to flip this. If you put enough passion and a deep sense of purpose at the center, any problem can be solved. What we did on vaccination, what we have done on financial inclusion, what we are doing on electronic voting, I can go on for next half an hour. I think it's the frugal engineering of India. The human ingenuity is at its best.
So this is where I disagree with him.
I just give me 1 minute, Gopal. Just give me 1 minute.
I think we should have to
just give me 1 minute.
Risk-based capital and forget about passion. Clinical objectivity with data discipline.
I think the capital is falling in place. At $2,500 per capita, there is no country in human history at the capital market ecosystem, the institutional infrastructure, and the technology prowess that we have. We need to be like so proud of what we have created. But I think this is just the beginning. And that's why I said that this transformation of country of savers from country of savers to investors is a big thing. And I completely agree with him. Businesses need to take more risk. This is what I asked Governor also in morning, Anand, that I think he's done so much. There are other regulators trying their best. But what more we can do to promote more risk-taking in the society? And I think this is where our role is as financial investors. How do we find the next leg of those entrepreneurs who say that we don't want to kind of have another profit pool from paint industry, but we will create the best-in-class physical infrastructure, social infrastructure, digital infrastructure, will solve problem at population scale, and there is market who's willing to take that risk. We got into alternatives. I mean, we manage $100 billion on public markets. But the reason we are in alternatives, because my view is that if not us, who? If not now, when? This country needs risk capital at very early stage, and we cannot say that there is so much of opportunity in the public market, you should not be there. So Gopal, I very much agree with you, but it's just that we should blindly follow everything that has worked in US.
I'm going to say something. I do not think our alternative managers, including TVS Capital, really take risk. Right? I don't think they take the kind of risk they should be taking. For a 10 trillion, 30 trillion, 50 trillion in India, we are sitting here happily with 4 trillion and saying we're happy. No, I'm saying we should not get fat, happy and contented. Basically, we have 26 trillion as per Mr. Parekh's number, 30 trillion, I think he said. Somebody said 35 trillion. You've got 25 to 30 trillion. You have to grow 8 to 10 times your current size. And that is not going to be happening with UPI and Jandan and whatever else. Those are fabulous moves. And it got us here. But what got us here is not going to get us there. Yeah. And that's where I think, maybe I'm just coming off this 55 meetings I had with every single AI company and every single VC in America, right?
And just the last point, I think since they mentioned this point about this growth drivers and this big numbers, innovation and all of that, along with that, the point about the inclusion part, which sometimes gets missed out in the story. Like Mr. Gopal talks often about nano and micro, and he has created that abbreviation
Nano Micro Enterprise.
Namo also he's created.
Enterprise.
Okay.
I'm a fan of the Prime Minister, so it suited me
So
well.
he's created that. But there is, if you look closely, just one number. I was reading up, there is this hired worker enterprises. 1 crore of them. These are not mom and pop stores, which are about 6 crores in the country. Those are 1 crore, and to get to sustainable level, to sustain themselves, they need something like 15 to 20 lakhs each. I mean, we have options where actually we can deploy funds. So it's not that there is no thirst for funds at the lowest level as well, much below nano also. So I think...
So the kind of schemes you're thinking of is if every mobile subscriber get 1 rupee a day from his bill, we will get 36,000 crores and we should put them in startups. I'm just saying, we can come up with all kinds of interesting numbers in India, right? Government's job is inclusion. Yeah. Industry job is to be killer. Basically, I would say, I'm sorry, I hope I don't get put into some box here, but we need to be Kshatriya mindset with Baniya behavior.
Very good.
So somewhere, unless we can get this going, because there's a war out there.
Yeah.
And we have the best talent. I know we have not enough IITs. My son is in IIT Bombay, and I see how difficult it is for these kids to just get, the number. All that will get sorted. But my mind, unless we go with not passion, but with a killer mindset, only that will get us to the next level.
Excellent. I think.
But maybe destiny is helping us. We exported best of our talents in the last couple of decades to other parts of the world. Whatever is happening at Harvard, whatever is happening in job situation in US, UK, there's a high likelihood in next couple of years, not by conviction, by compulsion, a lot of these kids actually come back. A lot of those professors come back. What we need to do is put a red carpet for capital and for talent. How do we get the capital which is waiting to hit our shores? There's so much of talent in the world, Indian talent, whose heart beats for this country. How do we get them back? Can we say that for first 3 years, we won't take 39% of your income, and we won't take like another, wherever you spend, we'll take 28% of the GST and several other things where you'll have to pay for your security, pay for your water, pay for your healthcare and education and everything. Can we do something for them to get the best of the talents back into the country? China did it 20 years back, and they really benefited a lot from it. The next DeepSeek is going to come from this country if we do that right.
Wow.
DeepSeek is already dead, though. I'm just saying. So I think the thing is changing so fast. That's my limited point, right? Yeah. It needs some different mindset to get to the 35 trillion. It's not the same mindset. The good guys are there. If you have great businesses, the talent will come because of that reason, without a tax break. I don't want to be the Italian government saying Trump is a bad guy, so all professors of Italian origin coming back to Italy, there is 3-year tax holiday, or something to the effect which the Italian government has done. I think that is a different part. That is the inclusion scheme. To me, I want the warrior scheme.
Excellent. Yeah.
I want to see Achilles. I want to see Arjuna, who are absolutely ruthless in the battlefield.
Thank you so much. I think we have laid the ground for listening to Mr. Nagaraju. I think the path ahead till Viksit Bharat may be the next step. Thank you so much. A round of applause for our incredible speakers.
Big round of applause for Mr. Gopal Srinivasan and Mr. Navneet Manot. Kshatriya mindset, Banya behavior, a country of savers to a country of investors. And, for that $35 trillion that we're going to get. I think some very thought-provoking discussions that happen here. And thank you so much for that. And now taking that forward, we have the Honorable Secretary of Department of Financial Services, Ministry of Finance from the Government of India, Mr. M. Nagaraju. He's going to take this discussion forward. So banking in Viksit Bharat, challenges and opportunities. He'll give a short address, followed by a quick fireside chat with Shobhana Subramaniam, Deputy Managing Editor at Financial Express. In the interest of time, I'm going to keep my introduction of Mr. Nagaraju really short. He has served as the District Magistrate, Director of Tribal Welfare, Secretary, Principal Secretary of Health, Finance and Industries and Commerce Departments, and he's been deeply involved in tribal development work and rehabilitation as well. He has served in the Ministry of Finance in between 2004 and 2008, in the Department of Economic Affairs, as Director Japan, North America, and the Director in the World Bank Division. After that, he's also worked as the advisor to the Executive Director at the World Bank in Washington till 2012. And he was closely involved in G20, G24, and many G11 discussions as well. So with a huge round of applause, can we welcome the Finance Secretary, Shri M. Nagaraju, on stage.
Good afternoon, ladies and gentlemen. I think after a very animated discussion between a clinical executioner and a passionate banker, I think my lecture would be a little boring. I am the single person, there is no one to spare here. Now, distinguished guests from the BFSI, banks and financial institutions, and esteemed members of the industry, ladies and gentlemen. Let me thank Financial Express for inviting me. And it is a singular pleasure for me to address this distinguished gathering on a topic that is dear to all of us, Viksit Bharat, and challenges and opportunities. Now, I also would like to recognize and congratulate Financial Express for organizing BFSI Summit every year for the last 4 years on different topics. I think this is extremely important for the sector where both policymakers, industry experts, professionals would gather together and exchange ideas so that we'll be able to understand, better appreciate the scenarios and draw up our own plans to take the country forward. So it is very appreciable work the Financial Express is doing. Now, since I was supposed to make a few comments on the beginning so that I will be able to speak. I think all of you are today, I think know, for the past decade, India has undergone major economic change. I think whether we accept it or not, I think we can't ignore the transformational changes the country is undergoing. And let me also tell you, those of us, I think, which we have seen this dramatic transformation, after maybe 15, 20 years later, these actually will pale before what we are going to have in the country. Given the scale and the impact it is going to have is unimaginable. Now, despite global uncertainties, I think all of you are aware, we have so many challenges. One is, of course, geopolitical tensions, rising trade protectionism, and everybody is scrambling how to protect their own exports and impose the tariff restrictions on the imports, inward-looking policies, and most importantly, policy uncertainty. Despite these challenges, we are still doing well. And somehow, someone who has handled these matters, actually I feel confident that these uncertainties provide us great opportunity for India. And both in the economic front, geopolitical front, and capital front, when we look at it, it's a great opportunity for all of us, for the country, if in case we pay deftly, our stock will go up, which we actually, the country is currently doing. You know, I think all of you know, India was ranked 10th largest economy in 2014. Now, now this year, coming to 2024, last year, we became almost 4 trillion. And we went past England. This year, we are likely to go past Japan. While, let me also think, what happens actually, we did, I remember a long time ago, we did some scenarios. What happens in 2075 actually? Which are the countries will be a lot of strength, and who will be the formidable powers? I remember those studies. In fact, these 3 countries will remain. I think all of you know. China, America, and India. China will be the number 1 by 2075, with all indications. And the competition then actually remains between US and India. We are very close. Despite US having less population, aging population, we still can't actually, we're just reaching there. The competition is between 2 of us. So it is not easy to go there, I think. Because given our size, the sheer number of population, and the scale, both consumption and demand, a country of this size has to grow. There is no other way, simply. But we have to get it right. What is most important is that we have to get it right. Now, NVIDIA is, I think, somebody is saying, is 4 trillion. But that is the other important factor I want to mention. Yes, the company may be 4 trillion, but it's also important to have equity. That is very important, and social cohesion. Now, with a large number of population growing, having money, we ensure that the wealth is distributed. I'm a great fan of Japan since beginning. When I started handling as a director Japan division and South Korea. Look at Japan, despite being a developed country for so many years, the number of billionaires are very limited. Wealth is distributed. We hardly find very poor people. But India, look at it, you have the poorest person, I think, maybe here, and the richest persons also, top 10 richest persons also here. I think we also should be mindful of how we are going. That is very important for the country and the stability of the country. Now, coming to the, now India has taken a large number of steps. I think we have taken very well coordinated fiscal and monetary policies in combination with the structural reforms, which has actually helped us build current climate. Now, we not only kept our house in order, standing strong against overlapping global shocks, but we have also strengthened our macroeconomic fundamentals and expanded our safety buffers. Today, the balance sheets of both our banks and corporates are among the healthiest they have been in years, supported by falling non-performing assets and robust capital adequacy. I think in this quarter also, NPAs have declined in the PSBs, all public sector banks, and our profits have also increased. And capital, our CR has increased, most of the banks in the last 1 year. And with SBI rising this year, 25,000 crores, and we are very well placed. Thanks to, I think largely, these are all actually thanks to the prudent regulations and sustained profit growth and the support of the government. Meanwhile, the government's ambitious public investment drive has created fertile ground for a private sector resurgence. Capital expenditure, including private investment, surged 5.7 times from 50,000 crore in 2013-14 to 3 lakh crore in 23-24. Increased capital expenditure and infrastructure, coupled with the deeper corporate balance sheets, has laid the foundation for a lasting revival in investment. We are very hopeful that our investment will be robust and the demand also will grow. Our external sector inspires confidence as we are reaping export opportunities in the services sector. Our current account deficit remains eminently manageable, and we have bolstered our forex reserves with a 10+ months of import cover to deal with any potential adverse eventualities. India's vast domestic consumption base, which accounts for roughly 40% of our GDP, acts as a powerful buffer that shields the economy from global downturns. India enjoys a democratic dividend that continues to fuel economic growth, with nearly 68% of Indians falling within the working age group. Today, India has become the new global growth engine with its young demography, improved physical and digital infrastructure, and above all, an enabling policy environment. All of these developments have created a conducive environment for reaching the mission of Viksit Bharat 2047. This mission, in fact, includes 3-4 major goals. India's GDP to be $30 trillion, US3 daily, per capita income between 18 to 20,000 from the current 2,700. To enable us to achieve this, it is estimated the bank credit to private non-financial sector should reach around 130% of GDP from the current level of 56%. This is one area, I think, where the country has to do very well. The bank credit to non-financial sector has to increase. Banking will play a pivotal role in driving India's ambition of becoming $30 trillion economy. Banks remain India's primary source of funding, especially for sectors critical to economic transformation, especially infrastructure, MSME, healthcare, and agriculture. Banks anchor inclusive growth by bringing the unbanked under formal financial systems, enabling millions through schemes like PMJDY, PM Suraksha Bhima Yojana, PM Jivan Jyoti Bhima Yojana, and SHG bank linkage program. Given how vital a strong banking system is to drive economic growth, it is imperative to tackle sectoral constraints promptly so that banks can truly power India's Viksit Bharat mission. This requires banks to deliver on certain structural themes like reimagining deposit mobilization, tackling rising leverage and asset quality pressures, increasing productivity, deepening digital and data-led capabilities, building future readiness in terms of ESG, resilience, and governance. By advancing these strategic themes, Indian banks can actually transform into stronger institutions. At the top of that list is need for a robust capital base. Indian banks must raise substantial amounts of capital to support the country's growth ambitions. IMF research shows that better capitalized banks borrow more cheaply, raise more funds, and can support credit expansion. Therefore, access to capital from all sources need to be looked at and to be worked upon by all of us. I also feel we need multiple globally competitive large banks, facilitating global access to global funds, best talent, and technical expertise. Currently, only 2 Indian banks, SBI and HDFC, feature in the top 100 global banks by total assets only, which is not enough comparison to banks from China as well as US. To meet this challenge, banks and financial institutions need to explore and expand avenues of raising capital, including conventional equity markets, bond issuances such as Basel III compliant AT1 and Tier 2 instruments, and exploring innovative tools like extending operations to global financial hubs, utilizing green bonds and sustainability-linked loans, and also foreign debt markets to fund domestic credit expansion. Large incumbent banks should be laser-focused on capital conservation by reducing operational costs. We're still one of the countries with huge costs of intermediation in the banking industry. Emerging technologies such as Gen AI, cloud computing, etc. hold immense potential to drive efficiency across the industry, improve regulatory compliances, ensure higher quality of services, and enhance security measures. We also actually need to look at reviewing the current FDI rules in banking sector to enable Indian banks raise more capital, so more patient capital, in fact. Universal financial inclusion is another challenge that I see that to be addressed on our path to develop the economy. Banks need to create opportunities for every individual to grow and contribute to the nation's progress. This involves innovating and reimagining bank strategies to align with the evolving needs and preferences of customers. Customer care, customer grievances should be the #1 priority for any financial sector institutions. RBI's Financial Inclusion Index score, an indicator of financial inclusion, shown that it has increased from 64.2 in March 2024 to 67 in March 2025, reflecting steady progress in access, usage, and quality of financial services. PM Jan Dhan Yojana has seen opening of around 55.83 crore accounts, which has created a conducive environment for achieving the objectives of banking the unbanked. However, a lot needs to be done for achieving the aim of a fully protected society through universal insurance and pension coverage. We need to work on developing more simplified micro-investment products. The need for this can be seen from the facts like India's share in global premium is about 2%. Production gap in India is 87%. Given very low insurance penetration of only 3.7% in FY 23-24, against a global average of 7%, financial institutions need to support the people to access the social security net for the masses by financial literacy and product customization. I'm also happy to inform that DFS has recently launched a nationwide saturation campaign to bolster the outreach of flagship schemes like PMJDY, PM Jan Suraksha schemes, and also e-KYC initiatives. Initiatives such as these are actually cornerstone for empowering economically and socially marginalized communities by facilitating equitable access to formal financial services. These initiatives are designed to bring unbanked individuals into the ambit of mainstream banking, thereby reinforcing inclusive and sustainable economic development. Universal credit coverage for MSMEs and agriculture and a focus on export growth are actually important pillars going forward. In the last budget also, Government of India has announced, identified 4 engines of growth, which are agriculture, MSMEs, exports, apart from investments. Given the MSMEs sector's contribution to India's GDP at 30%, 40% to exports, and 62% to employment, we need to have a robust credit flow to the MSME sector and enabling the access to credit for the agriculture sector and supporting entrepreneurship and generation of employment. The MSME segment used to traditionally rely on heavily on informal financing, but in the recent past, because of the government efforts, now it has become much more formalized. This year, we have actually seen credit flow to MSME sector grow. This quarter also actually showing. And we also launched, some of you are aware, this new credit assessment model, whereby the public sector banks provide credit to the MSMEs based on the digital presence, both consumption and demand. Now, the adoption of present, in fact, technology is very, very important. Innovation, so that we will have a more innovative innovation and advancing digital capabilities and also for future competencies. These are essential. And then forging organic partnerships is very, very important. NBFCs, last time we had, only this month we had a summit in Delhi. And also we had another summit with the fintechs. We want to have a closer relationship between banks, NBFCs, and fintechs so that all three can actually grow together. And leveraging DPIs, again, this is one of the important things. We are doing very well. I think all of you are aware. Now, UPI is live in 7 countries, and we do more, on almost 52% of the total UPI transactions in India. And everybody appreciate the way the digital public infrastructure has been built by country and also utilized. And in fact, it has brought a lot of empowerment to the rural and impoverished communities. And we continue to actually take serious interest on strengthening the DPI in the country. The other challenges I actually see is, of course, the climate change and also finance for risk mitigation. The financial sector need to be aware of these 2 risks and accordingly design their own policies and take into account the ESG policies that the Western world adopts so that we will not be taken by shock. The other thing, which is actually important for the banks, I keep talking to them, is the changing profile of the bank customers. The new generation G, I think we need to be adopting. And we need to educate them because these are young people, they're very confident of future. Therefore, they don't see much rationale for savings or having financial security. They are not actually saving. Everybody who are actually earning the good amount, they always want to spend money. One way that is very good for the economy, the more we spend for the economy, the better that is. But still, we need to also have savings, I think. And so therefore, the banks need to come up with products that tailor to the needs of the young generation so that they are lured to the banking. In conclusion, I would like to state that in view of the fast-paced developments and related concerns in the financial sector, like quicker response to the tech-based regulations, the banking sector is faced with a unique challenge. It has to incur higher operational and compliance costs, including the technology-based security infrastructure, in the near term, while continuing to raise and deploy capital at a sustainable and prudent manner to bring about the intended growth in the economy. I would also like to reiterate that institutional confidence and stability of the Indian banks will attract long-term foreign capital, supporting infrastructure, manufacturing, fintech, and climate investments. To sum up, despite certain challenges, Indian banking is well placed to explore the opportunities and also to support for the accelerated growth for a Viksit Bharat 2047. And I also hope that events like these, like in the past, facilitate thought-provoking dialogue through expert-led sessions tailored to discuss today's challenges, trends, and best practices. It should help us to understand the real-world sector issues, generating actionable solutions through constructive collaborations with the government, regulators, to balance innovation, compliance, and consumer safeguard. I know that we are all aware that we have many challenges, not just financial sector, but other sectors. And we have to do many more things, and we have to do many more things in a large scale. But these are all very formidable, and in fact, personally, I believe that India's future is very bright, and we are actually capable bunch of people. And we have faced many challenges in the past. Despite that, we remain strong, really robust, and very united, and we will remain so. Now, I actually feel that the story has just begun. I think the younger generation who are now, they will actually feel the strength of India going forward. Let me once again thank Financial Express for inviting me and for allowing me a chance to interact with you. Thank you very much.
Thank you. So I would request you to stay back on stage, and I'd like to invite Shobhana Subramanian, the Deputy Managing Editor of Financial Express, for some quick Q&A.
No, that was wonderful, and you've given me 3 questions, which I had also planned to ask. So let's start with, probably one of the biggest problems today in the banking sector. You said that they have to reimagine deposits. But reimagining deposits is easier said than done. Yeah. At the end of the day, the saver or the customer wants returns. In this context, at least temporarily, do you think there is room for a tax break on deposits?
This has been one of the perennial demands of the bankers for tax breaks on the bank deposits. We can't see. Last year it was not there. So I think next year what happens, we don't know. So I don't want to hazard any guess. But the point I've been making to the banks, I can tell you, if you look at the Western banking models, the deposits is not the key factor for their growth. Currently, they raise funds through different methods and then lend it. Now, bank like, let's say, JP Morgan or Bank of America, how do they raise funds? In fact, they can raise funds billions of dollars in a day due to their balance sheets and also the trust. Somebody mentioned there, entire banking system works on the basis of trust. They need to have trust that when the bank asks for funds and it is able to pay back whenever is required, need is there. We need to go, the banks should raise funds from the market at a very competitive rate. They should be, if there is a lot of trust, they should be able to raise at a lot more cheaper and then lend it.
But that would be capital, sir. They will raise equity from the market. That will be capital. But to lend, you need a deposit base.
We can also issue bonds. When the raising means, we can also issue the bonds. We have issued infrastructure bonds here. This year, we are trying to do some bonds. It didn't happen. But we plan to do. See, ultimately...
Retail bonds?
Yeah.
Retail bonds?
Yeah. All kinds of bonds.
Oh, really? With a tax break or no?
No, that we are not decided. But see, it is one form of raising funds.
No, I agree. No, the reason I ask is that you're saying the banks are making great profits. If you look at the Q1 results, all the profits have come from treasury. If you look at loan growth, it is 7%, 8%, 9%. I think one bank has crossed 10%. So they're not making money from their core operations. One reason is their margins are coming down. You see, I'll tell you where the problem is. This is leading to disintermediation. Mr. Parekh spoke of it. And why this time around it's a worry is that people will not stop putting money into the stock market. You can look at 10-year data, but the times today and 10 years ago are completely different, as is the state of the corporate bond market and the CP market. So how are banks going to lend?
See, I see the core, let me put it this way. The treasury operations is also part of the banking operations. We can't divide the banking operations into boxes. As long as the banks are able to receive deposits and pay back and make profits, that's a good model. Now, some banks, let me put it this way, the drivers of profit in some of the banks actually differ. Most banks differ. I'm talking about the public sector banks. Let's say the private sector banks, their lending operations are mostly into retail. Cars, homes, temporary loans, all kinds of these things. Whereas we, in the PSB, public sector banks, we also lend to infrastructure. We actually do a lot of corporate lending. Of course, we also do financial inclusion lending, large number of schemes. And despite that, if you look at it, our books are growing and the banks are making profits. Now, as long as the profits are there, the investor should be happy.
No, the core lending of the bank has to be, from where the profits come. You cannot, because treasury profits are not regular. If the bond yield goes down or up, it will change the treasury profit. When a bank chairman, again, public sector bank, publicly says there is a mismatch in pricing expectations of corporates and banks, that tells me that they are very reluctant to lend to corporates. And this is a public sector bank chairman who has gone on the record in our paper. So it tells me that A, they have become extremely risk averse. They don't want to lend to anyone below AA maybe, or AA plus. So, and that is why you see that credit growth has contracted even to the NBFC sector where it is negative.
Yeah, this credit growth is a little slower this quarter, but we want credit growth, we are expecting credit growth will pick up. And we also want the banks to lend. And, banks, each bank, all the banks have their own policies of lending. They take the call. Now, we have been advising the banks that corporate lending, in fact, corporate, Mr. Parekh has mentioned one point. If you look at the corporate profits last year, many of the big corporates have huge cash flows. And in fact, they are not actually seeking...
Exactly. 13.5 lakh crore is the total cash balance of India Inc. at the end of March. That's exactly my point. The big corporates don't want bank money. The banks don't want to lend to corporates below AAA, AA, because either there's a price mismatch, as your public sector bank has said publicly, or they are too risk averse. So, and you mentioned, that's why I'm asking, because MSME lending, etc., you wanted. And NBFC lending has actually contracted. So, where is the lending going to come from?
No, see, we wanted MSME lending to go up. We have also credit guarantee for the MSME lending. And we are also coming up with some more scheme for the MSME.
What scheme, sir?
The same, basically increasing the limit of lending from 2 crore to 10 crore. It's under the works, we will get it done.
This is under ELCGS?
Yeah, under non, this is the old one.
Okay.
This is CGTMSE. Okay. And, but we want MSME sector to thrive. And we are coming up, one is digital we have launched, only unless in the past where they have to submit the bulky papers. Now the MSME sector actually provide, based on the digital footprint, we can actually sanction loans. We did, last 3-4 months, we sanctioned a huge number of loans to the MSME sector. Now, banks will look for security. Banks doesn't print their own currency. Banks deposits are the money put into there by people like you and me. And the money has to be given back. They can't take risk with the depositors' money. Naturally, they will be very prudent. Because of that only, our both gross NPAs and net NPAs have declined continuously. Not that actually they have compromised too much on caution. In fact, they are very cautious, but still they have been lending. It all depends on how the demand picks up.
They're too cautious. You chaired a meeting of ULI last week. There was a report in the paper. And ULI, for all the fanfare, has not taken off at all. You were present at the meeting at which all the banks were.
Yeah, you're right. It has not taken off. That's why I have chaired the meeting. Last 1 month, I have chaired 2 meetings. One with all the state governments, all the chief secretaries, and the one with all the central government departments. The other is with all the banks, fintechs, and the RBI. So therefore, you can understand we want the ULA also to pick up. It takes time, but I think I'm now confident that with the number of data sets we have in the place for ULI will pick up.
Yeah, so you also spoke of how we need big banks. You pointed out that SBI and HDFC Bank are the only 2 top banks in the top 100. So is the next round of consolidation of banks overdue?
No. See, the point is, as the country is growing, the banks also have become bigger. HDFC has become bigger, and ICICI has become. And similarly, SBI is very big now. In the previous consolidation, if you see our results now, Bank of Baroda is a mid-sized bank now, and Punjab National Bank, also mid-sized bank. But we would see wherever the synergies are there, we can always look at it.
Is it due, if not overdue?
I don't know. I can't answer now.
You also spoke of foreign capital, which is what I want to ask you. So is there going to be a relook at the 15% hard stop on FDI in banks?
No, see, the point is, the capital, banks require capital for lending. This is given. The capital either comes domestically or from abroad. If the foreign capital comes at a cheaper rate, I think we should welcome. Now, currently it is 15%. And if it can be more, and the banks will have better capital, and also FDI is better. And we'll be able to expand our credit. That's the goal.
So you think the government is serious about raising this 15% FDI limit in banks?
No decision taken like this. But basically, as a policy thing, one can actually look at how best we can do.
No, so is the thinking in favor of raising the cap?
No, there is no thinking now. There is no thinking now. This is the policy. As a policy, one can always think about it.
The 100% FDI in insurance, it doesn't find a listing. It was supposed to come in this parliament session.
This parliament session is not listed. Hopefully, I think next parliament session it will come. We are hopeful.
Okay. You also made a very good point on how Indian banks, the costs of operations are very high. Very true. If you compare globally, we are no. But the government doesn't want to quote unquote, help them or subsidize them on UPI. Now, the banks incur big losses every time a UPI transaction, and you also mentioned Gen Z. Now, you ask any banker, he will tell you that they will do 20 transactions a day. On every transaction, the bank loses 5 rupees, and they don't save, so you're not getting any CASA, neither are you getting any deposit. But the government doesn't want to, put a charge on it so that the banks can make some money. So how do you expect them to operate?
Right. See, I don't expect a bank to make profits at every operation they do. No, that is a very bad economic philosophy. If there is a conglomerate, conglomerates make the profitability as a corporate, not every operation they do. Now, banks are doing well. When banks were given UPI, the number, you imagine the number of customers we have given to them and how it leads to their own credit growth.
Number of credit, it doesn't lead to credit growth because the majority of the customers, like you yourself said, the Gen Z customers, they don't do any credit transaction.
Oh, no. I think we are looking at only metropolis. The Jandan accounts, who are actually use UPI, they're all potential credit needy people. In fact, large number of people in the rural areas and semi-urban areas who use UPI. But I have seen, if you go to any small town, small village also, people are actually use UPI to pay for the sabji, tea, chai, coffee and everything. In small restaurants, people pay. And these are all actually, how did the country grow so fast in the last 5-6 years? If not, one of the key reasons was bringing formalization of this economy. UPI has played a great role. I think we need to recognize that. Now, if the banks wants to make money at every transaction they make, I think that is a bad banking philosophy.
So they won't take credit risk, but they will be forced to pay for UPI and then they will make profits also.
I don't want to say anything, because as someone in charge of the public sector banks, I don't think, some activities we make profit. This is how the corporate outlook has to be. Now, every operation they are not expected to. For acquiring a customer, they spend money. Now, if the banks think that they will want to make money, they want to make profit for acquiring a customer, no, they can't. Okay. You need to spend.
Okay. So just to go back to the disintermediation, is the government really worried? Because if you see in Q1, let's take the June data, actually 1 whole percentage point of credit growth has shifted to the money markets. So, and because, like I said, the times are not what they were 3 years ago and 5 years ago, the entire actually landscape has changed on how companies are borrowing, on how customers are saving. So, I mean, to me, this is really the beginning of a very structural change in which banks will lose business.
I'm not share with your thoughts on this. One has to recognize the world is changing and India also, of course, changing. Disintermediation is happening faster way than we thought. And now if you look at it dispassionately, is it good for the citizen? Ultimately, institutions are there. But ultimately, whether is it good for the citizen or not, that should be the barometer to judge a policy is working well for the country or not. Now, if you look at it, because of disintermediation, the fintechs and everything, NBFCs, much more financial inclusion in the country has happened than in the past. That is a fact. Now, money markets, yes, it is all, my sense is, it's not structural at this point of time.
Okay, and is the government in favor of allowing big conglomerates, corporate houses to get banking licenses?
I think the policy is already laid down. So there is no proposal at this point of time to review anything.
And RRBs have all been merged. Yeah, so what is the next step there? What is the government's thinking on how this RRBs will work?
No, you see, RRBs we have merged from 1st of May, 1st of May. And we just consolidated. Now we have 28 RRBs. So technology-wise, we integrated by September. And most RRBs now actually are profitable. We want RRBs to be very vibrant local institutions providing credit, access to credit as well as deposits to the rural population in the country. And some of the RRBs are very big. In fact, UP Grameen Bank, Rajasthan Grameen Bank, Andhra Pradesh Grameen Bank, Gujarat Grameen Bank, as big as some of these small finance banks. Now we want to strengthen that. And we want to strengthen that, I think maybe, and once we strengthen, we will take a look at it, how we actually, what we to do with this RRBs.
And the merger of the non-life insurance companies, public sector, that has also been on the cards. So how's?
No, that's not. There's a proposal in the bill. Once the act is passed, then it happens.
Okay. Thank you very much. That was really interesting.
Thank you.
Thank you so much
Thank you very much.
being here and answering.
Thank you very much.
She's trying to put me in trouble, actually.
No, sir. Not at all.
Yeah. And I'd just request you to stay back on stage for just a minute more. Thank you so much for the session. I'd like to invite Anand Goenka to hand over a token of appreciation on behalf of Financial Express. Shobna, ma'am, you can. Something for your office. Thank you so much to Mr. M. Nagaraju. And I know, everybody is working up an appetite right now, whether it's a risk appetite or an appetite for lunch. But I just ask you to bear with me for a little more time, because the next session, believe me, is going to be even more fire in the belly. So as the next session that we have is called Full of Guilt, Global Capital Allocations for the Bright Spot on the Planet. As the panel name suggests, if India is the bright spot globally and one of the fastest growing large economies, this panel will look at ways to ensure continued attraction of India and options to deepen the capital pool the country needs for it to fund its growth aspirations. We heard the last two panels talking about taking more risk and becoming a country of investors rather than a country of savers. I think this panel will take that discussion forward. We have, and I'd like to invite the speakers on stage in alphabetical order. Ms. Aparna Tyagarajan, the Chief General Manager of SEBI. Mr. V. Lakshmikant, Managing Director, Mr. Nilesh Shah, Group President and Managing Director, Kotak Mahindra Asset Management Company, who needs no introduction. And Ms. Soumya Rajan, Founder and Chief Executive Officer of Waterfield Advisors. And moderating the session will be Kumar Sharma, Senior Deputy Editor for Financial Express Digital. Kumar, your panel.
With such experts, Roshan, it's very difficult without our papers. Yeah. Thank you so much. Again, really incredible that we have a lineup of speakers like this from Aparna on the extreme end here, from SEBI, Mr. Lakshmikant, as VC who's actually spent enough time in US and comes back fresh from there, telling us in terms of how the world, especially the most important country on the planet, is looking at India. Nilesh Shaji, I think there's so much to know in terms of how we can actually get poor people more funds, deepen our capital pool, as it were. And Ms. Soumya Rajan, of course, I think how the high net worth individuals can actually now rise up to the occasion, whether they want to or how they are actually, what is attracting them about India and all of that. So first, a huge round of applause for them. It will really. Thank you. Ms. Aparna, if I can start with you in terms of the AIFs and FPIs, which you look at in a bit more closely. How important are they in this journey? We've talked that there is need for capital and all of that. If you can just begin with your thoughts there.
Sure. Thank you, Mr. Sharma. Good afternoon, everyone. Good afternoon and hello to my fellow panelists and to the audience. Very glad to be here, and thank you to FE for having us on here. Let me just set the context in terms of what we do as regulators in this whole journey of sustainable capital formation, and how do we plug in the entire scheme of things in terms of attracting capital flows to our markets, India specifically as a region, which is definitely something which is being largely on the say occupying central space. From an alternative investment funds perspective, we definitely look at this as a very critical product, which is something which will help channel funds, particularly from investors who have the risk appetite to take towards projects which are largely underserved by traditional financing avenues. So, right from channeling money to long-term gestation projects like infrastructure or startups, unlisted startups, which don't really attract so much of traditional, bank or NBFC financing, or things like long-term debt papers, which are not, we spoke about in the previous session. We had a discussion about banks lending moving towards not adequately moving towards corporates which are not so well rated. So things like you do want the full yield curve to be developed even for papers which are not so rated. How do those companies have access to finance? So these are all questions that we ask ourselves as we do about our work. So I think AIFs play that significant role in fostering innovation, in ensuring that startups get that capital which is much required at the early stage of their life cycle, and how we can really both domestic institutional capital and in terms of foreign capital. How do we really channel these funds from investors who have the ability to take these risks and move them towards a product which is again well suited in terms of the risk appetite of the product as well the risk propensity of the product itself? How do we really find the right match? So that is something which we ask all the time. So that is how I would say.
Yeah, very important. I think I'll come back to you on this actually. And two subsets to this is actually AIFs, domestic AIFs. What is being done on that front to encourage them? And what's the kind of fund universe you're looking at? Because of these steps, let's say a year or two from now, what kind of funds are we talking of here? That will give us a sense of that. I'll come back to that if you want. Mr. Lakshmikant, you're just back from US. We were discussing these points earlier. There is India really the bright spot? It is, of course, as many say. So how do we then sustain that as a bright spot?
Thanks, Kumar, for having me on this panel. Good afternoon, everybody, and pleasure to be here. Very esteemed panel. I look forward to the learnings. Actually, Gopal Srinivasan talked a lot about the IF, so very little left for me. But I wanted to bring a slightly different perspective. And primarily because of some of the conversations. Okay, as background, I run a $100 million VC fund, pretty much domestic capital, most of it. We invest in Series A, Series B kind of companies, enterprise technology. I'm an incidental investment manager. I spent about 40 plus years in the technology side of the house before I became a manager. So I was, part of my, fund to kind of a roadshow, so to speak, was abroad and spent a lot of time both in the New York area, Boston area, and the Silicon Valley. And a couple of things I just wanted to highlight out here. One was the fact that the India consumer story, in my opinion, is oversold, meaning that everywhere you go, 140 million, 140 crore people, this is the market, this is growing by, so everybody kind of knows that story. So anybody you go, it's like beyond that, what is there. So that is the kind of conversations that we had. So in that context, I just want to share a little bit of history. When we used to go and sell software services in the 80s, we had to show a world map and show where India was in that world map. Okay. I mean, now you don't have to do that. So brand of India has significantly changed. Brand of India is still probably 50 years ago, people would talk of India, then they would talk of, apart from the poverty and stuff like that, Mahatma Gandhi. Then after that, it was Mahatma Gandhi and yoga. You would see yoga and spirituality. And then maybe 20 years ago, it was Mahatma Gandhi yoga, and then the BPO industry or the India is still known as the back office. So after my first conversations, I wanted to change the track. I wanted to ask people, apart from the consumer story, what else would you think of, recall, that comes to you from India? So believe me or not, there were essentially a couple of sectors which came. I probably had about 40, 50 conversations, which top-notch people. Two sectors, one was space tech. Okay, space tech probably because of the fact of the Indian Mars mission and India's mission to the south side of the moon. So space tech was on top of mind, meaning that people believe that space tech. Second was obviously life sciences and biology. Okay. So it got me thinking that apart from the regular investments that we look, and we look at deep tech investments, it's important for us to build a brand around few areas. Okay. While investments are there and we talk about the fact there's enough money in the country, but if you want to play the game in terms of frontier technology or deep tech, having a great brand in 1-2 areas and building around that brand is extremely important. So I believe that, space tech is one of the areas, bioscience is one of the areas, and building some investment theses around these areas, around this brand, is what's going to be important.
Okay, though I think from a VC perspective, the exit might take time in both these sectors. So maybe I think, we'll come back on that.
Yeah, I can kind of react to that in interest. So I think the models have changed. I'll tell you what has changed significantly. A lot of the models probably 15, 20 years was what we talked as asset-light model. Because of the SaaS industry, everybody said that there's no capex required. Everything goes to the bottom line. So, but today, if you look at the high-tech industry, especially the AI industry, if you want to compete at foundational level AI, you need high capex investments. Okay. And so that is still, from a mindset perspective, from the Indian VC mindset perspective, Indian investors mindset perspective, anything which is capital heavy, let's say you want to do space tech, advanced materials, and it's going to be capex heavy. So, and obviously cycles will be longer. So the thinking and the openness needs to, and more importantly, everybody wants the security of an FD with the returns of a VC. So.
Okay, Nileshji, this point you mentioned actually in many interviews you've said about if other countries do this self-goal, then maybe, we have some advantage as well. Other than that, how do we ensure that, the net sellers, the net buyers in China and Taiwan and others actually come to India? How do we build on that? And domestic capital also, how do we, the kind of investment that we are having, how do we get people to shift from gold or whatever? And some thoughts there, how that can be looked at.
So thank you, Financial Express, for having me over here. The first and foremost for any business is talent. Not many people would have heard about Professor Arogyaswamy Paul Raj. Born in Coimbatore, worked in Indian Navy for 2.5 decades, created India's first sonar system, which even today we use. In the late 80s, he set up 3 labs in India, one for artificial intelligence, one for military intelligence, and one for deep tech. In 5 years, he was frustrated and left India. Joined Stanford as a student. In 2 years, became professor. Invented what is known as MIMO technology, multiple input, multiple output. It laid the foundation for today's 4G, 5G, and LTE technology. If we keep on throwing talent like this, how will we be able to build anything? Today, for our 4G, 5G, LTE, we are dependent upon global companies. But do remember, it was a talent which India gave. Fast forward to China, 6 times bigger than us. What did they do? There was a gentleman called Kai-Fu Lee, a Taiwanese. Like for us, it is Pakistan. For China, it is Taiwan. Moved to US, worked in deep tech, became American citizen. China brought him back. And today he's considered one of the movers for China's artificial intelligence. When China needed, they could attract talent, even if it is Taiwanese or American. And well, whom did Kai-Fu Lee studied? Well, he studied under Raj Reddy, the first Asian who got Turing Award, which is Nobel Prize for Computing. So first and foremost, Mr. Sharma, we have to respect our talent. We have to nurture our talent. If you keep on sending Raj Reddy abroad, Arogyaswamy Paul Raj abroad, they will benefit other countries, not India. The second is mindset of us. Today, US is a developed nation, India is developing. Why? It is because of people like us. US was in Great Depression. In those days, dollar was supported by gold, backed by gold standard. To come out of depression, they needed dollars, and to print dollars, they needed gold. How did they break the logjam? In 1933, Franklin Roosevelt, the then president, signed an executive order and nationalized American gold. American women were not marrying Mangal Sutra, but American males were wearing rings, and it got nationalized, and everyone gave it up. Either it was because of patriotism or because of $10,000 penalty in those days. Whichever way, US got the gold, and that's why US Fed is sitting on 8,000 tons of gold. That's why you could got Die Hard kind of movie. What we have done, 1962 war with China, we didn't have enough money to provide shoes to our soldiers in Himalayan mountains. 1965, another war with Pakistan, same situation. And what were Indians doing? They were using precious foreign exchange to buy gold. As Navneet mentioned, we were getting under PL 480 a shipload of red wheat on humanitarian ground, unfit for human consumption, and yet Indians were buying gold. Morarji Desai, the then finance minister, came with Gold Control Act. Did it nationalize the gold? Answer is no. He just requested Indians, please don't buy more gold than certain limit. And we said, government ka kaam hai law banana, hamara kaam hai todna. We converted entire gold market into gold smuggling and black economy. All of us contributed in violating our own regulation. Kumar bhai, ye mindset change karna padega. We want government to do everything, but as citizens, what can we do? We have to look. Third and final thing is rule of law. It's not that in US there are no scams. In fact, the biggest scam, Bernie Madoff, everyone knows about it, $60 billion. वो तो हमसे बड़ा गुरु है. But not many people remember about a gentleman called Irving Picard. How many of you have heard his name? मेरे को भी याद नहीं रहता है, मैं भी लिख के आता हूँ. Irving Picard is the guy who went and recovered every single naya paisa of Bernie Madoff scam. Not even one American citizen lost money. If it meant taking inner wares of Bernie Madoff family, so be it. if it meant taking money from the widow and estate of deceased people whom Bernie Madoff had paid, so be it. Irving Picard went and recovered every single naya paisa. That is the rule of law. In India, scam 92 ban jata hai, serial hit ho jati hai, but 1992 security scam cases are still going on. There is no settlement. Unless until you have rule of law, how will investors get the confidence? So protect and nurture talent. As a citizen, be a responsible citizen. And judiciary and regulators should bring rule of law. If that happens, whatever you wish, Mr. Kumar, will happen.
That's really nice, interesting actually, because yes, some people say that, like for example, you mentioned about collections. One big area, maybe it's not within the realms of this discussion, but one big area where collections is still in India not digitally done. Bulk of it is actually physical. So, I mean, and in fact, they say in India, there's not a religion or a caste which divide is there. The real divide is digital, isn't it? So, I think so, yeah, there are lots of lessons to be learned from there. Samya, to you, in this scenario, when we discuss this point about the capital need and increasing the depth of the capital pool, how do you see the HNIs today? How are they pitching in? How is the profile of those wanting to enter? Because there are many who are in the next generation who may not necessarily be in the same space as well. They want to branch out, go into different areas and all of that. What's your take on this?
So thank you, Kumar, and thank you, Financial Express, for having me today, for me to join this very esteemed panel. I think what Nilesh has kind of spoken about is kind of makes you want to reflect a little bit more just in terms of how we as individuals, as citizens, really look at the whole journey towards finance, towards the 5 trillion economy. I'm afraid I'm going to be a little bit more data-driven and speak a little bit more about how we're seeing the ultra HNI and the high net worth individuals kind of participate in this growth. Two comments really from my side there. The first is really around the surge that we've seen around how they participate through private markets. This is a little bit about what Aparna was alluding to and how she's creating the regulatory framework there. But clearly what we're seeing is that in the last 5 years, you've had a 5x kind of growth in the AIFs. Today, they're close to about 130 billion of AUM, which are in AIFs. And this has really happened because you've actually seen a huge surge in the wealth base. So ultra high net worth families today are close to about 13,000. That's going to rise by about 50% in the next 3 years. The high net worth community, which we define as people having more than $10 million, is going to increase by another 20%. And we're going to see that they're going to be close to about 125,000. Now, these are all households and individuals who are seeking a place for investing their money. Keeping in mind, of course, how has India evolved in these last 75 years? We've really become an economy which was a scarcity economy to one which is now an investing economy. You can see the difference in the generations in terms of how a Gen X and a baby boomer looked at wealth preservation as compared to what we see today as the millennials who are really looking at performance-driven strategies. So it's very different in terms of their outlook. The AIF space has really been where they've been able to look at powering the environmental, the entrepreneurial ecosystem, which to a certain extent even Lakshmi Kant even spoke about. So I think that's something we're going to continue to see. One interesting fact about this whole AIF area as well is that there was a conversation earlier in an earlier panel about bank credit actually slowing down. One of the areas we see in AIF growth is actually private credit. So what is today maybe 2 or 5% of client portfolios, we think in the next 3 years is going to be as high as maybe 20% in terms of the AIF allocations that they have. So in some ways, a little bit of the shift away from the bank credit, but it is coming in through the kind of credit that you can see through different fund structures which are actually there. So that's one comment in terms of how UHNIs and HNIs are participating, which is really supporting the private credit, the private market space, both in terms of credit as well as in terms of equity. The other, still kind of green shoots, but which I think is also important because at the end of the day, in India, 1% of the population holds 40% of the wealth. If you take that number to 10% of the population, it holds 77% of the wealth. Now, we are in a country which is extremely unequal in the way wealth is distributed. But if we want to power ahead towards being that 5 trillion, 10 trillion economy, then we have to make sure it's also inclusive growth. I think there was a comment that was made by Mr. Nagaraju about Japan's economy and how one looked at having more inclusive wealth distribution, which was there. But to that extent, it means that the ones who are wealthy today, the ultra HNIs, need to also start giving back. And that giving back comes in the shape of strategic philanthropy. If you start looking at those numbers today, there's about $1 billion which has been given just as ultra high net worths have given, small today, but as I see us moving in terms of the mindset, I have a feeling that the ultra HNIs are going to play a role in terms of giving through strategic philanthropy. It's going to be important also around areas like education, health, skilling, climate action. And one of the reasons why I think it's also going to work is because about 30% of wealth is going to be in the hands of women by 2030. Women are naturally a little bit more inclined towards making sure that everyone else also succeeds rather than it just being singular in nature. So when I look at these factors around just the giving which is there from the ultra high net worth side, and when you also look at private social funding, which is about 16 billion right now and growing quite promisingly, I feel that the ultra HNI, the HNI is going to play a big role, both in terms of private markets, but also in terms of strategic philanthropy.
Great, I think, as they would say, raise equity for equity. So perhaps, that's the way to go. One thing which we did when I did the eConnect was we had a promise that we'll avoid abstract nouns and look in terms of one or two doable things. So if I could just go back again to you, Aparna, is that one or two things, and this will be the last round, one or two things that you think, that you would want to build on and continue, and one or two new elements that would have to come in. I'm looking in terms of, like, for example, supporting AIFs. We touched upon this earlier. I mean, how to build on that, how to ensure that we have the profile is towards long-term thinking, but at the same time, the guardrails are enough so that we don't have fly-by-night. So similarly like that, if you can, very briefly, if you can just get quick comments on 2 points to retain and 2 to include.
Sure, thanks. So maybe quickly what we have done as a macro structural reform perspective very recently is that India is probably the only market where we've gone entirely demat both on the unit side and the asset side, and that is something which we must be proud of as a jurisdiction. So, it was a very hard phase to implement. We did work around a lot of very, very bespoke structures and funds and investors who were not really on board. It was an exercise which was completely co-created between the regulator and the market participants. But we have achieved, over the past year and a half, with the cooperation of the industry, we've been able to do that. Certain other first principles from an AIF perspective that we have done is that you ensure that all the investors in the fund are treated equitable amongst each other vis-a-vis the investment, the commitment that they have made to the fund, and in terms of the treatment that they get from the fund manager. So these are all, I believe, structural or very, very foundational principles that have been established in the regulations from a private equity and credit perspective. So now that we have the building blocks done, now that we have the foundations in place, I feel it kind of gives SEBI also a regulatory comfort to see that, okay, now that we have these first principles established in the regulations, what can we do to make the life easier, to facilitate fundraising, and to kind of aim to balance ease of operations and ease of doing business while also containing any possible risks that could crop up from a regulator's perspective. One thing that certainly comes to my mind is, this entire framework that we are trying to do around accreditation as a process. So, accreditation is SEBI's way of independently assessing investors' risk sophistication. with an independent validation by SEBI accredited agencies who do the process for us. And therefore, we are in a place where we can ensure the right fit between the investor and the product as far as risk containment is concerned. So that is something which we certainly are looking at. So you would have seen the consultation paper that SEBI had put recently on easing the accreditation process. So we are, working with the industry participants to see how we can build a regime where, if you have AIF schemes which have only accredited investors, what are the measures that we can really do to ensure that, hey, these are big boys and girls, and we don't really need to, be very micro or prescriptive in terms of the requirements that we should have from a regulation perspective. So that is certainly on the cards. Few other things that, again, was in the news recently was the work that SEBI had done for fostering more capital raising by startups, and how do you really, give a fillip to the whole angel fund structure. So that is something which I think is very critical when you're talking about a $5 trillion economy. Certainly you can't do that without the base of the structure, which are these unlisted startups and innovators who do much need capital from institutions and other HNIs and family offices like Soumya was mentioning. So from this perspective, a host of measures have been done to see what we can do. So there's, for example, we saw that a lot of companies were actually raising funds through large web-based platforms. So SEBI worked with the industry and with the other government agencies to tweak the definition of, qualified institutional buyers for angel funds to see if we can really embed the concept of accreditation and see if we can really enable seamless offering and allotment to a large number of accredited investors through the angel fund mechanism. So that, I believe, will be a good step forward, to channel funds through the angels structure. Likewise, the second one that, again, I think will get operationalized very soon is this whole mechanism around co-investment as a product. So we do believe that this was, again, something which we had co-created with the industry, where we believe that through the AIF framework, even today, co-investment is permitted through a portfolio management route, but this as a part of the AIF framework offers that much more ease of operation, while also structuring this framework in such a way that it doesn't compromise on the first principles of, pro rata and pari passu of investors, and the whole, visibility and transparency that the regulator would require from a transaction perspective. If we are able to ensure that, I feel doing that within the AIF framework as what is currently being, conceptualized by SEBI and will go live very soon, that I feel will go a long way towards increased capital formation through AIFs.
Thanks. Mr. Lakshman.
Yeah, I'll probably give one in the interest of time maybe. So a couple of things. I think what's essentially happening in my opinion is that there's a lot of money chasing seed, early angel, a lot of money there, okay? Very little money on the right side, which is more like Series A, B, C, D, okay? And some funds have started to appear in that space where they invest at Series A, Series B. If you ask me, I think that should continue because that's a very important trend. But otherwise, while the number of funding rounds is very high in India, almost the same as the US, the quantum is very low, especially at early stages. So if you want to be serious about especially deep tech, you should be able to fund on the right. Okay, so I think that should definitely continue, and I think SEBI is definitely doing a lot of work in that space, and I think a lot more PE participation is also happening. So I think that should definitely continue. And what should not, I would borrow from what Nilesh says. I mean, as a customer, we don't pay. We don't want to pay for innovation. Okay. So we may want all the innovation in the world, but when time comes for you to pay for that innovation and write a check, you don't want to do it. And that's one of the reasons that most of the startups, they say, we'll build in India, but sell globally. Everybody is like, I'm building here, but I'll sell at 4x in the US or 5x in the US. So I think we need to understand innovation is key. Down the line, that's going to be the advantage. It's not, money is one part of it. But I think, especially on the technology side, it's moving slowly to a winner takes all kind of a model. If you are the first mover, and if you are very good, you take it all. So I think it's very important for as consumers and customers to be willing to pay for innovation. So.
Yes, your thoughts.
So as Peshwa Bajirao mentioned, hit the root and branches will fall. So I'll just focus on expanding the size and then things will fall in its place. The first and foremost is we have to stop the leaking bucket. SEBI itself says that about 100,000 crore retail investors, retail speculators lose in trading. 9 out of 10 people lose money, and yet 10 out of 10 people believe that they are in 1 out of 10 category. Between gaming and crypto, between Ponzi, the amount of savings which is lying wasted is tremendous. And education is not the solution. India's most literate state, Kerala, spends more money on buying lottery than what they have cumulatively invested into equity mutual funds. बेचारों को आज तक ये पता नहीं चला है कि लॉटरी के धंधे में बेचने वाला ही पैसा बनाता है. जिस दिन लेने वाले ने पैसा बनाना चालू कर दिया, बेचने वाला धंधा बंद कर देगा. So education is not the paneka. Wisdom is necessary. And we have to provide knowledge and wisdom so that this leaking bucket stops. The second, we have to encourage innovation. I talked about how our savings remain frozen in gold. We are like Kasturi Mrug, जो भागता रहता है कस्तूरी की तलाश में without realizing कि वो उसके पास है. We have gone all over the world to get foreign direct investment, foreign portfolio investment. But in last 25 years, on an average, we have imported 700 tons of gold net of jewelry exports and spent close to $500 billion, which is more than net foreign direct investment, which is more than net foreign portfolio investment. How do we stop this? We have to encourage innovation. When I was working in ICICI Prudential, we had created a product which would have given full upside participation in gold. And thanks to the buying of put option in global market, there will be no downside participation. We would have converted physical gold where both upside and downside was to the investor account, where people had to pay 25, 30, 40% transaction cost for buying gold. And there was no hallmarking where people didn't know what quality of gold they were buying. We would have launched a product thanks to buying of put options where downside will be protected and upside investors will have fully participated. Unfortunately, that product didn't see the light of the day. Even today, US has come with a genius act. Stable coin is launched. Why can't India think of stable coin? A coin which is backed by rupee. We get about $135 billion by way of remittance. It comes from bottom of the pyramid working in Middle East. It also comes from top of the pyramid working in US. What we don't remember, there is about 3 to 4% transaction cost on transfer of money. Through stable coin, if I can shift entire remittance from someone else's pipe onto a pipe controlled by India, on that $135 billion, even if you assume 3%, that's about $4 billion of saving. Imagine government of India whose debt to GDP, state, central, local put together is about 80%, and we pay 7% interest. Effectively, 5.6% of our GDP goes by way of interest. You launch stable coin, there will be zero interest cost. You will be able to raise debt without paying interest, which is why it is called Genius Act. We were not the first one to launch, but can we copy idea? It will help us save money on transaction, on remittance, and it will reduce borrowing cost for the government. Government of India, which is rated just above investment grade by rating agencies, will borrow at the same rate as Japanese government is borrowing today. We need to encourage innovation. SEBI has done a fantastic job. All our regulators have done a great job. But where we need support from the ecosystem, not just regulator, is encouraging innovation. You plug the leaking bucket, you encourage the innovation, and see the magic of financial market.
Excellent. Samya, you get the last word actually in this. And given that Nilesh says awareness is overrated, and also that you need to...
I said education is overrated, awareness is needed.
Awareness is needed, all right. You gave the example of Kerala, so anyway. So, yeah.
So, my suggestion is really around increasing the female labor participation rate in the workforce. I think the Viksit Bharat number is that we should get to about 70%. Today we're at 42. We've just recently reversed a 2-decade low from 23%, which was just about 5 or 6 years ago. But the sad part about that growth is that you're really not seeing increased earnings for women, nor are you seeing them really come into formal employment with benefits. So while we can pat ourselves on the back at 42%, I don't think it's necessarily growth that's really helped women at this point. So I think there are IMF studies that say that if you were to increase the participation, then we could even get a lift of 27 or 30% in terms of our GDP. So what are the policies that we need to have in order to encourage this, whether it's around flexible work hours, whether it's around care, ecosystems? I think these are questions that many corporates do need to ask. And my sense is that if we can fix this, we can even fix just having more women as entrepreneurs. I think that will encourage more labor participation, which will actually encourage us to get to the 5 trillion and create a more inclusive country and inclusive growth.
Thanks so much. I think we have, I've already seen that we are close to the time, and I think we just, if we can conclude. So thanks so much for all your time, and a round of applause for the insights that we've
Thank you, everyone. And I think along with that risk appetite, you worked up an appetite for lunch. So we break for lunch and we get back in about half an hour's time for the rest of the afternoon. We have some very good sessions after lunch as well. So we'll be back in half an hour.
Dani Connex, BIMTech Birla Institute of Management Technology, supporting partners Zeta, Balance Hero India, PL Capital, Cyril Amarchand Mangal Das, and growth investment partner Motilal Oswal Asset Management. Before we proceed, we would once again like to request our audience to share your feedback on social media using the hashtag FE Modern BFSI. We'll now get straight into our next fireside chat with Mr. Prateek Agarwal, MD and CEO, Motilal Oswal AMC, on the topic growth investing, a bridge between equity markets and mutual funds. Mr. Agarwal brings to the table 3 decades of investment banking and advisory experience and delivered consistent performance across fund houses. He has been part of the core team that built 2 startup fund houses, ABN AMRO AMC and Bharti AXA Investment Managers. He joined Motilal Oswal in 2022. And to moderate the chat, may I now invite Mr. Roshan Povaya, Editor, Financial Express Digital.
Good afternoon, everyone. We were just discussing that the post-lunch session is probably one of the most difficult sessions to moderate because everyone's kind of in a food coma. But I hope you have enough appetite left for some of the discussions that are to follow, because we are going to be talking about different investing avenues when we're talking about India becoming a $5 trillion economy and raising the finance for that. And I have with me Mr. Prateek Agarwal, who's the MD and CEO of Motilal Oswal AMC, and they deal with a lot of the funds that we will be needing for this growth. And if I was to sum up some of the morning sessions, we had some takeaways like India should move from being a savings economy to an investing economy. And we need more encouragement for people to invest. We need more risk appetite. We need people taking bigger risks. And I think that was one of the key takeaways from the morning session. So starting with that, Prateek, if I was to come to you, mutual funds are considered a relatively safer investment strategy compared to directly trading in equities in the stock markets. I mean, these days you see a lot of retail investors jumping into the stock market, especially when it's at the peak, right, and burning their fingers. But again, the returns from mutual funds versus the equity markets may not be that significant. So we are talking about the concept of growth investing, and that's something that you have been spearheading. How does this straddle the two? What kind of risk appetite are we looking at from investors here when it comes to growth investing?
I will try to answer that. Now, see, in investing, you always start with a belief. Some people call it philosophy, as to why do stock prices move up, right? If it is because the underlying business is becoming bigger, larger, more profitable, more high free cash flow generating, the value of the business is expanding, and over time, markets will reflect it. That is growth investing. Okay. Now, if you are with your philosophy, then you are doing what is right. It is not risky. But in our market, what happens is that there is a market indicator, a Sensex or a Nifty, and risk is measured versus an index. That might make one look more risky versus the other. Okay, is something that people need to understand a bit. Now, we say this is time for growth, this is time for alpha. Just understand this, I'll give you examples, very simple ones. In 90s, what do you want? You want a space where there is large growth sustaining for multiple years. Okay, in the 90s, you got that from software, for example. So in an otherwise old economy kind of a construct which an index had, you get a new space, software, and any time over 92 is when I think, or 93 is when Infosys listed, to 2000, you boarded that train, people made large excess returns over Nifty. Okay, similarly, private sector banks, did it for 20 years, early 2000 till 2020 and so on. In the same manner, if you see, there are so many new spaces that have happened in the market which were not there before. So, come to think of it, 5 years back, probably there was no mutual fund listed. Now, we are talking India moving from being a country of savers to country of investors. Wouldn't you expect, so asset management to asset management, debt versus equity, don't you think mutual funds will grow faster versus the averages? Now, similarly, there was no renewable listed in the market. There was no new tech listed in the market. EVs were not known, people were skeptical and so on. And you get the drift. There are just so many new things which are happening, companies coming of age and coming in the market, that there are a lot of spaces where a combo of solid growth sustaining for long period is available. And we say this is reason for expecting excess returns in the marketplace and food for growth investing. Growth investing also gets tailwinded when interest rates are low, inflation is low, money supply is better. Something that during the course of the day, I think most people would take home. This is what is happening. So that is what it is, very simple. But then, if you compare our construct with that of the index, since index represents averages, larger companies, right? We in our business call it tracking error, very large tracking error, over 90%. So our construct should not be expected to be with the index. They will be on both sides. Okay. And hopefully, if the philosophy is correct, over time, outcomes should be good. That is basically how it is. So we say expect volatility. So as an example, I can give you two indices. For example, you look at a S&P 500. You look at a NASDAQ. Not a perfect example, but you take any 3 to 5 year block and have a worst starting point, which is just before the tech bubble burst, till now, yet you will find a NASDAQ which is more representative of what we do, innovation, higher growth kind of stuff, having delivered better returns versus an S&P 500, but with more volatility.
Okay. Yeah. Right. But when you're looking at a growth investment strategy, and I'm talking about your portfolio management, portfolio managed services, your PMS thing, you look at very limited stocks. So how do you allocate these stocks? How do you pick which ones are going to go into the basket?
Yeah. So I'll take some time trying to explain that. What do we see ourselves as? See, today, if you ask any investor how many funds you hold, 8, 10, 12, 15, right? If you look at the construct of the fund, you find ours short, which means everybody else is longer, and then think of it, you are holding 10 funds. You own 500 to 600 names. Okay, you are paying active management fees. Think of an investor, paying active management fees, trying to own the index. Cheaper way to do it is to buy a index fund. Okay, so see, running long portfolios is one thought if you, for example, are the only fund an investor is buying. Else, by doing that, you are making the investor over-diversified. So we see ourselves as one of the component of maybe a large one, our wish is a very large one, but a component of a client's portfolio. Okay. If you think in a client's portfolio, actually 50 names is good enough, but 60, 70 names is good enough. We say have us on the growth side, pair us with the best of value. Today there is no value manager who manages less than 70, 80. Yet your portfolio gets completed in, let's say, 100 names. Still chance for alpha versus having everything, come into your portfolio through one manager or the other. That is the difference. We don't see ourselves as whole of somebody's portfolio. Unless the guy is happy to, go through the variations along the way.
Put all his eggs in one basket.
Yeah. So very different positioning, thinking the client as to what his issues are and then building a product for that client. And we are saying, expect volatility. So we are saying, look at us as something which is volatile. But if we do our job well, if the philosophy is right, look at the earnings growth quotient of our portfolio, you will find it to be very different from anybody else.
Okay. So what are the sectors that you actually look at?
Let us do it by exclusion.
Okay.
मजा आएगा उसमें. कुछ लोग शायद जाग जाए. After a good, nice lunch was very good. So, what does a growth investor seek to do? Make excess return through growth. So, simply put, if index is supposed to grow at 12%, which is what it has done over a long period of time, you build in 3 to 4% excess returns, which will make us look good over 3 to 4 years. 3% more over 3 years is top quartile. You build in fees, you build in errors, omissions, and you build in some amount of valuation compression. So, क्या होता है? Your start point of growth of a compounded nature, not one period, I say 4 dots, is 20%, 21%. Okay. Now, think of spaces which will not do it. Okay, so will Staples do it? Try and find it in our house, practically zero. Will banks do it? In some constructs we may have some banks, but typically zero in many. Large IT do it, we have zero in the house. Will commodities do it? We have zero in the house. Will ICE vehicles do it? We have zero in the house. When I say zero, close to 0x of our large cap fund, that is how it is. So these are spaces which will not give you what you want, right? Spaces like new tech, will it give you that? Renewables, will it give you that? Defense, will it give you? Spaces which are benefiting from Make in India, will it give you? Luxury, will it give you? And you get the drift. So our portfolios are positioned super sharply for spaces which we believe will grow strongly for several years, which is the crux of, trying to get superior outcomes. So this is what it is. So I gave you exclusions,
right,
and then you get the money to put into newer spaces. Now it helps that we are of the size that we are, because the kind of growth that we seek is not really omnipresent. So if somebody is very large, very difficult for them to find these niches. We are probably of a good size to be there. So that helps. So this is how it is. So we believe our constructs may be some of the highest growth in earnings constructs in the country.
Okay. So in the morning sessions, we were talking about, having more investors getting into the country, like we were saying, from a country of savers to a country of investors. And some of the places where they can actually start off is with, small mutual funds, small cap, mid cap, would give them sustained returns. But how would you compare a mutual fund investing strategy versus a PMS, or for the few who the retail investors directly in the market? How do you compare what they should probably start off with if I was to just take an average Indian investor?
No, so I run a
Classify the
business.
risk appetite like for me.
I run a business, so it's so easy to say come to us. But, dispassionately, if you belong to a industry, suppose you belong to software. Software is a large industry in the country, lot of people employed. Now, lot of them will know more about software than we would know. Similarly, let's say take any other industry, automobile, cement, etc. So if you are dabbling in by yourself, if you do it in these spaces where you are more knowledgeable, chances of a superior outcome is better. Now, you can be in one industry, but you can have friends in 3 industries. Form a group, outcomes can be even better. So if you look at individual investors, you see groups, you almost never see one. Groups always help, exchange of ideas. When times are weak, you hold each other's hand and outcomes are better. But don't try and get into, spaces that you don't know about. Listening to somebody, because you may get in listening to somebody, Abhimanyu Chakravyuh mein ghus gaya, nikalna nahi aata tha. So you won't be able to get out, is the issue. So that is my thought. Now, mutual funds are great vehicles. So suppose you can do X percentage on your own. Now, every time you buy and sell, there is a tax incidence. Mutual funds are the most tax efficient vehicles in India. So with all the drags that we have, fees, inefficiencies, etc., we compete very well with most average investors, maybe even better than average investors. Because, let's accept it, regulators have been kind on us on taxation. Now, coming down to PMS, so for most people, mutual funds are good enough. If you look at spectrum of products that mutual funds offer, most of the need of most of the people can be satisfied. In fact, some of our mutual fund constructs may look superior to most of the PMS AIF constructs. But PMSs, AIFs in particular, allow you to do things which, for example, mutual funds cannot do. So, let's say, giving you a whole range of exposure to unlisted. Now, we have some of those constructs. So, in market, it is liquid. And liquidity has its premium. So if you decide to get into something which is not listed, maybe a year before listing, maybe 2 years before listing, and obviously you will hope to get it at significantly better valuations. While it can up the risk content, yet the outcomes can be vastly superior. So our experience shows that. So those kind of products are very unique products which alternates offer. For investors, once they have most of the needs are taken care of by the mutual funds for that last 15-20% of their capital allocation, they can definitely look at alternates. Alternates can be crafted much better. Their positionings can be very different. It is very easy to communicate that this product should be seen as core of your equity portfolio, for example. So when you think core, you think lower volatility. So I'm not talking of myself or somebody else. Lower volatility. How do you achieve it? Now, for example, by buying highest quality businesses which have a good, nice, steady gradient of profit increases, no leverage on book, no leverage on promoters, anything that causes volatility is not there, less there. And then you are not competing on returns. You are competing on an attribute. You are marketing that attribute, getting the client who wants that attribute. All of that is possible on an alternates platform versus a mutual fund platform, which becomes, one can do it, but it's more difficult.
Okay. Just one last question, and maybe I'll take one question from the audience as well. The sustained interest that you're seeing in the equity markets in India, like retail investors, every time the market peaks, you get a whole bunch of people getting in, burning their fingers in the market. And this has banks worried because savings are not that much, and deposit growth hasn't been that high compared to the interest in the equity markets. How does one strike a balance over here?
No, so this is not entirely correct. If somebody trades in the market, money doesn't leave banks. So you sold, I bought, and both of us has an account in HDFC Bank, for example, money stays in HDFC Bank. In fact, since you can't transfer from fixed deposit, you will put it in savings, so the cost of money for the banks reduces.
Okay.
So more market activity actually reduces the cost of money for banks. So it is not that we are competing with them. It doesn't change anything for them, if nothing better.
Right.
Costs don't increase either, because all of it is digital now. Where competition comes in is for using that money. If equity markets are good, nice, happening, and the whole ecosystem of private equity, venture cap has emerged, then banks find it more difficult to lend, especially at rates which they have been doing and at terms at which they have been doing. So, it's a different discussion, but the terms can be very onerous, and that 4% NIMs, exist only in the US probably.
Right.
So this proved stable for so long. If the terms for the borrowers improve, obviously, borrowers will go more to the banks, or if they want deposits, increase the rate so that the investor which is going to equity markets don't go to equity markets.
Right.
So it is a competitive thing. Earlier banks were protected. Now they are less protected. So that is the change.
Okay. Any quick question from the audience? Otherwise we can wind up because we are out of time right now. We have one question from the gentleman there. We'll just take that one question and then we'll wind up. Can you get a mic to him, please?
In a recent SEBI circular, the fund managers were told to put their skin in the game before it was not there. So can you hear me?
So in the recent SEBI circular, the fund managers were
told or were instructed to put their skin in the game, in the funds. And related question is that the expense ratio should be proportional to the return that fund make.
Sorry, we didn't get the last.
No, so I'll tell you, the rule is a fund manager, if he is managing one fund, 20% of his net after tax goes into his fund. Fair? If he manages two funds, then 20% of his net after tax goes into both of those funds in proportion to the size of the funds. Correct? Somebody who is in a supervisory function, okay, and looks at several funds, 20% of his comp, ex of tax, goes into all of those funds in the ratio of the size of the fund. Sir? बैंकर्स को भी बोलिए ना करें, जितनी भी लेंडिंग उनने की है सब जगह अपने भी 10-10 हज़ार रुपया लगाए ना.
Actually, we are out of time and we can take other questions offline. So I'd like to thank Pratik so much for this.
Chalo, thank you
session.
so much.
Thank you so much for joining me.
Thank you, Roshan. Thank you, Mr. Agarwal, for sharing your thoughts. Ladies and gentlemen, we'll move on to our next session, which is titled Growth Strategies and Investment Pathways, the Changing Landscape. As India's financial sector adapts to shifting macroeconomic trends, regulatory shifts, and digital disruption, institutions are rethinking their growth strategies and capital deployment. The upcoming session will examine emerging investment pathways, M&A trends, strategic priorities shaping the future of banking and financial services. The discussion will also explore how firms are balancing profitability, innovation, and sustainability in a changing landscape. For that, may I now invite speaker for the panel, Ms. Amisha Vora, Chairperson and Managing Director, PL Capital Group. And to moderate the session, once again have our editor, Mr. Roshan Povaya. Over to you, sir.
We just heard one type of investment strategy, now we'll hear another type as well. So this session is titled Growth Strategies and Investment Pathways, the Changing Landscape. So while we talk of becoming a $5 trillion economy, we need multiple stakeholders participating in it, as I said in the last session as well. So the mutual fund industry has approximately 54 lakh crores in assets under management last year. This year it's already passed 74 lakh crores, so it's growing. The capital markets have been particularly attractive last year to retail investors. And SIP is also growing. So this has become like almost a given now. We were talking about India becoming an investor market and less of a savings market. I want to first ask you about the sustainability of retail participation. We've talked about SIPs growing, the risks that retail investors face. What happens if there's an economic downturn? Given the global geopolitical situation, Trump comes up with something or the other every day. You never know when things can go south, right? So what should the industry and the regulator do to ensure that there is long-term investor confidence? And how resilient are we as a market?
So you have clubbed 5 to 6 questions into your first question. But the most impressive data point is that even as of June, the SIP AUM, fresh inflow, is almost 27,000 crores, and which is almost 28% YOY growth. Which means that when we see in last almost 1 year, when markets are a bit sideways, markets have seen all the Trump, they say tariff, but we say tantrums, and all the geopolitical events also, the so-called less knowledgeable investor have shown huge resilience, and they've continued to pour money into markets. Now this 28,000 crores, which is a good 28% growth, is now forming almost 20% of mutual fund AUM. So almost 18 to 20 lakh crore is part of this SIP's accumulated AUM, which gives huge stability to our industry also. And lastly, despite this, the penetration is still very, very low. So the scope continues to be huge. Now, asking me a question that if a geopolitical event leads to a 20% fall in the market, what would happen to a SIP investor? They should be so happy. They're getting opportunity of their lifetime because that's why they're doing SIP, so that they average out their investments over a period of time and also reap long-term wealth creation. Now, over the last 5 years, 10 years, 15 years, 20 years, and 25 years, all types of events, including COVID to war, and including American attack to our no funds, that's where we started, India started opening up. All events have happened. But markets on a CAGR basis on 25 years have still given us 14% return, which no other instrument can give. So I think it's very important that SIP as a class really helps you tide over the bulkiness. Okay. Now the problem still could be there, that if the investors are advised to be, putting your SIPs into what is more trendy, so only small and mid caps, because they are performing much better, or not diversifying enough, or putting your emergency funds into equity. Now that's the biggest mistake that anybody can do. You cannot time the markets. Howsoever smart you could be, you just can't time the markets. So you should put your emergency funds somewhere, protect yourself, and to wealth create, you should go through the SIP route. So now how do we really help people not make the obvious mistakes which we as the core participants know is through investor education. We have to continuously, as mutual fund industry, as distributors, keep practicing the advantages of SIP in terms of long-term wealth creation. At the same time, never to park emergency funds into equity markets. Then I think they will continue to do and ride the volatility really well.
Okay. So, you're talking about SIPs. I also wanted to just talk about, this whole concept of passive investing. But with the Indian government making huge strides in infrastructure, in bringing out manufacturing schemes, we're talking about semiconductor companies coming in. So if investors continue on a passive investing strategy, will they miss out on the high returns that are possible from these sectors in the next few years? What kind of strategy do you see in the next, say, 2 to 3 years playing out better for investors?
So the whole idea of passive industry is to somewhere mirror the indices, and globally and in India, the data proves that 80% of large cap schemes really can't create an alpha, which means they underperform the benchmark. So the whole trend started globally almost 30 years back as to why do I pay active managers fees when any which way they can't create alpha. So the passive has become almost 30-35% in US financial industry. And in India also it is gaining pace. And the key difference is the passive charges just about 15 to 20 bips, while active charge about 1.5, and in and around that. So as what just now Pratik was explaining, that even mutual funds have started thinking on a very focused strategy. If you see 5 years, 10 years back, when passive was very nominal, mutual funds used to broadly hug the indices and with little overweight, underweight. Now they don't mind being away from indices, go through a bit of volatility, but focus on alpha generation, which earlier was the preview of PMS. So passive is, of course, a good vehicle for long-term wealth creation at low cost. But in an economy like us, as what you know, from 2005 to 15, any railway company, I would have gone and met the promoters, or defense companies, any PSUs. Every time they were hopeful, this time big tenders are coming. Next year again, nothing works. Next year again, nothing works. And they continued that lull phase. But if you see last 5 to 7 years, the whole sector completely opened up. The policies came in place, and you can see the kind of defense orders which are going in. The sector just blasted. So now your passive funds can't capture that. Similarly, the whole trend of energy transition from your coal to renewable, solar or wind, certainly a passive fund cannot completely capture it. It will capture when that becomes a sizable enough opportunity and becomes important part of the indices naturally. So a part they'll have to play through active, focused active. But large part, I'm sure gradually in India also, like globally, the passive will gain market share, and the most important, I think, quant will gain market share.
So we were just talking about the sectors, and you were giving an example of railway, all that. What are the strong sectors that you see playing out in the next few years in India right now? So what are the kind of emerging themes for investment that you see in these sectors?
So, if you will see about, say, 2000 to 2010 period, the consumer sector was doing very well. But what within that? Brands, FMCG, fast-moving consumer goods. But as you see, with the complete onset of social media, where e-commerce, the whole dynamics have changed, because the visibility of brand, distribution power of brand is created by these platforms, and the brand loyalty is continuously coming down. So instead of now looking at the whole consumer space through these brand holders, you better look at it from consumer tech companies, who are actually the middle companies who are giving the power of distribution. So that's how the change, and we still feel that consumer tech will continue to do very well in many different forms. It will not be only platforms or deliveries, but they will continue to grow in size substantially. The other focus area, we all are doing this one full day session because the financialization is what is the underlying trend which has been unleashed. Now, when we look at that and we feel now mutual funds have become, 70 lakh crores. In terms of mutual fund AUM to GDP, US is at 130%. We are at below 40%. So there's huge and long way. Yes, so AMC is a complete, and they are cash generating, fee income based. So there are ways to participate in financialization. Similarly, of course, exchanges, most of the people know. And I'm sure most of them have been investing in the unlisted exchange also very hugely.
That is another trend that's emerging
Correct.
now.
But having said so, you take insurance. Insurance is such an under-penetrated industry still, where now that people like you and me also realize that once we are hospitalized, our insurance is not sufficient, let's top up. Let's add up. So there is going to be both the kinds of growth. More penetration, as the penetration is minuscule, be it life or general, as awareness increases, and top up. So both kind of growth will continue to come in insurance. And as what I just said, that defense still, we spend about 1.6% of GDP. But the technology change that we are seeing and the need with the surrounding that we have as a country to protect ourselves, this trend is going to continue and continue. So once again, that sector will continue to do very, very well.
This brings me to another point, which is, the role of technology, because we saw with our recent Operation Sindoor and all that, there were a lot of new technologies that were deployed in warfare, and which we're talking about.
Drone, anti-drone, that's the
exactly.
order of the day.
Yes. But when I come to your industry, and in every industry, artificial intelligence is now making big inroads, right? So the role of a fund manager, where does it stand? How do you see AI impacting the role of a fund manager now?
No. See, the fund manager role will still remain, but both with quantitative and AI. The amount of time that you wanted to invest in either data gathering, in data analysis, and in understanding the comparative data sets will just reduce and crush to nothing. So once again, but investments is not about data. Investments is about your mental discipline, which any which way you have to develop, and that is what differentiates two fund managers, two mutual funds, so on and so forth, or two PMS managers. So I think that it's not still the time that it will be completely non-fund manager, but as what we ourselves are doing. For the last 4 years, we invested in quant.
Okay.
And the kind of infrastructure that we have, so about all the data globally and in India, be it in terms of macro factors, be it all listed companies and their fundamentals, be it in terms of market cycle data, be it in terms of fixed income market data. Now the entire data talks to each other, basis which it throws to us what should be the large cap, mid cap, small cap allocation, what should be the sector focus, what should be the stock allocation. So we have reached till then, and this strategy, which is like emotionless strategy, which purely talks to data, has generated in last 2 years almost 8% outperformance. So this is just the beginning. As it becomes 5 years and people see consistently these things are working in upside and downside, and so many mutual funds are also launching this, then it will pick up the trend.
Okay. Sticking with trends, you also spoke about, the unlisted markets. So if I talk about AIFs and private markets, there is very high interest in unlisted companies because everyone wants to get in early, and then, there's an IPO exit when they come in there. What key challenges do you see in this market, especially for HNIs when they get into this space?
See, if you talk about HNIs, then I assume that you become an HNI only when you have enough sense to protect your capital. So they will at least think about the illiquidity part really well, because in unlisted, we have seen cycles in the market that even private equity funds used to get exhausted. 7 years and IPO just cannot come. So there are cycles. Markets are all about cycles. So timing the market in terms of IPO within 6 months or 2 years, assumptions may or may not work. So always in unlisted, only a part of your investments can go. But I think that to give the real strength to this unlisted, some of the AIFs can definitely participate, a category 2 in particular. But largely PMSs don't. They can't even participate in pre-IPO, IPO application as QIP. Those changes will definitely help, because what happens when a dedicated fund manager looks at it and there is a research backing, it is definitely a slightly better outcome than individually hearsay based. Because how, even if it is not a family office, you can't go for a plant visit, you can't do a vendor check, you can't do a channel check. All that in listed company is still possible now, but in unlisted, it's very difficult. So allowing these vehicles to participate could be a very good move to protect, that interest and safeguard the interest.
Okay, so what role do you see the regulator playing here in
allowing PMSs to participate as QIB category or as anchor category into pre-IPO, into IPO could be very good.
Okay.
Because what happens, PMS is still 50 lakhs, AIF is 1 crore per fund. So that middle investors still don't get that exposure. And then they have to dabble on their own.
Okay. We have time for a question or two from the audience. Can we get any questions? Anyone has a question, just please put your hand up. We'll get a mic to you. Okay. So I have one more question then. So should we be looking at easing norms for foreign capital? We're talking about getting to this $5 trillion economy. And should we be looking at easing norms for foreign investors, foreign capital coming in, and also regulating new age digital assets?
So I think, there are 2-3 very major changes or major improvements which are happening. So now we see, either as a part of CII or as part of APMI board, I observe that most regulators talk to each other. A decade back, each regulator used to work in independent this one. Now there is a regular way in which they interact and sort out. So if you see, some of the moves which are coming are more quick, more thought through. Mutual funds are now being talked about. There is a paper which says that they can accept sizable global money to manage, which is not, and it is that class of shares, which means as per their risk profile, their requirement, which helps get the ready manager with proven track record to manage those global inflow of money, whether from pension funds, whether from family offices, and so on. Similarly, from advisory front, SEBI has now come out with a paper which says that you can use different AI bots for for advising. For advising. So digital advisory is now getting formalized. So doing that in time and actually making sure it works will further help penetration, knowledge dissemination, safeguarding investor interest, as well as increasing the flow of money both from globally and in India. And last but not the least, our pension funds are now investing about between 8 to 9% of their corpus into equity. And globally it is upwards of 40-50%. So there is a long way to go for that long-term money to continuously keep pouring into markets and giving that long-term investments to market.
Great. So on that note, I'd like to thank you for this very enlightening session. It was great speaking with you. Thank you so much for joining me.
Absolutely pleasure. And no question means no interest, or no question means all understood. Thank you. Please, my pleasure.
Re-emphasize the fact that there is great deal of interest actually. When they talk in terms of this spread, I don't know, when the tier 2, tier 3 participation in this whole exercise, any thoughts on that? Because that's been one area which has been on the mind of many people, but some thoughts from you will help.
So I think regulators are doing their bit. Whenever the large AMCs go to tier 2, tier 3, the TER ratios they can have very different, so that the reach can be increased, because there is a cost. When the amount is too less, then there is cost is high. Over and above that, I think one thing which is helping financialization is entire social media move. Because the more the reach is created because of smartphones, the education automatically spreads. So I think that the opportunities in tier 2, tier 3 are now huge. And not only for, small retail investor alone. If you see tier 2, tier 3 now hubs, the large HNI, ultra HNIs also, because they have seen during the last 15 years of infrastructure built up how the land prices have really grown, what kind of money they have made from their land as we constructed roads across India, as we constructed other infrastructure across India. So I think tier 2, tier 3 is a way to go. There's no doubt about it.
Great. Thank you so much. Thanks for that answer. Thank you.
Thanks, Ms. Bora, for sharing your thoughts. Thanks, Roshan, once again. We'll move on to the next fireside chat on the topic AI-powered finance, transforming risk, efficiency, and customer experience. India's BFSI sector is witnessing a pivotal AI-driven transformation as CFOs harness technology to bolster operational efficiency, fortify risk frameworks, and elevate customer experience. Recent developments like RBI's endorsement for AI-based complaint analytics, use of agentic AI by financial institutions, AI for credit risk and smart lending, rising deep tech investment in the BFS space, and more underscores AI's growing strategic value. Our next panel will explore strike the right balance approaches with scaling AI into full-scale deployment while maintaining explainability, governance, security, regulatory compliance, etc. Please welcome on stage the speakers for the discussion, Mr. Shayantan Ghosh, Chief Risk Officer, Balance Hero India. Behind True Balance, one of India's leading digital lending apps, an alumnus of Indian Statistical Institute, Shayantan holds a Master in Statistics with a specialization in Applied Statistics and Data Analysis. With his extensive experience in credit risk management, he previously held leadership roles at American Express, where he developed innovative underwriting strategies and machine learning risk scorecards. Welcome, Shayantan. Joining him is Mr. Madhur Deora, ED, President and Group CFO, Paytm. Associated with the company since October 2016, Madhur is responsible for devising the financial and operational strategy, investor relations, assisting with a commercial roadmap to realize the long-term vision of the organization and driving overall governance. He was previously associated with Citi Investment Banking for 17 years. And to moderate the discussion, may I please welcome Editor B2B, FE Digital, Mr. Yashwendra Singh.
Thank you, Sandeep. Thank you, Sayantan. Thanks, Madhur, for being a part of this session. So let's just directly deep dive into the discussion. Starting off with you, Sayantan. AI is a buzzword these days. You know, it's redefining functions, roles, workflows within organizations. So from your perspective, how has AI impacted your work profile?
I hope I'm audible to the audience, right? Not a single day passes where we don't talk about AI these days, right? And I'll start probably with an analogy, right? Like, let's take ourselves like 10 years back, 2015 or so. Fintechs are like coming new in India at that point in time. Fintech is the buzzword at that point in time, what AI is today. And the overwhelming feeling is that like fintechs with the adoption of technology are going to soon challenge banks and probably like kind of going to remove banks in the longer run. 5 years from 2015, 2019, 20, we are talking about the fact that fintech is just a bubble, which is going to burst in the next couple of years. Now, 5 years from now, 2025, none of those two events have panned out. Both banks and fintechs are coexisting, cooperating each other, and gaining from each other's strength. The way I look upon AI is like today we think AI on similar lines. We think that it's a big disruptor which is fundamentally going to change how we operate our businesses. To me, AI is an enabler, not a disruptor. And like AI can help to like cooperate our business and take our business to a scalable, greater height in a faster time. So that's how I think of AI, and I'll give you some few examples. Easiest facing examples are, let's take customer facing roles, which are like customer support, telecalling collection agents, etc. In our business, which is, let's say, a fintech NBFC working on short-term personal loans, we are like distributing or disbursing loans to 98% of India PIN codes. From Ladakh to Kanyakumari, from Gujarat to Kohima, like we have customers spread all across the breadth of the country. Now, in a diverse country such as ours, do I then need to hire telecalling agents speaking all these diverse languages? The answer is a no, because like today, an AI bot can help to achieve that function. Or let's say a customer who is facing some trouble is wanting to call up like the customer center, like let's say late at night. So do I keep a team like operating 24/7? No, again, like AI helps me to solve that problem as well. Take marketing, for example, like we do like branding, posters, videos, and the AI related content today is probably like as real as what we had 2 years back, if not more real than like what we saw previously. But like for me, like underwriting is something which is close to my heart. That's what like I have been doing, right? And to me, like the biggest beneficiary, like from AI evolution is like, I believe underwriting as a function, which is like the core of any lending business. Again, take for example, let's say, with the usage of AI, we have been able to extract insights from like non-conventional digital data sources such as banking transactions. And now that is complementing like traditional credit bureau, civil data. And overall, as a result, what is happening is like my credit risk management processes are becoming more robust. So in a nutshell, like across like the breadth of like the industry that we are operating in, which is fintech, NBFCs, etc., the use cases and the usage of AI is like widespread, and like it is enabling our business again to scale to greater heights at a faster and a more rapid pace.
So Madhur, do you agree with him? How do you look at it? Look at AI as a disruptor or an enabler? And how is it redefining your role as a finance leader? I mean, is it helping you lower your cost to income ratio or improve forecasting as compared to earlier?
Yeah. First of all, thanks for having me here. I think, obviously, AI, I think it's too early to say what it will disrupt and what it will enable. I think what you should be prepared for is that it dramatically increases the speed of change. So whatever we see today and whatever forecasts we might have had about, or outlooks that we might have had about what will certain things look like 5 or 10 years from now, they will accelerate. They will accelerate dramatically because you just have all of these tools. Underlying all of this, remember, a lot of our analog interactions have moved to digital interactions. What that means is that every company, not just tech companies like us, but every company just has a lot more data, right? And I guarantee you that every company has a lot more data than they know what to do with. Like they haven't quite figured out how to use that data really well. So AI just gives you and AI itself is not new. AI is 10, 15 years old in some ways. The compute has improved, and as a result, you can do a lot more. And what has happened a year and a half ago...
Google Translate we've been using for years. I mean.
Exactly. And the reason why we're talking about AI so much more is because the interface has changed, right? So it actually democratizes AI. So I think one of the best things that we do, and I would encourage everyone to do, is AI allows us to become multi-domain as professionals and individuals. So all of us will have strengths in certain areas, right? Maybe we understand numbers really well. Maybe we know how to run organizations really well. If you think about functions, maybe you know how to do customer care really well or operations really well. It allows you, if you can ask the right questions, to become really multi-domain. So the things that you may not be the strongest at, AI is equally strong at everything, right? So you may have strengths in certain areas that can really complement other things. In terms of your specific question, one of the big, obviously at the core of it, developing consumer technologies faster, developing consumer technologies that you can measure faster. So when you launch something, you can know relatively quickly, quicker than before perhaps, that is it working or not working, or what part of it is not working. So you can really go deep into it and say, okay, this part doesn't work, and frankly, it can give you the solution as well, right? It can tell you, hey, this part of it you may want to relook at. On the cost side, of course, there are massive efficiencies. It does require an organization to completely lean into AI instead of trying to start with, hey, this is the problem that I'm trying to solve. Maybe you want to ask the question of, hey, do I have a problem? And then work with it to figure out, hey, what exactly is that problem, right? Because oftentimes we think we know what the problem is, and what AI can do is really help you understand what exactly is the problem, or even if you have a problem. And then you can focus your energy on the areas where you have the biggest problems. So I think all of us, if we are able to ask the right questions, then it can be a great tool to give us things to think about and projects to prioritize and so on.
Whenever we talk about artificial intelligence, one apprehension that all of us, most of the employees have, is job losses. How do you allay these fears in your employees? You know, one way probably could be upskilling them all the time and making them more relevant. Your thoughts on this?
There are two types of people, those who use AI and those who don't use AI. So if you are going to fear AI, you're going to be obsolete. If you're going to lean in, then you are going to be AI ready. And going back to the point that I was making earlier, which I think connects, is that a year and a half ago, it was very difficult for somebody like me to be able to use AI to make me do my job better. What has changed is the interface. So now I can use AI, right? Very, very powerfully, very, very intuitively. So now I have no excuse. I cannot give the excuse of, hey, I didn't go to engineering school, I'm not a statistics major like Satyantan is. I don't have to know those things. I just have to have the mindset of managing my own career, leaning into the change, and tinkering with it and figuring out things myself.
Your thoughts on this?
Exactly, like similar to how Madhur mentioned, like at the end of the day, you have to embrace the change. Like, and you cannot miss the AI train, like the way I am seeing it. It's a fast-paced world of innovation. Like AI usage is like as user-friendly as it can get today. You just have to know, like you have to just ask the right question. So as long as there is clarity in your mind in what you are trying to solve, I think like AI can again enable you to like on your pathway to solution. So it's not something that is going to like take away jobs. It's going to make you a better professional. And like if you embrace this thought and if you embrace this mentality, then you are on the right path. That's how I look at it.
So Sayantan, whenever a new technology is implemented, or rather whenever discussions about implementing a new technology come up in an organization, there is always this question of either you build or you buy. So what do you think about it? I mean, would buying off the shelf makes more sense when it comes to AI, or would you like to build it internally with your in-house teams? And why? Why would you take that specific approach?
That's probably like the right question in most of the use cases and verticals and functions. But when it comes to AI, I think the answer is like quite simple. Like, let's fundamentally break down what AI is, right? And again, if I have to take the example of one particular function, let's say, credit risk management in general, right? AI is not, let's say, a statistical model. So logistic regression, all of those things were in use like 10, 15 years back are not in use now. Even AI is not, let's say, a machine learning model like an XGBoost or a deep neural network, etc. Like today, AI is about large language models, LLMs, for example, which is like what is like fundamentally powering ChatGPT and all of those things. Now, if we were like thinking of, let's say, a machine learning model and all, like those, we would have debated whether to like do it in-house, invest in the right infrastructure, the resources, build it, and then deploy it. But hardly today, like we are not building LLMs. All we are using today is like, there are LLMs that have been like developed as large open source capabilities by by very big enterprises like Meta, etc., and then like you were tweaking or putting in a wrapper around those LLMs for the use cases where you want to deploy it. So in terms of implementation, there's not much deviation that can happen at this point in time in whatever level of AI innovation that we have. Probably, like again, 2 years down the line, the world is a fast-moving space today. Like this conversation may be very different. But for now, fundamentally, you are not building LLMs. You are using LLMs that are already existing.
What's your take on this?
I don't have a very helpful answer. I would say I would do both. I would do both and everything in between and everything beyond, and I would do all of it. So, for example, we use an AI tool to build AI systems, right? So, how do we analyze our data? We cannot just throw all of our data into AI and say, hey, analyze this, right? In theory, you could do it, but it's just very, very voluminous, right? So we use AI to build tools that help us analyze our data. So and those tools are deployed in our environment. So in a sense, we are doing both, even on that one specific project. And so we use third-party tools like ChatGPT and Gemini to come up with those things. And I think the answer would depend a lot on your capabilities and what type of thing that you're solving. Just like if you're a bank, you are using certain products, you're using certain services, you're doing certain outsourced projects. So you're doing a combination of those things. It really depends on your prioritization, how quickly do you need it. At the moment, I would think that for your most complex problems, most specific problems, vertical solutions may not exist, right? So yes, you may have a CRM tool that works, which is a very horizontal problem. But if you're starting to think about a specific problem in your industry, that is probably not built as an off-the-shelf solution. So you'll probably have to have either somebody build it for you or you have to build it yourself. The other thing that I would just point out is some of these tools they cut across more functions than you might have thought about previous tools. So for example, we get a huge number of obviously customer queries and merchant queries and so on, and we use now a new AI tool for that. Recently, I was doing a finance review, and merchants will ping us that, hey, we haven't got our money yet. Or vendors will ping us that we haven't got our money yet. And I was like, why wouldn't you use the same tool? And we get like hundreds of those, right? And they were like trying to build a tool themselves for this. I was like, we already use a tool that handles millions of tickets. Why wouldn't you just use the same tool to handle these few hundred tickets, right? And so I think all of us have to think about breaking down the problem into first principles and then figuring out, is there already something that exists that 99% does the job?
Sure. But how do you calculate the return on investment on an AI project? Is it easily measurable or it's tough? Is it intangible? What parameters do you take into account when you measure ROI of an AI deployment?
I think some of it is like everything else. You have to, first of all, have the right baseline, right? So the mistake that most companies make, or people who haven't got the experience to do it properly, is that they use the wrong baseline. So that's common across whatever you're trying to measure. I think we're talking about AI projects as if they are AI projects that will solve something for itself. The big opportunity is for AI to make all your spends more efficient, right? So for example, we have 30,000 feet on street who go and sign up merchants, and they take care of merchants and servicing. We have a whole bunch of models that assign tasks to them. Now, can you use AI to make that task allocation insights 20% better? Now, that is 1,000 crores a year spent for us, right? So if I can make it 20% better, I cannot imagine that any AI cost would be higher than that, right? I don't think we'd be spending 200 crores to make that 20% better. So I think you have to think about it slightly holistically. But I think also at this stage, you may want to invest in your organization just being very AI-led. That may not have immediate measurable ROI, but 2 or 3 years from now, you will be stronger as an organization, you'll be more AI capable as an organization, and as a result, you'll be able to solve bigger problems better than your competitors can.
Great. What metric would matter to you the most?
The way I look at it, again, it has to be very use case specific. Let's take, for example, again, customer support. With the usage of AI, am I able to solve more customer queries than what I was being able to do before? Let's take DevOps. Like with the usage of AI, am I being able to push more releases in a certain period of time than what I was being able to do before? At the end of the day, fundamentally, like it's efficiency, but how you like define that efficiency has to be very use case specific. Underwriting, right? Like if you are using AI, at the end of the day, are your credit losses better than what it was before? So like there's a pre and a post to it, but again, it has to be very use case specific. AI is a very broad term that gets thrown around like quite casually, I feel, these days. But like how you deploy, how you use that AI, it has to be very contextualized, function specific, and hence there are ways to measure that.
Can I just add one more thing to it? If you have a consumer-facing product, then not just AI, the role of any technology is something which is slightly difficult to measure in traditional sense. So to give you an example, Uber will spend X amount of money to try to get you a car in 2 minutes versus 5 minutes using technology, whether it's AI technology. 10 years ago, I'm sure it was not AI technology, but they spend a lot of money doing that. Can you really measure the impact of that? Most likely not, right? But there is a customer delight, and then there is also the element of moving the customer expectations so far forward that the customer says, listen, I'm just used to getting a car in 2 minutes, right? It's outrageous that I have to wait 5 or 10 minutes for a car. And that does differentiate you as a company, even though it may not be measurable purely in terms of how much driver efficiency did you increase or something of that sort.
Got it. We just have a couple of minutes left, so I think one more question, and then probably we can open the floor for questions from the audience. Madhur, as artificial intelligence becomes more autonomous, and that's what everybody desires, right? There need to be some guardrails as well in terms of compliance, regulations built into it. How do you balance both, giving it more autonomy on one hand and having these guardrails on the other?
I do think that in most of what we do, we are a little bit far away from systems which are completely autonomous, and that you don't completely understand why exactly it is giving you the insight that it is. I think the flip of that, I will tell you that if you're talking about compliance and other functions, there is an ability today, if you are a compliance officer of 25 years of experience, if you lean into AI, you are able to understand the data in your organization a lot better than you could 5 or 10 years ago. And like I said earlier, organizations are now have so much more data than they used to, and all of that data is relevant and should be used for compliance, fraud, risk, including credit risk. So it is almost an obligation on you as a control function to try to figure out what is the best way of looking at all of this heavy data that you have. And if you're not trained in data, you're trained in compliance or finance or whatever, you now have a tool that can actually help you make sense of it. So I think it makes many of those things a lot better. And I think the risk that comes from autonomy is probably much further out.
Sayantan, any final remarks from your end?
No, exactly. Very good point to where we are ending the conversation. We have come a long way in AI usage, but fundamentally where I think more work needs to happen, where we need to rethink, reimagine, is like something like AI governance. Again, taking an illustration such as like today, fintechs and NBFCs are doing algorithm-driven lending. So how do you fundamentally define transparency, explainability to the customer, right? So gone are the days of, again, logistic, machine learning. We are now on to large language models, etc. So a lot more thought needs to come into it. It's a evolving space, a bit of wait and watch. I am myself curious as to like what the end outcome will be. So, but for sure, like ethical AI is probably most important in order to like for an enterprise to adopt AI at scale as well.
Okay, great. So all of you can't see, but I can see the clock shows 1 minute over time. So thank you so much, Sayantan. Thanks a ton, Madhur, for your time.
Thank you.
Thank you.
Thanks, Madhu, Shantan, for enlightening the audience with your thoughts. Also, thanks to Yashwendra for moderating the discussion. Ladies and gentlemen, we'll move on to our next discussion on the topic driving digital transformation in banking and finance. The session will explore how banks and financial institutions are accelerating digital transformation to stay competitive, compliant, and customer-centric. From reimagining legacy infrastructure to deploying cloud, AI, and embedded finance solutions, the discussion will highlight how leaders are balancing innovation with operational resilience. The panel will also examine evolving consumer expectations and strategic priorities driving digital investment across the BFSI landscape. For the panel, may I now invite speakers in alphabetical order. Mr. Manish Gupta, Head Global Enterprise Sales, Adani Connex. Mr. Rajiv Ranjan Prasad, CGM SBI. Mr. Ramesh Narayanaswamy, CTO, Aditya Birla Capital. Ms. Richa Roy, Partner, Cyril Amarchand Mangaldas. Mr. Sivaram Kota, President of Digital Banking, Zeta India. And to moderate the discussion, I would Jay Mani, Leader, Banking and Capital Markets, Deloitte India. Over to you, sir.
Thank you very much. It's an absolute pleasure to be here and to have such a distinguished panel. We'll dive right into the topic. So just to reiterate, the topic is driving digital transformation in banking. And particularly what we will examine are two things. The opportunities that digital transformation continues to offer to the banking sector, and the flip side of the coin, which is the challenges. So we'll try and tap into stories and experiences of the panelists when it comes to this trade-off, and how do you balance innovation with risk and make the most of the opportunity and overcome as much as possible the challenges, right? So that's the whole idea. Let's first start with talking about what's working well when it comes to digital transformation, right? And particularly one topic I'd like to pick up is it appears that when it comes to the whole question of moving away from legacy systems, particularly core banking systems, which were very, very sacrosanct a few years back, now we are seeing banks and non-banking finance companies challenging conventional wisdom and moving away from those systems. Right? So the question is the move away from legacy and core becoming less and less scarier, less and less daunting of a task? And let me invite first Rajiv to share his thoughts thoughts as a banker on this question.
Thanks, Vijay. Basically, this is a problem which I think most of the Indian banks encountered or started looking at a few years back, particularly when this digital banking started evolving on the landscape. Because this with the legacy system, this entire digital banking would not have been handled by the legacy banks having the legacy system at all. So whether it's scary or it's not, that actually depends upon what approach did the bank, did the organization adopt toward this core modernization thing. So most of the banks, as you see, actually we started unbundling, I would say, or rather the creative destruction of the legacy core, or maybe we embarked upon the core modernization exercise by untangling the issues like the entire components were untangled, various services were decoupled from the legacy core. But it resulted into some kind of a challenge. More than the scare, it actually resulted into some kind of challenge because it came up with its own challenges, I would say. What kind of challenges? The challenges were pertaining to the integration challenges. As you bring about the components and start working in a distributed system, you have microservices and microservices and the APIs to start integrating with those. So it all depended as to what kind of efficient microservices or the efficient APIs you have built. So that was the first integration challenge that actually emerges with the core modernization or maybe this hollowing the core approach. Another was the data management. Because if you have a legacy system, one core system, entire data is sitting there, you have no challenge, no issue with the data architecture, data system, data management. But as you start taking it out and then starts residing, this data starts getting resided into various distributed components, then you have a challenge, because then you have a challenge of data integrity as well as the data inconsistency also. Similarly, then looking at this entire again, unbundling also led to a situation where if it is not handled properly, it started leading to some security challenges, some security vulnerabilities, which were not actually looked at when this was being handled in a core system and the legacy system. Another issue that also, another challenge I would rather say, is the skill gap. Because entire skill within a bank is built on a certain legacy system. As you bring it out and start building this entire system, the components around the microservices and the APIs, you need very specialized skills who are very strong in cloud computing, who are very strong in API management, who are very strong in the securities and those things. So I think it all depends how the organizations have approached it, whether they have gone through a big bang approach or they actually approached this particular challenge in a phased manner. And most of the organizations, they have gone ahead with this, carrying out this activity in a phased manner. So with proper planning, robust, I would say, implementation, and at the same time, ongoing management actually has made this entire exercise of hollowing the core, I would say, much easier, and it has removed actually the fear out of it. But at the same time, we need to be agile and alive to the new emerging challenges that is associated with this hollowing the core approach. Thank you.
Thank you, Rajiv. Ramesh, your thoughts on moving away from legacy and cores?
I think it is a problem of the will rather than the skill, in my view, right? Because my entire career was built on migrating systems from anything and everything to Vision Plus, right? Citibank, in a period of 6 years, migrated 40 countries. Okay, and every project went on time. But two things will matter. You need to have the ability to spend, because whatever is said and done, there will be unknowns. New technology will change. You'll have to do it. But I think it is just that people are so comfortable with what they're having. It works, and then there is always a support system to do, right? I think once you move that threshold of saying that, look, people who are supporting all these things today are not going to be there, in coming months and years, and then there's an opportunity to rationalize products. There's an opportunity to give better customer service. I think this whole problem solves away, but it requires a fair bit of alignment, might be starting from the board all the way to 3-4 levels down. And then once it can be done, is my view.
Thank you. Thank you, Ramesh. Shivram, your thoughts? I'm sure you have spoken to banks about this several times. What are your experiences and observations?
No, firstly, thank you for the opportunity to be on this panel. So thank you to Financial Express for this. Digital transformation, has it gotten easier? At least from our standpoint as Zeta, when you think about our banks, the transformation occurs in, different stages of maturity and complexity. So digital as a business or digital as a channel. Very clearly, digital as a channel is something that has definitely become a very accepted term. So how you source your customers, how you service your customers. So as long as the physical branch being substituted by a digital branch, so to say, in a lot of facets, I think absolutely. And that's where we see a lot of things moving definitely quicker. They become mainstream even. So the debate teams of so many banks are now considered mainstream. But a lot of the focus is on turning digital as a channel. Now, when it comes to digital as a mindset, I think there is still ways to go. Has the underwriting changed? Right? Still, a lot of the lending underwriting, etc., is based on the CIBIL scores and access to the bank, etc. Fundamentally, banks have evolved from creating the entire asset book from liability base as a relationship. If a new to credit, new to bank customer shows up, the probability that they would give them the required credit, the right amount of credit, is probably very low single digits today. The underwriting is not changed. The ability to consume alternate forms of data, etc. A lot of it is being spoken about, but it's all in the innovation, experimental labs, alpha, beta territory. It's not become mainstream. When you talk about fundamentally turning policy to accept digital, KYC, right? So there is video KYC, but its success still hovers between 50 to 60%. After that, there is still a little bit of disbelief or a suspicion left around in the various corridors of a bank to say that, but I didn't see the customer. I don't really know my customer. So digital as a business requires us to change our mindset completely. I think there's still some ways to go. Right? So would a bank engage in a 15,000 rupee loan or a 10,000 rupee loan? A, they don't need to. That's also a reason why they don't. They can afford to say 1 lakh and above is where I will deal, and they will get that business yet. And another 7-8 years, they're safe. But the fintech, the NBFC, thinks about the rate at which they will turn a 15,000 rupee loan, and they will say, I will turn it 5 times, and therefore I will make a 1 lakh. The bank doesn't yet think like that. So the mindset, so 2 parts. As a channel, I think a lot of progress has been made, and it's definitely easier and mainstream. As a business, still some ways to go.
Thank you, Shivram. Richa, your thoughts? You've been involved in a lot of policy work, legal work. What has gotten easier when it comes to digital transformation?
First of all, thank you so much to the Express Group. I'm a big sort of reader of Indian Express and Financial Express and contributor as well. So it's a real pleasure to participate in the events. And thank you, Vijay, for curating such a great panel and your very sort of interesting, provocative questions. Yeah, I think it might be useful to step back for half a second and just talk about the topicality of the issue. The digital economy in India is about 11% of the GDP. And the aim is that by 2030, it should be 1/5 of the GDP, and it should be $1 trillion. And I think that's going to be powered by digital banking. And I think just to use your rubric of opportunity and risk, I think there are some real opportunities there in terms of scale, access, potentially sort of customization using data. And we've seen banks deploy that quite well, including sort of some of the folks on the stage. But then there are risks with that as well. And, this is everything from things like fraud. So Sam Altman said just 2 days ago that banks are still using voice authentication as the sole means of authentication, and AI has completely upended that because it can replicate voice authentication very well. So that's really throwing a challenge for banks as well as regulators. And so as we adopt digital technology and transform banking with technology more and more, this is something we'd have to keep in mind, and this throws a challenge for regulators as well. And then, of course, there are risks like bias and exclusion and explainability and so forth, some of which we discussed sort of on the sidelines. each of which are throwing challenges for business models, but for regulation and policy making as well. And I know we're going to drill into that a little bit later as we go down, but these are some things that have worked very well, thanks to some of our public infrastructure and, the scale of adoption by banks and financial institutions. But I think lots of risk to manage as well.
Thank you, Richa. Manish, your final word.
So, in addition to the panelists, they mentioned about the data being generated across tier 1, tier 2, tier 3 cities. It's not only about generation, it's all about analytics also to be closer to the consumer. So for which the edge network, the edge infrastructure in terms of hosting that AI tools, the analytics becomes very imperative. So you have to be closer to the consumer so that you're not leveraging on a big scale network of residing in some XYZ location, but you have to be near to the consumer. So all these applications, security, have to be near to the consumer to a more effective use of AI.
Thank you. That's a nice segue to the next question that I think might be worth considering, which is, how do you differentiate between hype and real impact when it comes to AI, right? What do you see, and Manish, we'll start with you. What do you see as real change in AI in the banking sector? And what do you see which is still in the POC stage, experiments running for months and months? Just share your thoughts.
So for me, I would say BFSI is the second most evolving vertical in the industry after hyperscalers, which is going rapid digitization. And when you talk about the real-time payments, the digital enablement, the deep assessment which are happening within that BFSI business processes, it is not about just adding some additional space to create that infrastructure. It is about creating a future-ready network. The various challenges in this kind of future readiness, because no one knows what the future looks like. So somewhere you have to envisage from the current scenario. You have to see the regulatory compliances, the data sovereignty things, and you have to create a network which is so robust with zero outages. So that is where Adani Connects is playing a very major role in creating a future-ready, hyperscale, giga-scale kind of network, which is secure, scalable, and robust. So that is what my take would be on this.
Rajiv, your thoughts on, is there too much experimentation and not enough in production? Or do you have a counter view?
Yeah, no, actually, I will look at it this way, that globally, in the BFSI space, if you look at the IT investment where it is going, 50 to 55, 60% actually IT investment being carried out by the BFSI institutions actually is going into the run the bank. And if you look at the remaining about 15% to 15-20%, that is going into the regulatory-led development that are being carried out. So how much that leaves the BFSI sector for the IT spending to do? That just leaves about 20-25%, which is going into the innovation or product development and those areas. So if you look at this aspect, and at the same time, if you start looking at this, where does all this digital banking, the banks who are digitally, I would say, other players who are participants of this ecosystem, where are they right now in some sort of digital maturity? So the participants who are at the initial stage, or maybe still at not, I would say, very highly, strongly digitally mature, they're still working on the product level, the product provisioning level, designing our products, and some amount of innovation happening at that particular stage. But as you move towards more and more digital banking maturity, as it starts coming in, and if you start looking at the banks who are more digitally mature, you see that they have moved away from product provisioning, and they have actually moved towards customer-centric need servicing. So I would say whatever is happening in the AI, this is much beyond the hype actually, and now real work has started happening. But yes, definitely it's at different scales for different participants, different players. And so AI has actually moved beyond chatbots. Now more and more AI is being used for your decisioning, credit decisioning, for your automation of a lot of routine works, data entry, your risk management, it is being used on the fraud detection and all those things. Similarly, for the predictive maintenance also, AI is being used. So a lot of use cases are being discovered as the maturity on the digital space in general of the players is also evolving. And I would say that, okay, I mean, it appears that, okay, right now the AI is more buzz about it than the actual work. But good amount of work is happening. It's only a matter who is doing at what scale, how much. That is the only difference, I would say. Thank you.
Thank you, Rajiv. Ramesh, your thoughts?
I mean, I think all of us will, give from a different perspective. Let me give my perspective on this. For today, might be tomorrow, it is not valid. See, I think the reality is when we say AI, in my view, there are two things which comes to mind. One is the development of models itself, okay? Very rarely an end user is going to develop a large language model. It's not going to happen, right? So that part of the AI is out of the window. Second is training the model. Yeah, we might bring in data, but the different techniques to train the model also an end user will never do, right? So that is also gone out of the window. So now suddenly when you look at it, it is again a very old integration problem which you need to solve. And the second part is you should really get people to adopt to new tools. I mean, I would go to the extent of saying it is AI for an end user is that there is a different set of tools which he needs to use, okay? And then why there is a struggle in that is today the kind of the medium in which the tools are is the same. I'll give an example, right? We all did flip charts, right? From that we moved on to doing transparency with projectors. Then we came to PowerPoint, right? Now so it was quite an easy journey because all these things happened in 7, 8, 10 years. People were easily able to adopt because the form in which I need to do changed, right? So it was very easy for me to understand. And today, the challenge is you're giving me a tool A in computer versus tool B in computer, and I really don't see a reason why I need to go to tool B, right? And that's what I'm saying. No, what is an end user AI is what we want to look at it, right? How do we train people to use these new tools so that they do something in a much accurate way and in a much faster way? And I think that's where the problem is, right? We're trying to make everyone scientist. Actually, I don't know. I mean, we are really looking at a lot of problems. And we feel that if you have implemented your rule-based correctly 95% of the time in financial services, it is done. Right? So I think we need to get that clarity. I think because of it, I feel there is a challenge. But eventually, all these things is going to give, I think the reduction in time for me is the biggest thing which we are seeing. And we have done a number of projects. So we developed our own platform just to learn how this whole thing works because we didn't know what questions to ask. So now at least we know what questions to ask, even though we might not know answers. I think that's how we need to think. I think the adoption to new tools and new way of thinking is what will make AI successful. Because I think 99% of the world will not even touch real AI is my view.
A quick follow-up question, Ramesh. Agentic AI, there's a lot of talk that it will radically change processes. It will remove a lot of humans from the loop, may not eliminate, and that can collapse timelines, can reduce cost radically. What's your view on that?
Cost, I'm not sure, okay, whether it is going to, but we did our own experiment for audit, right? I mean, every quarter, it is very difficult. We have got 8 companies and auditors comes and say, so we said we will build a platform. The platform view is very simple. Tell me all the vulnerabilities in a region, say in my production region, right? So the dialogue goes something like this. The auditor comes and says, okay, tell me all the vulnerabilities in the region. Okay? The bot asks, can you upload all your documents, all your policies? Policies, regulation, we upload everything. What we realized it had the ability to go and find in which version, say, I'll just take an operating system, right? Which version of operating system I'm running? What is the latest which is available? What is the migration path for this to latest in conjunction with what it is changing? What would be the test script? What actual script? This whole thing got finished in 5 hours. Typically, it normally takes 8 people whom we take on an every quarter basis to do this, and it used to take 2 months for us. Okay? So the reduction in time is real. And you know what? This is 100% accurate. Okay? Now, the only thing is the human in the loop hand shakes because he needs to press the button and says, go and change it in production, right? So so I think that's absolutely real. And second, specifically to agents, we were in the US looking at companies, and one company really changed our view, right? Because we said we'll have to build an agentic platform, bring all data in. They said, don't do that. I'll create agents, I'll send the agents to your platform, it will go and do it. Then the whole thing changes. Suddenly you realize
in your existing systems, you can go and do this. And that's fascinating with A2A protocol of Google. And they showed a demo, and we were saying that, okay, now you don't actually need an agentic platform. What you need is independent agents going to each of the system, doing the work and come back. And that fascinated us, and we're trying something out of it. Only time will tell. And the time is very short. In 45 days, you will know whether it works or not.
Fascinating. Shivram, your experience is hype versus reality.
So we normally speak about AI as an overarching piece, but AI has been around for a long time, more than 10, 15 years in mainstream. It's the generative AI which is, actually driving the buzz. But I'll first pick the point Ramesh was making, that you send agents into the production environment to do the work. See, fundamentally, all historical systems or current systems are written in a way where data is organized by system. Some of the more modern systems or products may have organized it by function or product. But none of them are organized by customer. That would be the wrong design. In the current world, it would be wrong, it would be inefficient, expensive to do it so. But now, if you're sending an agent in there, and Ramesh is conversing with the agent or interacting with the agent as a customer, can we absolutely guarantee, and I'm speaking in the context of banks in India and globally, which have the strictest measure of risk management, the strictest measure of being accurate. Having a problem is not good enough, right? You cannot have a problem. Now, how do we guarantee that this agent is only going to pick Ramesh's data and only talk to him about it? Let's say, as part of a joint account, Ramesh and his partner share it. How does it figure out exactly what to pick, what not to pick? So the chances are it can get it wrong. And we've been doing our experiments on this and found that every now and then, and it's less than 1%, point something, but it gets it wrong. And therefore, it's not good enough to be put in that environment. In the context of banks, the data transformation required is you have to recast your thinking and the systems, etc., to have customer-led data. So, putting it colloquially, literally a table or a cluster which says, this is Ramesh's data, that's it. And that's the one I will give access to. Because if I'm sending my agent into their environment, I have to give it access to whatever that environment is. And that environment has other people's data. So that's, I think, and there are a number of 7, 8, 10 such large deal breakers that are there in the current way. So what we have seen is almost every bank is engaging in POCs. No bank has a production system, and for good reason, where they have put it out there and saying, yes, it's working. Everyone's very hopeful that something will change because the impact is tremendous. At Zeta, we started using Copilot integrated into our IDE, and we've seen productivity go up by 30 to 40% straight away. Importantly, all code reviews now we do it via Copilot. People are out there naked. They are not allowed to write bad code anymore. Our incident commander is an AI bot. It doesn't need rest. It knows exactly, we have 1,700 engineers in the company. It knows exactly who to go to for what. It's there in a dictionary, it's there in the playbook, but it can retrieve it. It doesn't get tired. So there are specific areas where we are seeing immense application. And with human in the loop, with things in the back office, I think we will see a very strong adoption and productivity will go up. Absolutely agree. When it comes to in the face of the customer, will you expose a chatbot to a customer directly? How do you guarantee that it's not going to say the wrong thing? I think there is still some ways. Yes, there are governance models. There are so many things everyone's doing, but it will take a while before we build our belief as a community, as a banking as a community, to come to that point. For example, voice is, an AI agent can talk to you, and 90% people won't know it's not a human. It's become that good. And yet, it can converse to you in any language. I can start with English, end with Hindi. That will start responding in Hindi, and so on. It can do all of that. But do you trust it enough to leave it alone, unsupervised, with your customer? I don't think we are there yet. So we are seeing a lot of even POCs happening with human in the loop. At the minimum, we will see the human observing the conversation, ready to step in if something goes wrong, or being even more conservative, that let me power the human agent with the right information. So instead of taking 9 minutes to close the call, they take now 6 minutes. I've got a 30% improvement. Let me take the win and move on. Right. So hype, not hype, definitely we are nowhere close to what the hype is. That, I think. Is there real work happening? Yes. A lot of improvements happening. as you said, 95% rule-based is enough. Or traditional AI, or even traditional ML. And it's interesting that I'm saying traditional ML. ML used to be cutting edge not too long ago, but that is enough. And that's what is actually coming into mainstream today. Gen AI probably has still more time.
Time scales are collapsing. What was new today will be traditional, conventional a quarter from now. Richa, your thoughts, your experiences of what's hype and what is real?
Absolutely. Very quickly, I think, first of all, I'm very glad you asked that question because it's very easy to get swept up in the hype. And I think I'll bring a slightly tempered view to this as well, because I think there are some ways in which AI is still underwhelming us. And I think there are some ways in which, it has a lot of potential and could do a lot better, particularly in financial services. And, the note of caution I'd throw particularly is when we used AI for anything related to decision making. I think Mr. Prasad also talked about potentially using AI for credit decisions. I think there is a real risk there. And I think, in the legal, regulatory, ethical world, we have a concept of a right to a human decision. So particularly sort of with credit decisions, we want to make sure that there are no exclusion errors, and we want to have, as you were saying, a human in the loop. So I think that's important. There's also kind of, we briefly touched upon the risk of fraud and others. So those are, AI is keeping up with human ingenuity in terms of, fraud and bad actors and so forth. But by the same token, and I've been in some conversations with regulators where they have used AI, very, very well. So SEBI has been using AI for the last year or so to review their offer documents, for instance. And so, they will use that to say, this is a disclosure you made a few years or months ago, but it's not in your offer document. Where is it? So things like that. RBI is using it in some of their regulatory processes as well. Yesterday, there was an article about, the IT department using it to see, the number of times you've logged in, how many times have you accessed your AIS, etc., to clamp down on tax evasion and so forth. So I think that's a real opportunity. But I would just say let's have a tempered view.
Thank you, Richa. No talk of AI is complete without AI infrastructure. Manish, you're at the forefront of building that. Your thoughts on challenges and the energy implications, and how are you tackling that?
So AI is coming in a big way, yes. I can not suggest the way other panelists are suggesting, but yes, I can tell you, because when we are working with hyperscalers, a lot of BFSI banks, or specifically big banks, they're already working with us to create giga campuses. And this giga campuses not only going to cater multi-tenants, it's talk about the operational efficiency, high density computes, energy resilience in terms of 100% renewable energy, 100% water neutrality. So talking about the big campuses hosting multi-tenants from every perspective, it's coming. And why? Because we are the ones who are creating for them. So when I'm saying we are creating, 2 years down the line, they would be live and working. So from that perspective, I would really say that things are evolving, because bringing transformation is not only about migrating some technology or adding some workloads onto it. It is something about creating an infrastructure which is evolving. And evolving, catering to the regulatory guidelines is, the data privacy things, the energy resilience, it all needs to be taken care. And from that perspective, we are going big bang across the domains, and you will see the output very soon on that.
Sorry, how far are we behind other countries like China in building infrastructure? I know it's a loaded question, but your thoughts, are we doing enough? What do we need to do to catch up?
So in terms of AI, we actually have a lot of challenges, in terms of the regulatory clearances, the challenges, the data privacy laws. 70% of data is still residing outside India, if you see as a nation. And the kind of infrastructure, if we talk about, still the per million capacity which we use in India is approximately
scalability. We are very selective, and also we are very purpose oriented, that okay, this specific purpose whether it will take me, it would be better if I build this in-house.
Services. As to why build will be a challenge. Because in financial services, I always say there's nothing called as a minimum viable product, right? A product needs to meet all the regulatory constraints day one, okay? Now we need to really say, what does it take to build that? And what we have seen, when people, I worked in Standard Chartered, which runs its own core banking for many, many years, right? So now that's a challenge. Because there is nothing, you can't do a MVP 1, MVP 2, MVP 3. Right? Day one, you need to have all. If that build is going to take a long time for you, there is no point, right? I think where we will do build, in my views, at a transaction level, we spoke about NPCI payments, it's great, right? If you were building a pure transaction system, I think you can build it.
In light of build versus buy and how that's changing?
So the problem is not recent, or even the topic is not recent. And every enterprise system, starting from SAP to a Finacle or banks or Vision Plus or TCS Prime, any enterprise grade system has started as a solution, working closely with a customer, and then grown out of it. Banks came out of SBI. Finacle similarly had a couple of anchor clients, if you will, and so on. Maybe for sure in the build buy, it seems like a binary option, but this is clearly a very successful third option, that you build in partnership with somebody, because there are multiple advantages. As you said, there is a cost and time element. Now, if you obviously share the cost and time across clients, then the net cost to each client comes down. And that's what has happened with every single enterprise product. So history is in favor of saying that enterprise products have to be built along with customer. You can't, and a lot of fintechs are doing this nowadays, and I get worried by that. They sit in a room, imagine something and say, this is my vision, and launch it, and then they're surprised why it doesn't work, right? So, but if you work with the customer and do, so we certainly at Zeta embody this, or we've internalized this, we try to follow that quite a bit. So there may be biasness there, but history also suggests that that is a model that's worked. And otherwise, in a bank, the build and buy largely depends on the context. Are we talking about building new core systems? The first question is not whether you can, but why should you? As you said, the interest rate is the same and so on. If there's a very big problem and you're not getting the solution, do so. Otherwise, as long as your core layer is configurable, as long as it has the right interfaces, be it API or file structures, events, etc. Now you build, where do you differentiate? Do you differentiate there, or do you differentiate on the experience? So the DBAT teams certainly are building a lot of experiences in banks. Now, whether they do it in collaboration, partnership, or by themselves is a tactical point, but that's the point of differentiation. What is the difference in experience? Ultimately, if you issue a savings account, you are required to issue a savings account only of a certain type. That's the regulation of the land, and not India, the world over. So why would you, so the why is not answered for build across on the core systems. Probably you should buy, but maybe collaboration works best. We are certainly seeing a lot of traction on the collaboration element, where so that it also, the change we have to make is not see ourselves as a vendor, but see ourselves as a strategic partner. Now the word, I know we say partner, vendor partner, all that too easily, but strategic partner means I have to put real skin, flesh, organs on the table to make it work. So, and we are required to do that, and we are willing to do that. And I'm sure, and we are not the only ones. Almost every serious player I see globally is coming in. So for example, let's set up a joint venture. And instead of investing the money into buying a product and building, do the joint venture, both invest capital into it, and then a product comes out. The multiple models that we are working on, I think that, so it may be the third way, not build or buy just.
Let's move on to a segment of the market where there is tremendous need for building better systems and better offerings, and that's MSME. The penetration of formal credit in MSME is really low. Richa, let me start with you. From your point of view, do you think technology and all this digital transformation will change that? Banks have been trying, NBFCs have been trying, fintechs have been trying, but still MSME credit is stubbornly stuck.
Absolutely. I think MSMEs are 40% of India's GDP. About 75% of all marketing happens at MSMEs. And it's just extremely inequitable that they don't have the same access to credit. And I think the reason for this is, and we were discussing this on the sidelines actually, is that a lot of traditional lenders lend on the basis of balance sheet and assets, which MSMEs don't always have. And I think the digital transformation opportunity here is through things like the Finternet, which gets rid of, the information asymmetry. It has kind of individual or business data at the Finternet. I think we have an experience with DPI, so I think there is a lot to be thought about in terms of the governance of the Finternet, who should own the guardrails, what should the private sector do. And I think there are also sort of certain regulatory and governance issues around kind of competition, around the difference between the public player and the regulator, around similar issues, relating to consumer protection, systemic risk issues, etc. That will have to be borne in mind. But I think the Finternet is something that can really democratize credit for MSMEs.
Thank you, Richa. In the interest of time, let me jump to the lenders on the panel. So, Rajiv, your thoughts on the potential for technology to radically increase MSME credit penetration?
Yeah. So, if you look at the MSME model, traditionally we have a trades platform. So, but if you look at the number of buyers and number of sellers who are registered on the trade platform against 63 million number of MSME, it's less than 1 lakh MSMEs who are registered as a seller on the trades platform. All three put together. Less than, just about, I think, 80,000 or 85,000. Similarly, on the buyer side, we have maybe, 30,000 buyers who are registered on these platforms. So just compare the number, where 63 million and where is this, whatever, 30,000 or 80,000. So what is happening, this is only the first layer of the seller who is actually connected on that particular platform or who is making use of this trades platform. And we have the entire chain, the lower in the value chain, who are not even connected anywhere. So they are simply supplying to the seller who is now actually getting benefit of this entire formal mechanism of funding. So the models that actually we have presently is the bank-led model, which is a totally transparent and acceptable also, which is more formalized in the form of your working capital finance or maybe this trades platform and those things. Second is your fintech-led platforms. So there a lot of agility has come. But again, the agility in terms of, because they are making use of analytics, their cloud computing capabilities, they have brought in a lot of agility and flexibility they have brought into the platform. So they are working with the industry majors and trying to connect to maybe the second layer, third layer, to some extent. Third form of your MSME lending is actually anchor-led. And there the benefit comes because now the credit leverage is that of the main anchor merchant. So there we don't have any credible solution, so to say, which will actually enable the use of this anchor credit leverage to go up to the last mile. Actually, because there are a lot of small players who are also contributing to that particular chain of the up into the value chain. So that is not happening because ultimately we don't have, I think, any blockchain-based tokenization kind of a model where you keep on fractionalizing the token up to the maybe deep tier financing kind of a thing, third layer, fourth layer, fifth layer type of thing. That is missing right now. Another thing is that now basically the banks also have to actually evolve their entire MSME processes around 3 or 4 foundational pillars, like strategy. They should be very clear as to which customer segment I am designing this product for, I should be creating the product for, which customer archetype I'm going to finance. Because you can't have a one solution or one shoe fits all kind of approach when it comes to MSME. Different kind of MSME who is at different stage or at different levels of value chain would require different kind of treatment. Another is the processes. Now, as you go towards fintech-enabled financing for the MSME, you also need to actually design your processes as well as put in place the appropriate policies so that it supports your instant credit decisioning and all those things. Third is your analytics. Now, analytics has to be so strong and robust that you are able to make use of all the, so much of, I would say, the data is available now in the ecosystem transparent, very credible information in terms of your GST and everything, that it's very easy to actually analyze and basis the cash flow, extend that kind of a lending. And then the operating model. So if if banks are able to solve for and address these 4 key issues which surround this MSME and able to address the up to the last mile, I think that is the way going forward.
Great, sir. Now, there's a lot of consumption lending. I think the positive side of MSME lending, it actually adds to production capacity and creates economic value. So very critical issue. I know we are 2 minutes over time, but I'd like to invite the panel members to give one closing remark, maybe 10 to 15 seconds each. Manish, we can start with you. If you were to crystal ball gaze 5 years out, how do you think the banking sector would look different compared to today?
So the difference which I perceive would be something like predictively scalable kind of a system, because no one can envisage the technology and the future of it, and somewhere resilience at scale. So that's how this BFSI vertical should be, from now and 5 years later down the line.
Thank you. Rajiv?
Yeah. So I would like to actually quote Bill Gates, and actually this quote came in 1994, but I think it's still prophetic, that banking services are necessary, not banks. So let us see, because the way things are evolving around analytics, around a lot of new technologies which are bringing about a lot of agility into the system. Even today, what you see, the NPCI, the payment space, 36 of the payment space is with the NPCI, UPI, And
what banking regulation will be like, what financial regulation will be like. So my hope is that 5 years down the line, financial regulation will be much more participative, proactive, and kind of principles-based. And I think we're already headed there. The governor, I think, in his remarks this morning talked about sort of committing to doing more stakeholder consultation before bringing out regulations.
Thank you. Thank you very much. I know we are 6 minutes over time, so unfortunately no time for audience questions. But please feel free to catch the panel members on the sidelines and ask your questions. Thank you very much to everyone on the panel. Thank you for your valuable insights.
Mr. Mani, for moderating that session. Thanks to all the panelists also for joining us today. Ladies and gentlemen, we'll quickly move on to the next topic, which is a fireside chat, Future Ready Innovations, with Ms. Rohini Rajola, Executive Director Growth, NPCI. As Executive Director, Growth at NPCI, Ms. Rajola plays a pivotal role in expanding the reach, utility, and adoption of its payment solutions. She leads product enhancement initiatives aligned with NPCI's strategic goals and market needs, and drives business development, spearheads marketing strategies, and manages go-to-plan market plans for the organization. And to moderate the chat, may I now have Mr. E. Kumar Sharma, Senior Deputy Editor, Financial Express Digital.
Thank you so very much for your time and the patience. We've been waiting eagerly for your session, and everyone who comes here talks about NPCI, never misses to mention that, though I think I was talking to my colleague and I was mentioning that coming from SBI, as you know, is also a huge digital bank in some sense, isn't it? So, yeah. But first of all, A round of applause for NPCI. I think innovations UPI crossing 18 billion transactions last month, and we have her speaking. I think, yeah, great. So that's a huge thing. In fact, I was talking to Roshan, who's the editor at Financial Express, and he has been meeting at NPCI's, I think so far, right from Dilip Asbe, we have been having interactions each time at BFSI. And we were just discussing of how, impactful NPCI has been all through. So great, I'll keep it brief. I'm keeping on looking one eye on it, then I will go into 2 or 3 specific things.
So thank you very much. And I think it's always heartening to sit in the audience, even in the previous panel, to talk, when people are talking about growth, when they're talking about transformation, and it doesn't matter which industry, which organization people are from, and it's very interesting. And I think there's a feeling of slight proud feeling as well, sitting in the audience and listening to the fact that NPCI is this invisible enabling layer or the platform that is driving that success, right? So, again, you mentioned 18 billion. I'm sure like everyone's read enough articles and news bites on how we are now the single largest real-time payment processing in the world. We crossed even Visa on 1st of June, actually. It was a landmark day. We did more transactions in India on UPI than Visa does globally. So, that scale has already come in. But to your question, Mr. Sharma, if you look at it, UPI was launched only in 2016. So it's not like it's been here forever. It's only about 9 years. We have not yet completed the first decade, and it's been transformative. It's democratized payments. It's actually not even a product. It's a platform which has really catalyzed fintech innovation. Like we built what innovators can come and build on top of. But to your question, especially in the context of how do we get to the $5 trillion economy, what is it going to be? How will the next decade look slightly different? And where do we go from here? Yes, we are now at, it took UPI about 12 months to reach 1 billion transactions a month. We now do about 600 million transactions a day. We, in fact, have an internal model on when we are going to reach the 1 billion transactions a day. And it's not very far in the future. And we are ready for that. So,
any time frame has been set?
We have internal models. We have a bunch of very smart people who have done some predictive analytics to what that date is, but that's an internal one, so I'm not going to share that here. But importantly, it's not just about going from 600 million to 1 billion transactions. I think the future-ready innovations that you're talking about is how are you going to solve for inclusion at the penetrate even further in the inclusion, despite the fact that even today, a substantial, more than 50% of our transactions are actually coming for tier 2 and tier 3. So it's not just about in the metros, it's not just here. So how do we drive even further on inclusion? How do we get the next 200, 250 million users digitally, financially included on one end of the spectrum? And I think at the other end of the spectrum, how do we ensure that we are actually making UPI payments? Today, when you think of a UPI payment, the form factor is a phone and a QR. It does a lot more than that, but if you had to ask somebody on the street, hey, what does UPI represent? If they had to create like a logo, they would make a phone and a QR. Tomorrow, it's going to be many, many more form factors. And, we have the 3 I's there, which is how will UPI enable payments to become invisible, intelligent, and inclusive. So there is by design. So that's where we are moving in terms of the innovations. You want me to specify?
No,
I've been talking for long, so I'll let you ask the questions.
Very important. Good that you mentioned this. And actually, very important that you mentioned on this inclusive bit, because I was trying to understand, in fact, you can help us a bit more on this. What kind of innovations perhaps NPCI is exploring when it comes to bridging the last mile, as it were, the gap? I asked, for example, there has been talk of this UPI Lite, voice-based payments, feature phone support. Some thoughts on that, some specific points that you think are engaging your attention.
No, so absolutely valid. By design, if you look at the UPI Lite, which is and Litex, which actually works even in an offline environment, meant for small ticket, low bandwidth kind of locations where both merchant and the customer might not have, internet access. I'd go even beyond that to say UPI Circle, this was a feature which was launched in the last Global FinTech Forum. We've now got the approval for the full delegate. So typically, and that for inclusion, when you look at senior citizens, when you look at domestic help, when you look at young kids, for them to have access in a calibrated manner, in a manner which is, taking care of any of the risk elements, being able to extend the experience of digital payments to them, I think the whole next phase of growth of UPI Circle will be really key to that. The one other element we get, NPCI has many products beyond UPI. I know UPI is our star child, so it takes if you look at the Aadhaar-enabled payments that we have, I think there are more than about 11 million points where people can get digitally, that's where you're taking digital financial inclusion right to the remotest corner of the country. So there is a lot of innovation, especially to drive inclusion, which we are already working on UPI, but there are also other products. And those products range from getting DBT or the Aadhaar-enabled payments right up to going to use cases like toll and transit. So
one specific, maybe in the coming year or something, 2026, that one thing that we will see definitely taking shape and actually, and one long-term thing which actually can be materially significant, just to give a sense in terms of innovation in this.
So not to make any predictions, because I think it's important to know that it's the customer who decides. And UPI is not scaled like this because someone sat 9 years ago and said that there'll be 1 billion transactions a day. I think the important thing is we built something which was so easy and real time, not just for the customer, for the merchant, for the corner nook and corner store there. But we think there are a few products that are really are ripe for scale. And I'll shift a little bit from UPI to our RuPay credit card. The RuPay credit card enablement on UPI, I think that is driving the acceptance to a whole new level. So if you look at how, yes, people were making UPI payments at small stores, and there was this entire credit card payments which was evolving or, growing at a slightly, steady pace, so there was this entire differentiation between a merchant who was accepting QR and the small set of merchants. It's a fraction of the total number of merchants who accept the POS terminals where you can go and swipe your card, right? So when we launched our RuPay credit card, which is only 5 years ago, you can go to banks and say, hey, you issue cards with X scheme and Y scheme. Now you can also issue a RuPay credit card, which is all good. But that's like catching up to the market. The true innovation there was to say, we now have so many merchants who accept UPI. What if you could also use your credit card at all of these UPI accepting merchants? And that, I think, has really, really transformed. And we believe that is going to roughly double in the next few years, where you will be able to go and, because when you use a UPI transaction, then it's typically taking out the money from your savings account. When you give the same experience to the customer where they can get reward points, they can get the interest-free credit, but still use it at the corner store where they were not able to use it. So I think that is one innovation which there is a lot that is happening in that field. We are going to be launching a few features on EMI. There's a lot of product enhancement on the RuPay credit card, but I believe that's one that's really going to take off. The other one, I believe, UPI Circle is going to be having a lot of impact, especially from an inclusion point of view as we roll out the full delegate.
Yeah, I think crucial actually. Last 2 points I want to check actually. We discussed this point as well, and in our newsrooms we keep discussing this about like how banks have this know your customer. Now we live in an era where we need to know your fraudster in some sense. So on fraud prevention and the approaches to that, how is let's say NPCI using technologies like the 2 letters of the English alphabet, AI, which have often been used, AI or biometrics, to stay ahead of the fraudster and make the experience much more seamless. Any thoughts on that?
Yeah, I think at NPCI it's a huge responsibility for us. So it's not just about, again, getting to those billion transactions a day, but getting to them in a safe, reliable, in a way that even the remotest part of the customer who is the least tech savvy, can also understand and participate in this in a responsible manner. So we take two approaches to this, Mr. Sharma. The first is about consumer awareness. And I think somehow, that's got nothing to do. So I'll come to the AI bit, but sometimes we get so carried away with how to use AI to control fraud that the simple thing about letting people know, because it's those places of vulnerability where there's maximum risk. So I'm sure, hopefully, many people have seen our campaign on the Main Moorkh Nahi Hoon, which we ran on TV and lots of other social media. We're actually coming to the next phase of that, and we have taken that not just on, yes, you can watch it on TV and on social media, but we've actually taken it to grassroots in, Nukkad Nataks. We did like lots of very, very inclusive things on ground during the entire Kumbh Mela to actually people who are there, because everybody there was a merchant and there was lots of commerce, how to educate people on ground. And I think that's our responsibility, and we will continue to do a lot more of that, because, the best anti-fraud tool is an aware customer. It's not just about an AI model, but that's something which we continue to do. But you're right, and on the AI piece, we invest a lot in our fraud risk management. In fact, we have gone even beyond, and we now have created models that we are sharing with the banks, because we are in this unique position where we are able to even see things like, what's happening on money mules, not just money mules. So we've created models, we are sharing them with the banks, and we are increasingly, every time we are training those models to be able to get better and better at figuring out, and we sit in this unique position where we can add on top of the models that banks run in-house to be able to get better at fraud prevention. So this is, I think, going to be an ever-evolving space, but we are invested very heavily, and we're working on both traditional models, the customer awareness, and AI-led models to be able to capture.
One last question, actually. Suppose we have this conversation, hopefully with either me or my editorial colleague, not a bot, in a year from now. What would be the one thing that you think would be NPCI talking in terms of achievement on the innovation front? And that's my last question.
I think it would be very limiting to say there would be one thing that NPCI would talk about from an innovation.
As many, but what do you think really would have made impact?
Yeah, I think it is time for some of the things which have been on the brink, which have been like, there's been a lot of talk about IoT, wearables, all of these things, which have been in a more experimental pilot kind of phase. We think that some of those things are going to be getting into a little bit of mainstream and will start picking up. I think there's also going to be some more, again, because of AI and because of all the work that is happening, we believe a little bit of the multi-language and voice-based transactions, which we've done some work, but I think there's that next leap of where the models get so much better that you can actually run those at scale. Some of these things which we've been, and no innovation happens in an instant. It's not like something's going to happen tomorrow, but there's been some of these things which there has been a lot of work, and then there's an inflection point. We believe that for some of these innovations that we've been working on for a very long time, we're going to see the inflection point coming in over the next 12 months.
That's a nice point to end this on, but thanks so much for this. In the interest of time, I had a whole sheet of paper with questions, but I think given the time constraint that we have, and already there is pressure on your time, and you have also a meeting to attend. So great. So thank you so much, and a round of applause for what NPCI has been able to do, and you in particular. Thank you so much.
Thank you.
Thanks, Kumar. Thanks, ma'am. Now, our next panel is on cybersecurity. And this is the last panel discussion of the day. We'll follow that with one fireside chat. For this panel, the title is Building Resilient Cybersecurity in an Era of Escalating Threats. For the panel, may I invite the speakers in alphabetical order? Mr. Bharat Panchal, Chief Risk, Security and Stakeholder Management Officer, Bima Sugam India Federation. Dr. Pawan Chawla, CISO, Tata AIA Life Insurance. Mr. Puneet Asthana, Executive Director and CTO, Shriram Wealth Limited. And my colleague Sandeep Soni will be moderating this session. Sandeep, over to you.
On the topic building resilient cybersecurity in today's digital framework. And I'll come to Mr. Panchal straight away to you, sir. As a marketplace, for insurers, connecting the insurers, the customers and intermediaries, which has a potential to kind of, transform the insurance landscape in India and multiply the insurance penetration in the country. How do you see the concept of, cybersecurity, how difficult or is it, to control the risk, from the third party perspective, sir?
Well, thank you. So the session is last on cybersecurity, but security is always come first. And that's the principle for us when we are building this insurance platform. Because security has nothing to do, security doesn't do a partiality nowadays. You go any sector, be it insurance or telecom or the previous speaker was talking about banking and payment. Everywhere security has taken its own driving seat. What we are building right now, the Bima Sugam or the insurance platform, definitely is going to be a tech-driven with a lot of security, kind of tools and technology implemented. But the fact of the matter is that, security has much less to deal with the technology than the human behavior, right? Because I have seen in my previous avatar where I was in NPCI, and we have seen how people are misbehaving when it comes to technology. So I think the psychological change also required to implement along with the security tools technology, because when it is a paradigm shift in terms of your user experience. Same time, security will also become paramount on certain things, right? So therefore, what we are building right now, it is security by design or security as a principle right from the day one, right? So that's a opening remark from my side.
Stan, I'll come to you, sir. Your thoughts on the subject.
Also, like Bharat mentioned, that cybersecurity is not silo. It need to be looked at from a different angle, or it has been part of all the embedded system now. The paradigm shift which we see is there more no IT issues. Now everything has become the cybersecurity issue as well. Even the system is going down or it is slowing down, it is a cybersecurity issue. So that shift we are seeing there from an IT landscape perspective. And similarly, when you look at it from that perspective, so third-party risk, which we are going to talk about, will become important, because whichever vendor you are onboarding and whichever third-party APIs you are integrating with your system for building the ecosystem becomes very important.
Can you give some examples, some references?
Yeah. So if you look at the recent threats, the insurance companies itself. There are few insurance companies which have been breached because of their third-party APIs which are integrated and they have not been secured. So it is very important to build a strong third-party risk management framework in an organization and ensure that it has been followed rigorously. It doesn't start towards the end, it starts at the beginning. And in that framework itself, you should ensure that first you not only check the controls which are implemented by the third party in their own environment, but whatever controls are, they have been following as a practice as an organization. So you may find third parties who doing the assessment when you are approaching them and asking for certain documentation. Now obviously that is a risk, because they are only doing transactional work. They are taking security seriously, because when you are reaching them and because they want to get associated with you or they want to stay associated with you, they keep on doing certain exercise. Maybe it is VAPT, maybe it is ISO certification, maybe it is certain governance work which they are doing. But then you have to analyze them over a period of time, give them rating, and tell your business as well to be cautious of such vendors and not onboard those vendors where you see a potential third-party risk. Continuing with that practice, it may help you in building a strong cyber resilience framework within the organization as well.
Okay. Stan, I'll come to you. How do you define risk? How do you look at it? And also, secondly, when we talk about, AI adoption, in the sector, do you see, AI workloads kind of outpacing, the capabilities, digital capabilities?
Surely. Just to continue on this, the vendor-induced or the third-party risk definitely needs a right framework. That's one. And this equally applies. I think one thing good is happening is last 4 to 5 years, this talk has gone to the boardrooms. So these days, the cybersecurity initiatives or any new initiative, the angle of a cybersecurity talk happening preemptive is now setting in, which is a good thing. In the rush of latching on to the exciting journey of artificial intelligence and the workloads, which all across industry, banking, capital markets, everywhere we are getting into this kind of AI workloads. There is still a big gap there in terms of the framework. We are supposed to do a lot of exercises of cybersecurity analysis, threat analysis. LLM model itself is one of the strongest promoter of leakage in terms of data. So these are the 3 areas especially. And then of course I also feel that there is a skill gap. We still get a skill gap there, which I see in stitching that kind of an architecture, what is coming across, where the LLMs are actually sitting on cloud, or a particular LLM which actually you download and implement in your data center. So these 2 areas which I believe cybersecurity is requiring a bigger attention.
Awareness scaling, are among the 2 areas that you highlighted. Mr. Panchal, your thoughts on it? What we can do, to increase the awareness and also on the scaling part? Awareness.
Well, I think that's what my previous answer was also, that there is less with technology and more with the psychology. Awareness is because in terms of cyber fraud today in India, 70% of fraud happen out of greed. 20% to 25% because of ignorance and fear, which has nothing to do with the technology. So awareness is the only tool by which you can make people educated about how to behave in the technology-based system. Like, we are literate, but we are digitally illiterate people, right? So how to bring that literacy among people. And, if you see the kind of news coming in nowadays, somebody lost 7 crores, somebody lost 5 crores, bank manager, IPS officer, doctors, chartered accountant. I mean, they are not the people, those who are coming from the rural part of the country, those who doesn't understand how to deal with the technology. They are the well-rich, well-educated people, but the greed, ignorance and fear is overwriting all the technical control or from security or risk point of view what we build in the system. Because if you are giving your username and password to somebody, matter ends there. System does not have intelligence to figure out is you or somebody else is putting this username and password, as long as the username and password is correct. How you can bring that awareness among people, that's a key aspect. And by bringing best of the best solution, best of the best technology, of course it will make preventive kind of actions when something is going wrong, but it is not going to entirely safeguard you. You have to have human intelligence, human, kind of awareness, which plays a role.
So for these digitally illiterate people, as you put it, what's the best way to create awareness?
Unfortunately, until you lose your money, you are not bothered about what is going wrong. So I'm not saying that everybody should lose money, then only they'll understand. Best part of the awareness is that, look, I'm telling in so many conferences that in medical science, is always said is a 1 golden hour. In any fatal accident, or one hour is most important. Something similar in cyber world. Precious 2 seconds. Before you do anything, whether it is legitimate or illegitimate or anything, before do any transaction, think for this 2 seconds. Why this guy is giving so lucrative offer where I can be a billionaire overnight? If this guy has so much of money, why he is not a billionaire? Why he is doing this small business with me? Why this guy is giving me a threat that my mobile is going to be, my SIM card is going to be blocked because I have done my KYC just a month back. Why should I bother? If we took that deep breath, think for this golden 2 seconds, your 98% problem will be solved because this 2 seconds will give you the sense what I am doing is correct or not. That's the best way.
So just being patient for at least 2 minutes, going through, read out.
2 seconds, not even 2 minutes.
Not even 2 minutes, 2 seconds. I think, but that's one of the reasons why IRDAI has sort of, issued, guidelines around, fraud monitoring. So according to you, what steps have you taken you to kind of, look at it, how you are adhering to it, what steps you have taken?
See, it starts from the alignment. So I would say before going to the employees in the organizations, the board has to be aligned and the management has to be aligned, and they need to think from that perspective that everything starts from a click or there is a human intervention which is required. If they are aligned, it will become a seamless journey for you to have spread awareness within the organization.
Can you give one scenario?
I'll come on to that. So, like Bharat talked about that, if it is until unless somebody faces that kind of a challenge or lose money, they will not even think about cybersecurity. Now, the way you can articulate it, and there are many ways to do it. In different organizations, there are different ways to handle such scenarios where it can lead up to termination of an employee as well. Not specific to any organization, but I have seen organization in the industry, in the BFSI, which does that as well. So you have to keep on enhancing your education program and then have it implemented and make it mandatory for everybody to go through it. Otherwise, stop the salaries of the employees itself until unless they complete it. Because if they don't take it this seriously, there will be high chances that you will be breached. And if you look at the history of the attacks, if an organization is breached once, it will automatically get breached again as well, because there will be some loophole which has been left. There is an article I was reading, and it captures this study which has been done. And let's face the fact that hackers have more money than CISOs, so they have all the good tools which they can implement, which has the AI, ML capabilities and all. And CISOs will only have to wait till the time they get the budget and have that implemented as well. Because we also need to keep on testing. Right, cybersecurity is all about breaking things. It's not about making things. It's about breaking things. You keep breaking the things. You learn more. You implement more. It will be better for you to secure the organization. It's all about that. The change in the mindset has to come. If you cannot bring the change in the mindset, you will never be able to achieve the level of security you want to achieve for an organization.
Right, Mr. Thana, breaking things and changing the mindset. But we talk about, in the AI-driven era. Do you think most of the organizations are mature enough to face these, AI-driven threats, according to you?
There's a very stark percentage, or a bad percentage. Very frankly, I was sort of a data of 2025 report. There's about 13%, it has done a survey, and only 13% of the CISOs do align with the concept that the new AI, are they prepared? Are they even planning? So it is a very, very bad percentage. No, they are not. But going by the same method, if any new project or a new architecture is in place, today, most of the organization, I have worked with biggies of the world, at least in India, I've seen with HDFC, ICICI, to example, Instagram as well. The cybersecurity approval analysis, doing a threat analysis of any new architecture, that's what comes first. We talked of vendor evaluation. The same theory goes for adopting any LLM model, that are you actually going and testing that where it is deployed, how is you going to connect, what is the data transit, how the data is getting encrypted while, because the LLMs are taking data elsewhere, you don't know. So who's actually doing this deep dive? These are the elementary steps where you can actually know how to deal with it. Coming back to awareness, I believe the tabletop exercises we are doing today, which is very good. I'll give you an example. We were doing a tabletop exercise in ICICI, and one of the board members said, I'll call the CTO. That's what is the answer. So from there, I believe the training to the board members is also essential starting from there. They should not eventually even accept that there is a ransom call. So this awareness is growing up. This is the level where the awareness starts. Then an anonymous email comes to the employee and we are tracking those emails. How many people are opening it? What is the open rate? How many people are clicking it? So this shows that the level of maturity, alertness to the emails which are basically not right. They have some errors there, but people don't notice. And primarily these emails are related to salary, they're related to any kind of a benefit, etc. So these are the easy kill. But if this awareness by on and on exercises we do, I believe the awareness and the readiness to this kind of attack can be improved.
Readiness, what do you mean by that? When we say readiness?
Sorry?
When we say readiness, what exactly?
Readiness is about the rule book, the playbook. In case of any attack, what is your playbook? Who calls up? What is the communication pattern? Who sends the email? Whose email is supposed to be acknowledged? It is the CISO, it's the CTO. Who sends the first line of communication, which is supposed to send a red alert that, okay, time for action. If this playbook is not being made over and over, practiced by the way, it's not that you can just create it, take it to board or the IT security committee and get it approved. It is to be practiced. So more and more you bring that playbook to practice, the likely chances of responding to a threat is much better.
Very interesting.
Yeah, I would like to add, because what he talks about is the operational readiness, but there is a technological readiness need to be checked as well, and it needs to be verified from time to time. Otherwise, what will happen is when the incident actually happens, you will realize that you may not have logs to actually do the forensic of that. So it is very important that you keep on doing this exercise in a continuous fashion, in a regular interval.
And I'm sure most of the enterprises in the country are not ready with the technological readiness, for a small enterprise or not even mid-size, a micro enterprise, small enterprise. How micro enterprise, small enterprise can have that kind of technological readiness?
See, it again depends. I mean, a regulated organization, yes, people have started adopting it, I would say. Not 100%, definitely, because this is not something which was in the radar of anybody till a couple of years back. But now people have started adopting it. And second, you have to also look at it, everything requires an investment. So you need to budget that out and then only you can do it. And again, it starts from management. You need to convince them to get that done as well, because it may require some investments as well. So if cybersecurity, what I believe is always starts, it's always a top-down approach. It can't be the bottom-up approach. So first, people in the management need to be convinced to take to take an appropriate action, and then they can drive it within the organization. But yes, technical readiness. Coming back to that topic, it is very important, because when you are what Bharat talked about is the golden hour. It is important because if you are ready to face an attack, when the attack happens, if you are ready, you will be able to recover faster. Because if you're not ready, then it will take more time. That's the reason you see that there are many organizations which stays down for 4 or 5 days, sometimes more than that, because they are not even ready. They don't know. Everybody believes that I'm immune. Nothing will happen. But in life, it is not like that. Even your life is not immune. You get sick, you fall. God forbid if something happens, the things goes wrong. You have to be prepared for everything. You think of the worst and then start preparing yourself.
But Mr. Chawla, I wanted to touch upon the investment aspect that you talked about. Investment, right? This may not be part of the discussion that we had, before the panel, but I want to touch about investment because eventually cost is also a critical factor, for at least for emerging businesses. What are the key areas, a growing business, emerging business should look at purely from cost perspective in adopting these cybersecurity solutions?
So I'll give an example with my real life learning. So there are a couple of things which you should look at is, first look at what is your requirement. Don't go by the words or what the OEMs are telling you. There are different buzzwords which are being used in the market. There are different ways people try to scare you in the name of cybersecurity. And whenever somebody comes to me, I always say that don't scare me because my business has been built on that. I sell life insurance, so. So don't scare me. I can scare you more than what you can scare me. But the thing is, people need to understand. That was on a lighter note, but people really need to understand. So they need to first see that what best fits within their environment. Not for everything you require the best product. You need the right product to be implemented in the organization and which can still bring a value onto the table. You will be able to convince. And when you go to the management with the budget, always show the ROI you are bringing in onto the table. It may not be always monetary, but it may be from a resiliency perspective what you are bringing in, which could potentially save the business for the organization. Like we talked about the attack. Now today, if you look at it, the way attackers are moving forward, there are services which have been sold, and unfortunately, not unfortunately, fortunately, they are much more coordinated, and it is much more well-balanced industry than any other industry in the world, because it is on trust, but still everybody believes it. You can buy a ransomware at a cost of $40, and you can hire a planter at a $10 per hour cost as well. In the dark web, if you go. Now, look at it. If you can do that, anybody can hire a ransomware planter and allow them to plant it. So I always recommend one of the video which is there on YouTube. You should always check it. Anatomy of an Attack. It was released by Cisco in 2016. It is still valid, still prevalent, and it still applies to all the industries today. You just look at it, how the attacker thinks. But that's where the industry is moving. And what is important for the for CISOs or for the information security professional is to pitch the right product at a right cost with the ROI you are bringing onto the table. You will be able to convince and implement that.
Right. Mr. Panchal, can we also talk about the timing of adoption of cybersecurity solutions? Most people, they may not take cybersecurity solutions in a very sincere way. Especially for a new enterprise, probably a one-person company, a small company. I'm sure the level of sincerity and maturity when it comes to mid-sized enterprises, large enterprises, definitely there. But when it comes to small enterprises, one-person company, small enterprises, the awareness is not there, and also they don't understand the timing when they need to adopt the cybersecurity solutions.
So let me tell you a very straightforward thing. Cybersecurity is not something which you can add as the topic at last. You have to think cybersecurity the way you think about your enterprise. What is important that you need to understand what you want to prevent, what you want to secure, right? Not everything is very important or not critical. Like let's say in pharma, the process may not be important compared to your formulas. You want to secure your formulas compared to your process. So you have to identify what you want to prevent, what you want to safeguard. Accordingly, you have to invest. See, the fact of the matter is that where there's a technology, there's a cyber. The risk is always be there. Unfortunately or fortunately, the technology is dynamic. The risk emanating out of that is also dynamic, and therefore your cybersecurity also has to be dynamic. Days are gone where you used to put one firewall, one antivirus, one router, and security is done. No, it is not. At the same time, that does not mean that if you have invested 10 crores, and that is giving an assurance that you are safe. No, it is not. You have to identify properly. You have to invest meaningfully. On top of everything, you have to continuously monitor the threat vector as well as your environment, that what is going on, where you need to further enhance your security. But in all said and done, you should not wait for something to happen to your organization and then you invest, which could be a 10 times or 20 times bigger than what you are supposed to do right now.
Mr. Sana, we'll close up with your parting thoughts.
So I believe cost of compliance and cost of cybersecurity is definitely a new entrant. When I say new entrant, it has been realized as one of the element recently in last 2-3 years. And that continues to be ringing in the most of the TCOs and most of the board notes. So cost of compliance is now being realized very effectively. For cybersecurity, as rightly said by Bharat, it is not a retrofit. It is never a retrofit. If you do a retrofit, you eventually end up creating more technical debt rather than solving it. That's about the cost. And this is non-negotiable. The cost of compliance and cost of, thankfully, in kind of a regulated environment in India, cost of compliance and cost of cybersecurity is non-negotiable. So I think that I believe is happening in bigger regulated entities. In mid-size, it is a talk, and small REs, if I may call it as, are doing something. They're trying to manage it, but the sensitivity is low. They want to save costs, etc. Yes, it is a costly affair, But when I talk of the biggies, yes, they are looking at it. They're doing heavy investments as well in that.
So cybersecurity cannot be retrofitted. It's non-negotiable. Where technology, that's where cyber is. I think we leave our audience with that parting thoughts. Thanks. Thanks to all our speakers joining us today. Thank you once again.
Thank you. And if you get your cybersecurity wrong, you always have insurance to fall back upon. So that's our last fireside chat of the day. We'll be talking about insurance, the way forward in a poly-crisis world. May I now welcome on stage Mr. Satyanandan Atyam, Chief Risk Officer, Tata AIG General Insurance. Mr. Atyam is responsible for driving the company's enterprise risk management framework with over 18 years of global experience across insurance, capital markets, and automotive sectors. He brings deep expertise in risk, information security, and data privacy. He's previously served as the CRO at Max Bupa Health Insurance, and he's an engineer and MBA finance. And to moderate this fireside chat, may I please also welcome Mr. Varun Gupta, partner at EY. Not a very easy task to have the last session of the day, but it's up.
Hi. It's to have more people in the audience than on the stage. I think that's itself is an achievement at this hour. We'll try to keep it short given the audience and the weather, but still we'll promise we'll add value to the conversations. Satya, see, nowadays when I speak to my daughter, earlier we used to tell them treat our guests with respect. Now what happens, you can see what happens with Trump and Zelensky. Yeah, so you know what happened with Trump and Zelensky. War was a rare event. Nowadays, we can see skirmishes happening all over, right? 4 of them are happening right now as we speak. So there is crisis which is emerging in the world, and maybe we'll talk more about the data around it. But how do you see all this is interconnected? What's your view on that?
I think, Varun, it's a very broad question. I think when we talk about geopolitical instability in itself, I think we are seeing around our space, across the environment, across the world itself. So the way these are developing, I think, the polycrisis definition, what we have been given to talk about, I think it is quite apt in terms of the type of interconnected, events we are seeing, this type of amplification that is happening. I think, and the uncertainty and the more of uncertainty, which is also an eventful outcome of this interconnected, I would say, the crisis, what we see, and the geopolitical situation is all about creating more of, unnerving situation for the, I would say, for enterprises, for the entire world itself. So I think these are, all leading to more of uncertain moments, uncertain days for corporates. I think these are also creating more of our ability to manage the risk, because this creates so much of uncertainty with regards to, let's say, you take insurance business in itself. I think at some point in time, the type of marine insurance we write, we had to be cautious about a certain geography where we had the Yahutis being attacked and, those creating those attacks. We had to be cautious about type of risks we write from a marine perspective. So I think across every sector, I think this geopolitical uncertainty, what we see, is creating impacts.
Yeah, I think, so if we kind of peel down the layers, I think one topic is NatCat, the catastrophes and what's happening around us. Now, sometimes we fall prey to a recency bias. Sometimes we hear that calamities are happening, floods are happening. And so as risk professionals, you are a risk professional, I have been a risk professional. So we need to look at data also. And data does prove it. So just to share some statistics with the audience, In insurance, there is generally a life side and a non-life side. Now, if you look at the data which is published by the Institute of Actuaries, then on life insurers, broadly 1 to 2% there is improvement in mortality year on year. That's the data which is published, 1 to 2%. Forget about COVID. I think that's a different aberration. But on the catastrophe side, whatever statistics are coming, it's almost 3 to 4% increase every year. So definitely something is happening in the world which is increasing these risks. So what are your views about this?
So Varun rightly mentioned, I think you gave a very life insurance perspective. Let me give the general insurance perspective. I think in 2023, we had $140 billion losses across the world because of the NatCat events. And to give the audience understanding that NatCat means natural catastrophes. Now, these natural catastrophes, and to in context, the first quarter of this year, the NatCat events are zero. Now, what is the impact of these NatCat events? It creates a lot of physical and transaction risk for the world itself, for the insurers. When you talk about insurers, they underwrite the risk, the property and casualty business in particular. And when they underwrite the risk, it is quite important to understand the physical and the transaction risk. The physical risk arising from these natural catastrophe events and the transaction risk, which is more subtle in nature because it is not quite evident. When I'm saying it's not quite evident, I mean to say, let's say if I talk about pricing and underwriting as one area, you have a transaction risk when you see that the fossil fuel-based cars, you will see the claims are reducing because people are moving to transitioning to EV-based cars. We are not seeing this, we will be seeing this. We are actually in the transition phase. The transition risk will be because your average claim cost is reducing, your average claim cost for an EV-based car increases because of the battery fire. So you may see there is a transition risk there. You may get cautious because if you are not prepared, if your underwriting policy, if your underwriting methodologies are not correctly in place, you may not notice this transition risk. And you have to accordingly create your average claim size. Now, average claim size for a physical risk of a fossil-based fuel car would be a certain number. But an average claim size of a EV-based car where a battery loss could be a very big amount, could be a different number. Have you taken it in your IBNR reserving? That's quite important. So these are some examples of how transition risk is quite important. Now when I say a climate risk framework, I think we have all heard about the TCFD guidelines, the Task Force for Climate-Related Disclosures, Financial Disclosures. So even insurers are moving towards a climate-related risk frameworks to be developed. I think recently the regulator has also mandated that every organization should have a climate risk framework approved by the board. And I'm part of a lot of discussions where there is a clear indication that this will be benchmarked with the TCFD guidelines. What it means? What it means is the next level is investments. Are your insurers are making investments which are actually where your investee companies are ESG compliant companies. So insurers are taking the BRSR reports of those investee companies, and then they are benchmarking those numbers and they are accordingly investing. Third parameter, which will come under climate risk framework, would be more around reserving, would be more about underwriting. I think there are a lot of catastrophic models which insurers adopt, basis which they really measure the cat-nat risk, and then they accordingly price it from a geographical, from a pin code perspective. So there could be another perspective from a reserving, which I said, because reserving is again an uncertainty. And being an actuarial, I think I'm getting into your shoes, and I have to be quite cautious on that way. Because reserving is a subject which is talk about uncertainty. You are talking about uncertainty and you are creating those reserves according to it. Because in general insurance, you also need to create, though you are looking into the cat losses which are experiential base of what was past, you also need, basis the experiential base and basis of what is projected, you need to also create those IBNR reserves. So I think from an insurance perspective, I think the climate risk, which is one of the determinant of a typical polycrisis, which we see when we say polycrisis of geopolitical, climate, and other topics of cyber and other social impacts. I think this piece is quite impactful for insurers. And I think they have the right mechanism, methodologies in place to cater to the insurance business and putting those right provisions in place.
I think one area which I think India has a lot to do, but the way the technology progresses, I think one is use of technology, let's say satellite imaging. Because if you monitor the trends over a period of time, you can see how the land use is changing, how, let's say, the lakes, what happened in Kedarnath, the lake bursting. So if those monitorings are there, so and satellite imaging is getting real cheap nowadays. So do you have any other example of technology changes which are happening which can help in this area?
See, I think the space tech, I think what you mentioned, satellite and the space tech piece is quite one of the emerging area. I think one of the previous speakers, I do not recollect, but I think he was also referring to the space tech as an emerging space, and which is one of the deep tech space of where, there could be a lot of investments and there is a lot of leverage from a societal impact. I think I always believe, whenever you are working on some emerging tech or an emerging, area, the amount of societal impact it makes is quite important. We see, we are talking about many other satellite-based services which are coming to India. The Elon Musk, what he brings with his Intelsat, services. So I think the societal impact of reaching the connectivity, I think the last mile connectivity at a cheaper price and with a better bandwidth, I think this is something which is going to be quite transformational in India, particularly, which I think we are seeing in other geographies. They are already extending these services. I think the satellite tech, the space tech would be the biggest revolutionary change, which I would say. And once this change comes, and I think there is a lot of things to catch up in terms of cyber. Because wherever there is a tech, there is a cyber. I think the previous panel also talked about the cyber risk being a determinant and outcome of any technology innovation. So I think to limit the answer to your question, I think this is what my views are.
I think because the previous panel spoke about cyber, so in the interest of time, we may just skip that and perhaps move to more geopolitical changes which are happening. And you know that we see that there are conflicts which are happening, and they have happened in recent memory. India, Pakistan, Iran, Israel, Russia, Ukraine has been happening, and today we heard that Cambodia and Thailand, there are certain border challenges there as well. And now it is becoming a bit normal, I will say. So maybe 1 year, 2 years ago, firing into an enemy territory was still quite taboo, but now it's becoming quite normal. So how do you think about those risks, the reasons behind it, and how it might just change insurance and the world we see?
See, insurance in particular is all about a societal impact. I think it brings capital leverage because if you really understand property and casualty or insurance in particular, it brings a lot of capital leverage for the governments. Because the more the insured population, the better the capital leverage for the government and society in particular. Now, with regards to the conflicts, what you see, I think it's more about a decreased tolerance. I think when you see these conflicts emerging across different geographies in this world, I think you see a decreased tolerance in the mindset of people. So a decreased tolerance is not a derivative of a certain behavior. It is a derivative of what you see and what you see as an accepted behavior. Because occupying an enemy territory is more of an acceptable behavior and the tolerance is increasing for that. So these are risks which are actually prevalent because of the type of baseline, I would say, acceptable behavior which is being created. Because I think the aggression in particular, is now being termed more conveniently in terms of your own, I would say, cautioning or I would say protecting your own interest. If you try to term everything as an aggression, as protecting your own interest, I think the world is going to move in that direction. But I think there is a flip side to it. We are not, because I wanted to touch the economic impact and what is the geopolitical instability. If you are allowing me, I will just put that perspective.
Sure, go ahead.
Yeah. What we are seeing in the last, I think in the first half of 2025, we have seen the dollar index is actually being 10.7% its fall in the dollar index. It is actually it is clearly showing that the world is moving away from the dollar index and maybe the gold is going to be a preferred base. The central banks are increasing the reserves of those gold reserves. Because the dollar index is getting weak, it also means there is a lot of capital flow away from US. And if you see the credit spread between the Indian bond yields are decreasing. Now they are about 1.88%, less than 2%. What it was a 7% in 2011. The lot of geopolitical shifts also happens because of the economic activity. We always have a different perception regarding the geopolitical shifts, but there is an underlying economic activity which also influences them. So what we are seeing is that the amount of capital inflows that goes to move to US are also decreasing because of that. And it also creates more amount of uncertainty of inflation and recession. And this also creates a lot of bureaucratic and political interventions. And it also, so there are multiple reasons why you see this economic shifts, or I would say a geopolitical shifts, and underlying base, I would say it's always economic shifts.
I think human race, they say, is quite inept in understanding changes which are major but slow, which happen year on year. So I think the dollar index, let's say, or the gold, which you are talking about, I do this interesting exercise that sometimes when you are looking at your bank balances, bank statement, it's a fiat currency. So try to measure it in terms of gold, as in how much grams or kilograms of gold you can buy. You will get some very, very startling answers. So, but the bigger point here being, and I can recommend to the audience a book by Ray Dalio. It's a book which is Changing World Order. That book actually speaks about that whenever there are changes in economy and economics, that's when the military conflicts start. So generally, it's not the military conflicts which precedes economics, is the other way around. So take UK, before that it was Dutch, and actually the book goes back 500 years, Romans. It goes up to the Roman Empire and how the changes start to happen in this world, which is now increasingly becoming multipolar. So my last question, you have now around 20 years or 20 plus years of work experience. If you were to go 20 years back, sitting today you have certain experiences, and if you were to reflect back and see 20 years ago, how would you see the change in role, or what do you see the change in risk perceptions around?
So there are two views. Maybe Varun, it's a very tough, tricky question. I would say, see, you always have a very basic concept of a threat, vulnerability, and risk. You have, let's take an example of you all sitting in the room. We always are with a threat of, there could be a cold flu with somebody which could spread. And that's an ever-prevailing threat. The vulnerability could be our own immune system. Maybe 70% of the people may not catch the cold flu, but maybe 30% could catch, because that is a vulnerability or weakness in your own body, which you are susceptible to the threat. And anybody who catches that flu is exposed to the risk. So a threat exploiting the vulnerability leading to a risk is a more manifestation of how things work. And that's in the real world also. So if you talk about this 20 years back and now, I think the threat vectors were limited. The threat vectors were limited. The vulnerabilities were, even they were there, because threat was limited, you never had a threat exploiting the vulnerability leading to a risk. Now, we all talk about digital acceleration. 20 years down now, we are talking about digital acceleration. The threat is, now threat vectors are arising, because the thief who used to come and break the door of your house and pick up the jewels from your jewel box is now coming digitally, because your crown jewels are not in your house now. They are in your bank accounts. They are in your app, in your mobile. So threat vectors are increasing. The vulnerabilities were always there, but you are reducing the vulnerabilities now. Because now you're moving to a digital space, a new set of vulnerabilities have arisen. You are adopting new digital technologies, a new set of vulnerabilities arise. And the risk is an exposure there. So I would say 20 years back, though you never had vulnerabilities or you never had a lot of threat vectors, your risk exposure were reduced. Now your threat vectors are increased. Your vulnerabilities are also increased because of the new adoption of new technologies and new products. And therefore your risk exposure is increased. I think that's more of a common, I would say a common sense perception.
So I sincerely hope that with the threat vectors going up, with the vulnerabilities going up, the body will create antibodies and we'll become stronger as a race. Thanks a lot for your patience, and thanks a lot, Satya.
Thanks, Varun. Thanks for the good question.
Thanks, Mr. Atyam. Thanks, Mr. Gupta, for joining us. Thanks to each and every one of you who's sitting and staying back for us, listening to our conversations so diligently. I would like to extend a heartfelt thanks to our speaker, all our moderators, and the audience, lovely audience who have been part of today's event. We would also like to thank our sponsors. Please take a moment to share your feedback, share your thoughts with us. We would like to hear from you to make our future events more better. And we soon want to see you in our future events. Thanks for joining us today. Thanks a lot.